What is up, everybody? Welcome to this, the last Benzinga Small-Cap Conference of 2021. I am your MC for the day, Spencer Israel. Welcome. What's up, everyone in chat? What's up, JP? What's up, James? I see AB in there. I see Desi, Nicole, Sean. How you guys doing today? We got a lot going on today. So we have, I didn't even bother counting. I think we've got several dozen companies here presenting today. Let's remember first what the point of our small cap conferences are. There are a lot of public companies out there, companies that trade in the US, companies that trade overseas. Most of them are hard to reach, right? Maybe they don't get a lot of attention in the mainstream financial media, or they're not super active on the on social media or on other conferences. We have gone and found those companies and brought them to you, and the point here is for you to get actual real virtual FaceTime with these companies. So we're going to have presentations today. They are all going to be followed by Q&A from the chat, from you. So if you have a question of any company at any point today, drop your question in the chat, and we will do our very best to answer them. So we've got public companies. We've got spanning the gamut of industries. We got biotech, we got cannabis, we got REITs, we got miners, we got tech companies, solar companies, just so many things going on today. A couple of things I want to note just before we get started with our first presentation. Number one, it would help us a lot if you just take a split second out of your day and just hit that thumbs up button. Just hit the like button. You only got to do it once. I'm not going to bug you again. Just do it right now. See, it's right there. Smash the like. 1, that will help. 2, we want the chat to be as active as possible. Obviously, there are other things happening throughout the day. Don't be afraid if you're live trading, whatever, let's say you're trading, you're doing your thing, you got us on, as well. Drop your trades in the chat. We want the chat to be active as it can be. There's going to be discussions in there throughout today, discussions related to the speaker, but also whatever you have going on in your trading day today, we want to know. Don't feel like you have to, stick to the topic. No, as long as you're engaging, that's a win for the community. So don't be afraid to drop your trades in the chat if that's the thing you're watching today. If you're watching the market, drop your observations in there as well. We'll have people in the chat moderating it all day long to keep it active and keep it flowing. Number 3, we are giving away a free 1-year subscription to Benzinga Pro today. We are doing it via a Slido poll. If you've been to our previous events, you know what this is about, right? I bring up a barcode on the screen, and you scan that barcode, and throughout the day, we'll be bringing up questions. All you have to do is participate. You don't even have to get the questions right. Just participate for the chance to win a free 1-year sub of Benzinga Pro. I'm going to bring the poll, the code for the poll up now. Okay, there it is. Scan that code, and throughout the day, I will be bringing up questions on the screen for you to answer. They could be opinion-based questions. They could be trivia questions. And then one lucky winner will win a free 1-year sub of Benzinga Pro. We're going to give that out at the end of the day today, which will be around 4 o'clock Eastern time. So a lot to get to. There's the code. I'm taking it off now, but I will bring it back on if you missed it, or just you can just rewind to the stream if you missed it. So drop your questions in the chat. Drop your trades in the chat. Let us know what you like. Hit the like button. Do all that good stuff, and tell us how we're doing. For real. We like feedback. What's up? What's up, Shelly? What's up, WK Harris, Michael? How we doing? All right. All that being said, wait, I'm seeing a thing in the chat. Please post the link. We will post the link in the chat. Not to worry about that. Let's bring on our first speaker of the day, and it's actually going to be a one-on-one fireside chat, not with me. I know that's what you wanted. but it's actually going to be moderated by our own Justin Roberti. He's going to talk to Laurent Lamothe. He is the former Prime Minister of Haiti, and in his next act, his current act, he is a technology entrepreneur. And so let's bring Justin and Laurent on. There's Justin. What's up, man? And there's Laurent. How are we doing, guys?
Hey, guys.
Justin, can you hear me?
Yes, I can hear you. How are you, Spencer?
Excellent, excellent. Great to have you guys on. I will see myself out. I'll be back in a few. But Justin, the floor is yours. Laurent, a pleasure to have you here.
Wonderful to be here.
Well, it's something to follow up on Spencer's all of Spencer's energy here first thing in the morning. But we are thrilled to have Laurent Lamothe on with us. Laurent is, of course, an investor, an entrepreneur, and former Prime Minister of Haiti. It is an honor to have you with us today, sir.
It's a great pleasure to be here, Justin.
So I know that you've had between being you at one point were a professional athlete, and then you pivoted from there back into the private sector. Then did a stint as Prime Minister and accomplished quite a bit there, and then went back into the private sector. You've had quite an unusual career path compared to most people, with some fairly illustrious accomplishments. At what point did you start looking at the possibilities involved in global investing? It seems like that actually preceded your time in office, but was there were there elements of the time that you spent as Prime Minister that sort of informed your point of view on global investing?
Actually, no. I started investing way back in the days. I started in 1998. So I did a startup called Global Voice Group with a co-founder, and we started on a $5,000 loan from my dad at the time.
Wow.
Who basically, thought that he was just, giving me the money just, for me to go away and stop asking him.
$5,000. That was your round one seed funding, huh?
That was their seed funding. That was the pre-seed funding. So we started in one country in South America, in the telecom space. So we were basically selling airtime, international airtime to mid-sized carriers. We started in one country in Suriname, and so we then went to Guyana, and then I met a friend of mine who was in Africa and says, "Look, I think you should check out Africa because the opportunities there are great." I'm like, "Are you sure? Africa, really?" And he's like, "Yeah, you should give it a try." So I went over to Ivory Coast and we started there, and basically we became, I would say, one of the largest companies in Africa selling airtime to large carriers in Europe and in the United States. Wow. So that was, that's been quite a ride. The company, I did that from 98 to 2010. And basically we were trading over, 4 billion minutes every month at the time. And, it's been quite a, so I've been an early Africa believer, an early Africa investor, having lived it and eyewitnessing it every day.
And have you seen the opportunities grow in these kind of developing markets? How is it looking today versus when you started 20 odd years ago?
Well, it's very different in the sense that it's much more mature. Africa is a huge continent. We're talking about 1 billion people, right. And we're talking about a continent that's very often misunderstood, and people don't understand the opportunities because of lack of communications. You have so many different languages, and you have a lot of naysayers, a lot of people that don't believe in Africa. I'm one of those, I would say, success stories that have invested there, that have believed in it. Not at the beginning, I was a little bit jittery, just like everybody else. But having lived it, the opportunities today are much greater because you have a much more mature market. You have a structured market. I mean, you have countries such as Nigeria, Ghana. Nigeria is 140 million people market. Ghana is like over 40 million market, and in different areas. For example, fintech is an area of great need.
Sure.
You have 54 countries also in Africa. So people that are not there, and you're seeing a huge shift of companies going down there. Google is investing heavily down there. Salesforce, when I spoke to their CEO, they're planning on investing there. So you see a huge momentum now going into the African continent.
Mm-hmm. And sure, and technology has certainly helped make the web boom, of course, and now blockchain has certainly helped make more opportunities more available. I think that a lot of investors who are looking for high risk, high return investments would probably gladly consider African startups that might 10x, but and look to reach that untapped audience. It just intuitively seems to make sense since it's a large audience. It's also an underserved audience. You have many unbanked and underbanked there, for example. So as you mentioned, fintech seems like a really promising place. I have a feeling a lot of retail investors and even smaller projects don't necessarily really know where to get a foothold to start looking at global investment, which is why you have the sometimes accurate criticism of a blockchain consisting of a lot of U.S. and European-based companies serving the problems of U.S.-based and European users. That has been an ongoing sort of criticism. Where do people start if they want to properly vet something as an investment, and maybe get in the ground floor of a promising startup or an African-based unicorn? I know that there have been several over the past year.
Look, there are several avenues. One of them, certainly, if investors are looking, for example, blockchain investors, Africa is a fertile. It's a great market for blockchain investors. Why? Mm-hmm. Because one of the main applications of blockchains is, for example, money transfer and the high cost of money transfers. You have billions of dollars going into Africa, and the average fee that the sender of a transfer is paying is between 12 to 15%. So that's incredibly high. Mm-hmm. And you have billions of dollars being paid in fees every year. So that creates a perfect ground for blockchain investors wanting to invest in money transfers, for example. Mm-hmm. And the technology is well received in terms of the leapfrogging is definitely a reality there. And when you see and you have companies that are taking the next step. So you have a company, for example, called Untapped. Mm-hmm. Untapped, what they do is they bring several, they just did several trips into South Africa, for example, and they bring with them U.S. investors, and those U.S. investors get to see, firsthand the companies or the fund that they're investing to, and they encourage, and they've done that with several companies, they encourage companies to incorporate in Delaware in the U.S. in order to have the access to U.S. capital markets, and thus reducing the risk into investing in that would otherwise exist in the minds of U.S. investors. Well, they take those companies to the U.S. and incorporate here. Now, it's a twofold advantage, because for the company is able to have access to the U.S. the U.S. capital market on one hand. On the other hand, the investor also has access to the niche markets that would otherwise be untapped. So Untapped is actually the company. Mm-hmm. And Jim Chu is the person driving this innovation, and he's investing heavily in Africa. So it's a really win-win situation.
Mm-hmm. It seems like the level of firsthand research to do due diligence for these projects, just as an average retail investor, maybe kind of on the more private side of things rather than institutional, it could be intimidating to make a start. Is the best way to do that to look for funds that are making these kind of investments and kind of get on board in that way? Or what's the best way to, make an impact there and also sort of protect yourself in your investment?
Well, there are several funds that are investing in that space, in the different, because as one has to be bullish, of course, and of course invest, part of the portfolio into a market like that. But there are several funds. Untapped is one of them. Invest Africa Fund is another one. So you have very good funds that do the deep dive research into those different companies and provide a pretty nice return that investors would love to have in a diversified portfolio.
Mm-hmm. Now you mentioned, of course, this is the small cap conference, but we're looking at all different forms of fundraising. They're all relevant. So to just talk about fintech, blockchain for a minute here. I mean, it certainly is within the ethos and the intended the stated goals, like in the Bitcoin white paper, going back to the beginning DNA of what crypto has become. To create global access to financial instruments and financial institutions that wasn't available for a number of people before. Do you see fintech as an opportunity to make more of that actually reality, some of our higher ideals in Africa in terms of servicing that audience?
100%. If you see already the valuations of companies in Africa, especially, for example, in the digital banking area, is incredibly high. There is a company called Kuda Bank, which is it's a digital bank in Nigeria that started. They started with a valuation of about $36 million. Now they have a valuation of over $500 million, and then they only have really 1 million subscribers, of which 240,000 are active. So imagine with just 1 million subscribers, the valuation of $500 million, the growth potential that this bank has, and that's just one. In the small cap space, in South Africa, for example, you have great opportunities after the COVID. The real estate market is one that took a huge hit, and that creates a lot of I would say mispricing in the small cap area, and that creates, of course, great opportunities for investors wanting to come in, and they have an organized the Johannesburg Stock Exchange, so they have a very organized market. So and then you have opportunities in that space, because real estate has been hit very hard in Africa, especially in South Africa, by COVID, and the opportunities are endless.
We've spoken a lot about Africa. I mean, obviously that's a place that you've been focusing. What about other areas of the world that we should be looking at? Outside of Europe, outside of the U.S., of course, Haiti. What are other opportunities we should be looking for as investors, and even as projects looking for a place to expand, make partners, that sort of thing?
Well, I mean, Haiti and the Caribbean in general is definitely a place with. I mean, Haiti is a huge market with a very large size diaspora. Same thing for the Dominican Republic. Same thing for Jamaica, for example. So you have opportunities there in the fintech area, also in the money transfer area, because, for example, you take a country like Haiti. Haiti has just every year received about $3.6 billion, which is 40% of our GDP, in money transfer. And the fees paid are about between 10 to 12%. So every year, Haitians pay between $360 to $400 million just in fees from the money transfer houses. So, by developing, and in Haiti, everybody has a cell phone or two. Everybody has at least one or two cell phones. Sure. So imagine the opportunities that could create for a company. Basically doing a digital money transfer, or doing it through crypto or USDT. We see what's happening in El Salvador with the adoption of Bitcoin as a legal tender. So it's easier, Justin, for these type of smaller emerging markets to adopt legislation and change the landscape. And that's why the opportunities are there. El Salvador is a country with that's full of opportunities today for investors, and you see it. You see, Bitcoin ATMs all over, and that and the side that people don't talk about is the impact that the Chivo wallet, this Bitcoin as a legal tender, had on the money transfer fees and the benefits that the people and, of course, the investors are getting from this digital wallet, because then they can trade Bitcoin or any other currencies, and including USDT. So people are using that to make money transfers and then lower the access fee, the transaction fee, for that space.
Sure. The use case around eliminating intermediaries and reducing fees through fintech is, I mean, obviously, like, it's something that we feel in the U.S., but just is enormously important in other places where they're depending on transfers going out to relatives and coming in to the country. And that is a huge amount of money, 12% right off the top. I mean, you can obviously see why that's so important. Are there other emerging or regulated industries like legalized cannabis in the U.S., or organics and medicine in general, so psilocybin, for example? Are there any other emerging industries that you're feeling equally bullish about?
Well, certainly the legalized cannabis is one of them. Although in the Caribbean it's slower, especially in Haiti, and we see it as a much slower because it has to do with culture. It has to do with a legacy of mostly the culture of the country. But that's a market that has huge upside potential. And in Africa, we see, for example, a country like Lesotho, which is a very small kingdom that probably nobody has heard about, but that's very bullish on cannabis investments, for example. And they have welcoming laws, for investors to invest in Lesotho into the cannabis industry. So, you have fintech, that's certainly huge. Legal tech is very big also. As you see, what's going on in the US, for example, with the migrants crisis, the Haitian migrant crisis, and several others, immigration has become a huge issue, and opening an opportunity for legal tech companies to develop apps to make it easier to obtain information, to make it easier for people to have access to the US immigration system and understand it better, and also putting out of business the coyotes, the illegal people, the illegal companies providing false information, fake news to immigrants that are creating this sometimes this inflow of migrants. So you have, and legal tech can play a significant role into preventing that and easing the access to information and having subscription-based following of cases. So you have, I think that we're at a wonderful time of opportunities, and where the bigger markets are need the smaller markets in order to keep growing. And this is a reality today that you'll see today and that you'll see tomorrow and for the ongoing future.
One last question, because we're just about to wrap up. Since you have had a level of accomplishment, of course, I don't think anyone else on this call right now has the experience of having been prime minister. Is there any wisdom you can bring to us from that very unique experience and accomplishment that you've had, that you've brought over back to your private sector life and your attitude toward investing?
Well, one is certainly to do your research and believe in diversification, of course, and in government is the same. I mean, I tried to bring my private sector skills, to government when I was there, and certainly when I left with an experience of having led a country that was in great crisis. After the earthquake, the country that was completely shattered, and having to use, I would say, innovative strategies and non-traditional methods, one is to mobilize international sensibilization first on our plight. Second is to also show the opportunities that the country had to invest. I mean, we had, for example, in the lodging industry, we had 0 hotels after the earthquake. All the hotels had been destroyed. So it took a lot of skills and a lot of persuasion and negotiation to bring, for example, Marriott into the country. And Marriott opened a super nice hotel there. Best Western had done, and that was investing 101, because you had to really roll out the red carpet for those brands to give the country a shot. So now I see it the other way around, that you should never cast off an opportunity or a market, and you should look into as a as an investor, look into markets that have lots of potential and that not necessarily everybody is interested in. And those markets can be the hidden gem that people are looking for.
Well, thank you so much. It is a great honor for you to join us. It was a great honor for us for you to come join us today. Thank you so much for your time. We really appreciate your insights, Laurent. And it's been great speaking with you again.
Great, Justin. Thank you very much. And it was a wonderful pleasure to be here.
Thank you very much.
Thanks a lot, Laurent. Thanks a lot, Justin. I just want to give a couple quick shout outs. One to our chat. You guys are on fire today. I saw you guys talking about Roku, which just spiked on some news. So keep it going. Keep it coming in the chat. We love it. We love it. Thanks a lot, Justin. The other shout out I want to give is to the guys on our news desk, the Benzinga Pro News desk. These guys are just pros, powering through the headlines as they come in. Speaking of big movers today, this next company that is coming up had news this morning and saw their shares spike as much as 50%, 50, not 15, 50% this morning. Let's see if we can get them on right now. We got a lot to get to here. So the head of IR at Lexaria Bioscience, George Jurcic, I see him here. There he is. George, welcome to the Benzinga Small Cap Conference.
Hi, good morning, everyone. Thanks for having me. Thanks for the intro there. It's been a good day to the market so far, and we're looking forward to the continuation of the day.
It has been. So I understand you have some slides. So can you please share your slides or bring them up on the screen here?
Yes.
There we go. Can you go into present mode, please? There we go. Perfect. All right, sir. I mentioned the headline. You guys had news. I'm sure you'll cover it, but the floor is yours.
Perfect. Thank you very much. Well, hello. Good morning, everyone. For those of you who are new to Lexaria, welcome. Our disclaimer side, also available on our website. I'll start off this presentation by providing a short overview of the company, our technology, DiHydroTech, then dive into our R&D program, which has produced exciting results this year. Our intellectual property portfolio is very strong. We have 23 patents granted, and we have another 50 pending all over the world. We are patent granted in the United States, Australia, the European Union, Japan, India, Mexico, and China. On one particular note, we do have a patent granted in the EU and also in Australia that allows us to already under granted status to use DiHydroTech CBD to treat heart disease, which should be of great interest to yourselves and for us as we pursue CBD for hypertension with the FDA. We have a disruptive drug technology with multiple opportunities for success in cannabinoids, oral nicotine, antivirals, and other active pharmaceutical ingredients. We're showing great revenue growth, still under about $1 million a year, but with that said, roughly 99% profit margin on these royalties. We have ample scientific data evidencing our technology delivers higher quantities of APIs in less time for cannabidiol, oral nicotine for reduced risk, and antiviral drugs for COVID-19 and other infectious diseases. We uplisted to NASDAQ capital markets in January. Raised about $11 million US and raised about another $4 million through our publicly traded warrants in July. All our operations are fully funded until Q2 2023, and we're pursuing an investigational new drug enabling program for DiHydroTech CBD as a prospective registered treatment for hypertension with the Food and Drug Administration, which I'll touch upon later in this presentation. The point here on this slide is to illustrate our technology has been tested in virtually every one of these sectors, valued at about $245 billion, which gives our shareholders various opportunities for success. I'll touch upon some of these later in the presentation, but the audience should be aware we have a versatile technology with multiple applications and paths for success. This slide shows you the progress of some of our leading programs. Some of you may already be familiar with these markets, but you can see our CBD for hypertension is well underway, with the goal of having an FDA meeting in 2022. The CBD for hypertension market is a $28 billion market all by itself. But get this, in the United States, and this data is freely available, 1 person in 4 who is diagnosed with hypertension is actually using drugs to treat it. So that means 3 out of 4 are not. Meaning that if this stat is valid, that $28 billion market could actually be a $100 billion market in waiting. That is a lot of unmet demand, and I will tell you why we think we could meet some of that demand later on in this presentation. Oral nicotine is gearing up for human studies. Antiviral therapies, NSAIDs, PDE5 inhibitors continue to evidence superior results. CBD for epilepsy is an interesting one and a very important one. I'll dive into this a little deeper in the coming slides. This slide here, this is a great slide. This is a PK curve, came out of our 2018 human clinical study. The black line, as you can see, is our dihydrotec formulation. The dotted line is one without dihydrotec. And the shaded light gray dotted line was one of our competitors in their own human study using a nanotechnology. They were delivering about 100 milligrams of CBD, and we delivered about 90 milligrams of CBD in our study. Slightly different, but comparable. Blood samples were taken every 30 minutes up to the 3-hour mark, and then basically roughly every hour on the hour until the end of the study. You can see for yourself that in the first 30 minutes and at the first blood draw, the nanotech is stuck at 0. It really hasn't started to work. And by the 1-hour mark, we delivered more CBD than the other formulations throughout the entire study. On the left-hand side, you can see 317% more CBD delivered, higher CBD delivery throughout the entire study, higher cerebral perfusion, and lower blood pressure shown versus baseline. Truly remarkable results. This is a nice simplified description of how we render dihydrotec formulations and what those formulations can be and some of the benefits they allow. Just to put it in perspective, we named the technology dihydrotec because we have patented the process in a composition by which we use a dehydration methodology to create an effective molecular association between an active pharmaceutical ingredient and delivery method. We utilize long-chain fatty acids, and this is the focus of our delivery technology. In step 1, you can see how we combine a given lipophilic fat-soluble active ingredient with a fatty acid like sunflower oil. We then subject that mixture to certain heat and processing steps and then combine it with a carrier particle such as gum arabic. The hydrotec formulations at least start as powders, and that powder is now mixed with the combined fatty acid and API mixture with or without a co-solvent if needed. It is then blended, further refined, and then subjected to a dehydration processing method, which renders us a final powdered intermediate material in which the hydrotec is now part of. It is baked in, let's say, and what you have is this powder that can be utilized in an end product. We can take that end product powder and we can process it a little bit further. We can compress it into tablets, fill it into capsules, convert it into semi-solids like topical creams and lotions, or even as a liquid for liquid dosing. So how is the hydrotec believed to work? Well, on one side, you can see many of the areas and benefits of long-chain fatty acids. And all we're really doing is creating a figurative Trojan horse, if you will, to piggyback on that fatty acid. We know long-chain fatty acids block and shunt away from receptors in the oral cavity that detect bitterness. And as such, the bitter flavor profile, which is a signature of CBD extracts and is almost eliminated with our tech. We know long-chain fatty acids in the stomach stimulate motility so as to move to the upper intestine. And in the small intestine is where you absorb the long-chain fatty acids. And in the small intestine, long-chain fatty acids uniquely channel towards the lymphatics and directly into the bloodstream instead of into the liver. And as such, you bypass the dreaded first-pass liver metabolism. We have evidence in our study work directly showing that we do bypass first-pass liver metabolism for faster and more complete entry into the blood. Once it's in the bloodstream and circulating up to the brain, for instance, we know long-chain fatty acids affect transport into brain tissue. And again, we seem to piggyback for more rapid and complete entry into the brain, which matters most for the active ingredients that we do work with. I'll quickly reinforce the main talking points from this slide. Our technology masks unwanted taste and eliminates the need for sugar-filled edibles. It improves the speed of onset. Effects are felt within minutes. It increases bioavailability, much more effective at delivering drugs into the bloodstream. It increases brain absorption. Our testing suggests up to 19 times improvement. Reduces drug administration costs with a higher ratio of drug delivery expected to lower the overall drug costs. I'll walk you through some of our key studies and findings for the hydrotec CBD. Please note, when you do see a study with A, that is an animal study, and if you do see an H, that denotes a human study. I'll keep it at a high level, but what I would like the audience to know is there are press release icons on our deck on the right margins, which link to the press releases if you'd like to read a little more detail. So to kick it off, in 2018, we had a skin absorption study as much as a 225% increase in CBD permittability when compared to the highest performing commercial penetration enhancing formulation, and almost 1900% increase in CBD permittability when compared to a control formulation that was devoid of dihydrotech or any commercial penetration enhancers. Our human clinical trial using Lexaria's dihydrotech, I touched upon this a little bit earlier, but again, we delivered 317% more CBD into the bloodstream. And in February 2019, a single 90 milligram dose of CBD provided evidence of dihydrotech CBD, I should say, provided evidence of lower blood pressure, a higher blood flow to the brain, faster delivery of onset, larger quantities of CBD within the blood, compared to a single 90 milligram dose of generic CBD. And this study propelled us to our current state, investigating CBD for hypertension. As we move along and come closer to current time, our next study evidenced up to 475% more CBD into blood. The Hydrotech delivered measurable quantities of CBD into blood in as little as 2 minutes, again demonstrating the rapidity of our technology. In 2021, we issued results from our two human hypertension studies. The first one delivered up to 2,100% more CBD into bloodstream and up to 1,700% more CBD into brain tissue. The second one, using our new formulation, delivered up to 2,700% more CBD into bloodstream. Moving along to kind of summer and fall this year, our human clinical study, Hyper H211, evidenced the rapid and sustained drop in blood pressure with the Hydrotech CBD, and subjects experienced excellent tolerability. Human clinical study, Hyper H212, also evidenced up to a remarkable 23% decrease in blood pressure with patented dihydrotech CBD relative to placebo. And those of you who may have high blood pressure, you can truly appreciate what we have achieved. And these positive results moved us towards an investigational new drug application filing with the Food and Drug Administration for our dihydrotech processed CBD as a prospective registered pharmaceutical treatment for hypertension. On this slide, we conducted multiple studies. The first was actually a THC study evidencing dihydrotech delivers equivalent quantity of oral THC 3 times faster, 15 minutes versus 45. We announced an R&D program to compare the first and only FDA-approved prescription CBD Epidiolex. This is actually a head-to-head study, if you will, to compare the effectiveness of the FDA-approved Epidiolex to dihydrotech CBD for reducing seizure activity. And finally, we announced an ambitious new hypertension study. This will be the most comprehensive study ever undertaken by Lexaria. It is expected to consist of 60 volunteers between the ages of 45 and 70, using 3 150 milligram doses of dihydrotech CBD every day for the 6-week duration of the study. Study protocols are currently being readied for submission to the Independent Review Board, and approval is anticipated by January 2022, and final results should be available Q2, Q3 later on that year. This body of work really led us to what I touched upon earlier in this presentation, our IND FDA plans. As a background, the U.S. National Center for Health Statistics estimated that 108 million adults have hypertension, and 3 out of 4 in the U.S. adults with hypertension do not have it under control. This market has a lot of unmet need. Think about it. 3 out of 4, in some literature, 4 out of 5, regardless, people just don't seem to take it serious. Or on the other hand, for most people, the medications may not be accessible, whether that is because they're too expensive or adults do not want the side effects that the current medications offer. That is why these unmet needs highlights demand for new approaches to lower blood pressure. So we announced Lexaria will be pursuing a pre-IND meeting with the FDA in early 2022 with a view to IND filing by late 2022 via the expedited 505(b)(2) NDA pathway for rapid market product launch. I'll switch gears to work on our antivirals. This is a hot topic given COVID-19. 2 studies on this page. The first demonstrating improved delivery of select COVID-19 treatments with drug classes also used against HIV and AIDS. And a primate study. The main purpose of this study was to confirm that Lexaria's dihydrotech formulation and processing methodology did not negate the known antiviral efficacy of these compounds, which it did not. This study was performed using a primate cell line, Vero E6, and conducted by a leading independent U.S. biosafety level 3 testing laboratory that delivers critical services to government and commercial customers. This was an important step towards advancing the animal and ultimately human efficacy testing for the purpose of using dihydrotech processed drugs to potentially treat COVID-19. Lexaria completed a successful antiviral drug molecular characterization study with Canada's premier federally funded research organization, the National Research Council. The NRC has successfully confirmed Lexaria's study objectives, demonstrating dihydrotech processing and formulation technology does not create a covalently bonded new molecular entity, or an NME. In that, each drug tested remained stable and did not undergo change in chemical structure. These findings are strongly supportive of accelerated regulatory findings, such as the 505(b)(2) pathway, which I just mentioned, permitted by the FDA and other international regulators. And finally, study viral A23, demonstrating significant enhancement in antiviral drug delivery with possible benefits for treating SARS-CoV-2, COVID-19, and mRNA vaccine side effects. And finally, our breakthroughs with oral nicotine. As you can see in the slide, 2 studies in 2018 with truly impressive results. The first one here, 148% improvement in peak nicotine delivery. 1100%, I should say, rather, faster delivery of nicotine to the bloodstream, 560% higher blood levels of nicotine. And the second study was even more remarkable, 90% more nicotine, 70% more nicotine delivered within the first 15 minutes. And the stats go on and on, up to 295% higher brain levels of nicotine. Truly, truly impressive results here. And our last slide here to wrap up our oral nicotine, we did a 2021 study demonstrating dihydrotech oral nicotine delivery peaked in bloodstream 10 to 20 times faster than controls. And peak levels were achieved up to 10 times higher than controls. And our partners within the nicotine industry, Altria has funded R&D and is licensed to use our dihydrotech in U.S. markets and has agreed to pay us a royalty on any oral nicotine product sales. And our research collaboration with British American Tobacco. And also discussions are underway with other Fortune 100 companies for dihydrotech for oral nicotine use. Our commercial opportunities are endless. We've demonstrated our ability to enter formal agreements with Fortune 100 companies. We are actively developing lead product pipeline candidates. And we also engage strategic partners with third-party companies interested in exploring formulation opportunities with their specific APIs of interest, licensing our technology in exchange for upfront fees, milestone payments, and/or royalty payments. Lastly, Lexaria's key executives, directors, and advisors, Chris Bunka, our chairman and CEO, John Doherty, our president, as well as our strategic advisors who all make this happen. Finally, our corporate and financial information. We have 5.7 million shares outstanding, approximately 8.3 fully diluted. At the time of this presentation, share price was $6.19. Inside ownership is about 10%. That does not include derivative holdings. Our average volume, 90-day average volume is about 850,000 shares a day. Market cap about 35 million. Just a last note, we currently we did release our financial statements a short time ago. We're sitting at about $11 million cash US in the bank. With that said, thank you for tuning in. I'll now answer some of the questions that you do have.
We do have some questions from the chat, George. First off, thank you very much. This first one here is from James, and just to be clear, what kind of FDA approvals do you have or are you in the process of getting, just to summarize all the information?
Sure. Just to kind of recap that question is currently right now, we're in a pre-IND meeting. So we do not have anything filed with the FDA at this time. our plans right now to have that meeting. You can call it later on this year later on next year in 2022. We are working currently with our consultants on this topic, and we'll provide more guidance to the market most likely in January when you have those timelines a little more firmed up.
Can you explain the importance of the IND? Well, first off, explain what IND means. Explain what is such a big deal about that.
Sure. That's an investigational new drug filing. So really taking a new product to market. Our body of evidence and our studies that I did talk about in this presentation have highlighted some of those tremendous results. And it's really gathering those results to kind of state your case, if you will, to the FDA. To really show that you have a valid technology, a valid product. It does not do any harm. It works. It says what's on the tin, as they say. And really furthering those conversations and going through those clinical trials and subsequent valuation metrics to reach that final milestone of bringing a product to market.
Awesome. George Jurcic is the head of IR at Lexaria Bioscience. George, thank you so much for the time today. Thanks for the clarity, and good luck.
You're welcome. Thanks for having me, and thank you, everyone.
All right. I'm going to bring our next guest here on in a couple of minutes. Before I do that, I just want to, do as I say and follow through on my promise that I will be bringing up the Slido poll back throughout the day. So let's bring it up again right now. As I said off the top, this is a opportunity for someone to win a free 1-year subscription to Benzinga Pro. Just scan the QR code on the screen and just participate. I will be changing the slides throughout the day. As I change them, they'll change on your screen. Just answer right or wrong. Some of them don't even have this one doesn't even have a right or wrong answer. And we're going to compile all the information, all the people that submitted questions or submitted answers. And at the end of the day at 4:00, we will pick a winner. So there is that. I see the chat super active today. Shout out to the chat. You guys, the trade ideas are flying in there. Keep the trade ideas coming, right? We don't necessarily, I don't personally care if the chat is talking about other things, right? We've got the conference, it's going all day. But here at Benzinga, we know the market never stops, right? Trading never stops. So, except for days when, the market's closed, and on those days it does stop. But market's going today, things are hot. So drop your trades in the chat, whatever you're seeing out there, whatever you're seeing as far as movers, as far as news, let everyone know. I want to give another shout out. I gave a few shout outs before to our news desk, to the chat. I want to give a shout out to the Benzinga Pro developers. I'm sure a lot of you guys saw yesterday there was a number of Amazon Web Services outages throughout the internet yesterday. Not on Benzinga Pro. Benzinga Pro did not have a single outage yesterday. I saw CNBC had some problems. I saw Disney had some problems. A lot of places had problems. Benzinga Pro did not. So huge shout out to the developers. Sometimes they get the brunt of the anger, right? Because people only notice them when things go wrong, but when things go right, they deserve to be noticed. So shout out to all of our hardworking developers on Benzinga Pro. Where are we doing? How are we doing, I should say, on the like front? We're at 184 likes. Can we get to 200 likes in the next 30 seconds before I bring on our guest? Let's see. I don't actually have the music. Plus, I don't know. The music may be copyrighted, so I'm not going to play that. But I can hum it. Okay, I'm not going to wait. It's 9:50. We're almost there. Oh, we got some tunage. I like it. Nice. All right. Let's bring the tunage back later, guys. Let's take the tunes off here. Let's bring on Stephen Rossi, who is the CEO of Worksport. Hey, by sheer coincidence, Worksport also had a headline this morning. Stephen Rossi, good morning. Welcome to the Benzinga Small-Cap Conference. Uh-oh. Stephen, you're on mute. Check your mic in StreamYard. Unless I can't hear him and you all can, in which case, that's my problem.
Spencer, can you hear me?
Yes, I hear you now.
Hey, good morning. How are you, Spencer?
I'm doing fantastic. How are you?
Good, good. Sorry for the technical glitch. There's lots of switches and wheels in these, but nice to see you again.
So many switches, so many wheels. Great to see you as always, sir.
Yeah.
We've got a video, correct?
Yeah, so we got I think something just something in the background. Today we're gonna switch it up a little bit on our normal presentations.
Okay.
We got our video going.
Yeah, guys, let's go ahead and play that.
All right. Well, Spencer, it's always good to spend some time with the Benzinga crowd. We have some of our longest and loyalist shareholders and supporters, from Benzinga. We always hats off to you, hats off to that pro team like you were talking about, and we're happy to be here again today. So usually, we go through our presentation. And I think that we've done our presentation a lot. Our presentation's available at investworksport.com. So today we're going to switch things up a little bit. And we're going to. I get asked a lot, about the background of the company, updates in the company, my history as a business person. So if it's all right with everyone, I wanted to spend a little bit of time today just to make sure, just to talk a little bit. About where we came from and where we are going moving forward. So, I guess it all started back when I was a boy. We growing up in the 80s, telling everyone how old I am now. Summers were bicycling, our rear ends are glued to bike seats, basketball, baseball, summertime. Wintertime was hockey, sledding, tobogganing, and a lot of snowball fights growing up in Canada. But some of my fun, and that was always playing with my brother. I got a twin brother, so there's another one of me out there. Our fondest memories were outside, but some of the best memories I ever had really started with camping with my uncle. Once a year, we went camping, and together as a family, me, my brother, my uncle, and those are some of the best times for us. I used to love seeing him pull up in this big old red Ford pickup truck. And man, we load that truck up, to the roof, full of everything. And that thing, kind of just was a workhorse. It wouldn't quit. We'd load it right up. It'd get us through all the trails, into the campsite and the job site. And it'd get us, some of our fondest memories. That's, probably the time I'd want to say that I really fell in love with pickup trucks. I mean, man, I tried to get my hands on that truck, but I kept getting, it kept getting older, and finally it was time to go. But that's when my love of trucks kind of really started. Fast forwarding to when I was about 12 years old, was my first job. Like a lot of kids my age, my first job was a paper boy. And I remember, my boss at the time, the owner of this paper route, said, just get the papers delivered, by the morning. And of course, I didn't listen to him. I got my first taste of business from that. And I was scrappy and hardworking like that Ford, that big red Ford pickup truck from my uncle. And within a month, I had that paper route into a small business of my own, which was my first taste of business. I was upselling my customers magazine subscriptions, grass cutting in the summer, snow shoveling in the winter, and that was my first taste of real business, and I was hooked at that point. And I made enough money, doing that for a few years, and then my other jobs to save up for 2 years tuition for university. And now I had to graduate. I graduated high school a year early. So here I am, 18 years old, just turned 18 in university, and I had enough for a couple of years saved up, and I did 1 year, 1.5 years of university, and it really gave me the fundamentals of business. But I was anxious to kind of get out there and do my own thing. So after that year, I took whatever I had left in savings, and from working through university as a lifeguard. And I bought my very own red pickup truck, and boy, we put a lot of miles on that truck. I think that every mile I put on that truck running my own business, was a lesson that I learned also, a hard taught lesson in school, a hard knocks and business that I don't think I would have been able to learn from books. I don't think I would have been able to learn from a professor. It was a grind, but I built my own business, and I was really, really excited to kind of keep growing and evolving. So, that puts me into my mid-20s, and with a solid 10 years of business experience, under my belt, and a lot of experience, and knowledge and know-how, I began thinking about pickup trucks from a business perspective. Remember, I still had my old Ford red pickup truck that was, my partner in crime. So one of my mottos is no gain is made without a larger risk first taken. So I took these businesses that I'd founded from nothing and with nothing, and I sold them. And that's when Worksport was founded in 2011. I was in my mid to late 20s, and the motto of Worksport at that time was taking everything I had learned from business and everything I learned about being able to go anywhere and do everything, and my love for pickup trucks, and kind of combine it into one. So what we noticed is that pickup trucks kept getting better. I mean, we're talking like late 2010. 2011, the F-150 was dynamite back then, and pickup trucks were taking over the world, and they are still now. So the truck accessories that were being bolted on these trucks were the same old truck accessories from 10 years ago. So you got this brand new truck with the first LED screen in there, GPS and navigation, and heated seats. But you got a cover back there that was the same cover you could buy for 1984, and that's where we saw an opportunity, a big disparity. So we founded Worksport based on building innovative products and learning and evolving with the market. But not only did I want to build a good business, but I also wanted to kind of do good in the world. So creating these affordable products, I understood that what the businesses wanted and the consumers wanted, and I also understand that the first thing that the consumers were buying with their trucks was this tonneau cover. With that, I guess another founding motto we have is we don't inherit the world from our ancestors, but we borrow it from our children. So my father was and still is a big influence to me in my life, and he used to always come to me and tell me, we don't inherit the world from our ancestors, but we borrow it from our children. And that statement really gave me a lot to think about over the years. And on one of those many late nights, on this owner-operated business, in an aha moment for Worksport, we thought, why not? We're already making these tonneau covers, so why not use this tonneau cover as a blank canvas? And that was when Terravis was founded, which a lot of people are excited about. We decided to integrate our tonneau covers with a highly efficient solar panel. And another motto we have, because we're full of them, is you don't have to be the best. You have to be the first. So integrating a solar panel, we have the intellectual property. This is a great idea. And that's when the Terravis system was founded. So you have an electric truck, Rivian, Ford, GM, all these cool trucks coming, and all these people buying trucks by the droves or in droves. And now you have a solar tonneau cover that will charge that truck. If you don't have an electric truck, you can buy our solar tonneau cover, now called the Terravis Solus, and you can buy our Terravis Core battery system. And now you've created a microgrid. Getting back to where I came from as a kid, go anywhere, do everything. If you don't have a pickup truck at all, that's fine. You could buy our battery system for a stormy day. Put it in the cupboard or bring it to the back, 9 acres of your property, and go camping just like I enjoyed doing still to this day and when I was a kid. Jumping a few years ahead, the Terravis system is the first truck bed system now that not only delivers high quality storage, security, and function, but also delivers power that can be used wherever and whenever you need it. Like we always say to those that swing a hammer or swing a golf club. So we're really proud of where we've come from, and we're really proud of what we've accomplished in just this short year. Remembering that in 2019, late 2019, just before COVID, we didn't have a lot of capital, but we had the experience and my experience from running a business to kind of keep our balance sheet clean and keep our story evolving, and we would be able to stretch a penny. So on a shoestring, we built our business, and it's only really been 1 year that we've been able to really raise capital and deploy. And so we have a lot of updates on what we accomplished this year, and then we have some, we'll open it up to some questions from the Benzinga crowd as well. But 2021 shook out exactly like it was supposed to. The revenues weren't necessarily something that we were after, but it was part of our larger plan. We built out our infrastructure. Like I always say, brick by brick, we build something meaningful. We need a solid foundation. So we took this COVID opportunity to augment the way we've done business. Previously, and still to this day, we do own a factory in China, but we wanted to be able to be one of the first made in North America, almost fully automated brands out there. When we automate production and we invest in that automation, we have such high precision and such low costs that we get a solid beat, that we can go to the market at a great price, but we go with laser focused precision. The same product every time. It's not manually made and not reliant on infrastructures and supply chains that were already kind of upside down, and they still are to this day. So with our automation investment, we kind of paused the revenue side, and we've been investing in the factory that I sit from here today to build something that hasn't been ever built before. And even though we haven't been focused on selling, we focused on building our customer base. We just had a PR today that announced that we're ready now. We're ready to start looking at OEM business. When we look at OEM manufacturing and the amount of inbound interest we've had from OEMs around the world, both large and small and new, we start looking at being able to supply through automation and also being able to deliver a quality product, which we can do through automated system. So I think that these are very critical bricks that we've been laying in the foundation for Worksport, and we're poised now for a level of success that we weren't poised for before, and our future has never been brighter. We've raised about $30 million, so we have all the capital we need to guarantee the success moving forward. And we're doing exactly as been advertised. We're deploying capital for inventory from China. We're launching a worksport.com direct-to-consumer website, which allows people to buy Worksport products directly from us. That gives us and the investors a very high margin of profit, protects and grows our brand, and allows us to establish ourselves so that as we build B2B business, we're building it as an established brand so that we can kind of name the terms of our sales and keep enviable profit margins and earnings for investors, as opposed to starting as an unknown where you're kind of more swayed by the buyers. We're deploying capital on the new sales channel, and the Terravis energy products, the Terravis Solus, the solar cover, and the Terravis Core battery system are in real life existence. We'll be launching those to the world very soon, showing real life products, solving real life problems in our trucks, in our studios very soon, and we're already taking pre-orders. The pre-order campaign has gone very well. We've launched that campaign to friends and family, and only now are we starting our marketing engine to grow towards 10, 20, or $30 million in pre-orders before we start filling. And this could all, or should all, be done within early 2022. So we're right on that cusp of breakouts. We're taking in partnerships, we're having conversations, we're building an automated factory, we're getting product ready to go, and we're patenting new designs. But what's very interesting is Terravis Energy. So Terravis became such a big idea that we started looking at personal power for pickup trucks and EV truck owners. But then we started thinking about what, again, you don't have to be the best, but you should be the first. What does the future of energy look like? So Benzinga viewers and everyone at Benzinga knows what happens to a stock when there's a lot of demand for it. The same thing that's going to happen to the power prices or energy prices when there's a lot of demand for that, when we all get home at 5 o'clock and plug in our EV. So we're looking to anticipate the problems that we haven't yet even known or become aware of by being the first and the best, by looking at Terravis Energy as a subsidiary to create power for communities and EV charging infrastructure where power isn't otherwise available. And we're deploying unique technologies, specifically looking at hydrogen technologies. And all of this information will be launched in the very short future. So the amount of news flow we have and the amount of exciting milestones we have to meet couldn't be bigger now than ever before. So pre-order campaigns rocking, worksport.com's rocking. We have an amazing pipeline of transactions, and not transactions, but news and milestones that we're meeting. And we feel that we've come so far in 1 year of the 11 years we've been in business that things will continue to accelerate. And we're just extremely excited at the company that we build and what our prospects look like moving forward. So I appreciate the time to update, and I'll open it up to any questions, Spencer, that are available from the crowd, or that you may have for us. We're an open book. We love thread pullers.
I don't know. Hey, Steve, thanks a lot for that. We got a couple questions here from the chat.
Yep.
You ready?
Yeah, absolutely.
All right, let's go. First one, someone was asking specifically about the tonneau cover for the Ford F-150. I'll just read it directly from WK Harris. I'd like to know if the tonneau cover could possibly keep an F-150 hybrid power boost batteries powered up without having the gas engine start. Plans for that?
For sure, yeah. So I mean, people have mentioned like, hey, why would you want to buy a Terravis solar tonneau cover or core battery system when Ford's coming up with a hybrid with the battery pack? See, the thing is with our battery pack, and it's a little tongue-in-cheek, is that you can carry our battery pack with you where you need and just plug something into it. You can't get that Ford F-150 on the second floor of a house you're building, though. So without a really long extension cord. So we're really proud of the Terravis core system for being able to be, something that you can carry in your hands. The question relating to charging the Ford is yes, we will look to integrate our solar cover into OEM applications as we build up OEM relationships with companies like Ford, Stellantis, and General Motors as domestic, so that our cover can charge the low voltage side of EVs or battery packs. And on a Ford, we could produce 600 watts, sometimes even a bit more, and our tech's evolving. We're think tank. We are a think tank, so we are improving solar efficiencies in the technology that we're using. So the answer is yes, and you won't have to run that engine and have to deal with the emissions or the footprint that you're going to be kind of building on the emission side.
Luciana R.T. Bartley made a comment about the supply chain for car manufacturing is being tough right now. Can you comment about your own supply chain right now?
Sure. Yeah. So supply chain, we found for cars, for vehicle manufacturers, supply chain is challenging on I think the biggest thing that I'm hearing from other manufacturers that are manufacturing for OEMs is that nameplates are struggling with chips, and these are microprocessing chips. We don't use them. So, GM, for example, can't make a General Motors truck because it needs a microprocessor. So why make the rest of the truck when it's missing the heart, for example, or the brain? We use more readily available microprocessors in our battery technology. And what's actually happened is that since companies like General Motors are slowing down production because they can't get the microprocessors that they need, but we don't. In fact, supply chain for us has gotten a lot better. The pricing, a lot of our products use aluminum extrusions and steel and aluminum paneling and plastics. And a lot of those peripheral suppliers have actually slowed down because they're not getting the orders from the GM. So, for example, our price of steel has gone down 50%. Our price of aluminum is almost down 50% from what it was at a high about 6 months ago. So our supply chain's actually improved because we don't use the complex microprocessing devices that are slowing production down for phone makers and car makers. So we're not only are we good, we're better than we were.
I mentioned off the top that you guys had some news this morning. The news was relevant to your OEM strategy. Can you just speak more about that?
Yeah, so speaking about our OEM strategy is, at a certain point, you have to, investors want that news flow. They want us to get a deal with ABC company. But at a certain point, a pragmatic business person like myself with the experience that I have has to understand that there's a certain point that we may not be ready for it. We may not be ready, taking on that kind of an account might do us more damage in the long run than good. But we're ready now. So we're kind of bolstering those conversations and we're harboring those conversations with OEMs now. And we've had a ton of interest. So we're ready to have, work on making OEM deals, and we're harboring those conversations now. Those are going fantastic.
Got it. All right, Stephen Rossi, the CEO of Worksport. Stephen, always a pleasure to chat with you, man. Oh, actually, I almost forgot. There was a lot of comments about your chair. Where'd you get it?
So this chair is from IKEA. I'm not gonna lie.
IKEA.
This is from IKEA. IKEA, baby.
Let it be known. Stephen, always a pleasure, man. Have a good one. Thanks a lot for coming on the Benzinga Small-Cap Conference today.
Thanks, guys.
All right. If you guessed IKEA, come up to the front of the room and I'll give you your cookie or whatever. Let's keep it going here. It's 10:10. Hey, did you guys see the VIX lately? The VIX just within the span of a week or two, it doubled, right? We went from 15 to 30. Volatility spiked. What do you do when that happens? Our next guest can tell us. His name is Bryan Sapp. He's a senior market strategist at Schaeffer Investment Research. Hey, there he is. What's up, Bryan?
Hey, how's it going? Thanks for having me.
All right. We're talking volatility. We're talking trading in the volatile markets in periods where the VIX is going higher, which we just had for a couple of weeks. So, do we have your screen share ready? I think we do. All right, then the floor is yours, sir. Tell us what exactly is going on here.
Okay, so you said, the VIX spikes to 30. What do we do? Well, hopefully you're positioned ahead of that spike, because once it spikes to 30, it's generally too late, right? Like if you're putting on hedges after the vol's already spiked, then you're probably in trouble, and or you got washed out of a lot of your long positions. So this is a strategy that we've developed. We're going to talk about buying straddles and using volatility to try to double your money. Generally, we'll put about 100% target on these trades. And we're just going to go through, what we'd like to look at and what could be some potentially good situations and the benefits of it over time. So first off, we're going to talk about some terminology, some benefits of it. We're going to talk about volatility as an asset class, like the trends that it takes over time. Some technical analysis patterns to look for to define potentially, volatile situations. Some catalysts and indicators that we like to overlay with those technical indicators. And then we're going to go over a trade that our subscribers just received to kind of give you an idea of what's what. And then if you have any questions, hopefully we'll have a few minutes at the end. So feel free to write those down and ask me those. So first off, what is a straddle? A straddle is a simultaneous purchase of a call and put option with the same strike price and expiration date. You can structure these directionally if you'd like, or market neutral. So for example, if a stock's at 150 and you buy the 145 strike straddle, that position has a little bit of a bullish lean to it, even though it's a hedge position. And if you were to buy the 155 strike straddle, that would have a little bit of a bearish lean to it. At Schaeffer's, typically what we like to do is just trade market neutrally. And historically, my best trades, my biggest winners have come in situations where I honestly had no idea if the stock was going up or down, or the ETF or whatever it may be. So the way that you make money buying straddles is you profit via an increase in implied volatility and or price moves in either direction. And as a general rule, when you get price moves, implied volatility will follow suit. The price of the options will get bid up as the stock or the ETF becomes more volatile. And again, as a buyer, you don't care if it goes up or down. You just want movement. Just do something. So here are the benefits of trading them. First and foremost, you get a diversification of strategies within a portfolio. For people that trade options or long only, the recent washout that we had, and especially in the small caps, that probably hurt a lot of people. If you use this strategy in conjunction with your other positions, it's going to give you a hedge. So, when COVID happened last year, the market just flushed out, and we had a ton of just huge winners in this service because obviously the market was collapsing. So it can help kind of cushion that blow that you might take from the rest of the market. Now, additionally, these can do well in trending markets. Generally low volatility trending markets, you'll have a lot of, stocks that participate on the bullish side, and you'll get big winners on that. So it can kind of work in both kinds of markets. The market that's kind of the kryptonite for this strategy is a mean reversion. So if you just get long periods of chop, the volatility gets sucked out of the options, and that can be tough. But that's the one time where it's generally tricky to trade these types of things. Another benefit of trading these is with any option trade, you have defined risk in each position. You're buying options. The most that you can lose is your outlay, the premium that you purchased. So when buying options, you can use option convexity to your benefit. The P&L chart for a straddle is similar to that of like a call or a put option, where you can have huge winners in a short period of time. And it's not too uncommon to see 200% and 300% winners in these positions, which are hedge positions, but can still work out really well. The advent of the weekly options has been huge for this. There's so many stocks now that trade weeklies. They have expirations, every week, months out. You can really hone in on what the best time frame is, what the best option is to buy in those situations. And then lastly, you have a low probability of a large loss. So in order to take a complete loss on these positions, you'll have to hold it until expiration, and the stock will have to close at exactly the strike price that you bought on expiration. Very, very highly unlikely. And you can manage risk as you go. There's different ways to manage this, but just the probability of taking a complete crap out on a position is very low compared to buying an out of the money call or put, which has a very high probability of taking a large loss. So we're going to shift gears a little bit and talk about volatility. what volatility does over time. And this applies to virtually any risk asset. It can be crypto, it can be stocks, real estate, gold, whatever it may be. You get these periods of volatility compression, and then you get periods of volatility expansion. The way to think of it maybe is like you get an impulse move in a stock, and then it churns sideways for months, and then you get another impulse move. And the impulsive moves are generally on heavy volume, and they generally happen quickly. The analogy that I like to use is like a coiled spring. So, you know, your click pin, if you take that little spring off the inside of the pin and you take it and you squeeze it, you're essentially compressing energy into that spring, right? And the more you squeeze it, the more energy that's in it. And as you let go, the spring might shoot across the room or hit the wall or whatever it may be. Stocks behave the same way. I'm sure a lot of people have heard the adage, the longer the base, the higher in space. Same principle. If you get something that consolidates for a long, long period of time, when that eventually breaks, you're generally going to get a big reaction. And the longer the consolidation, the bigger the reaction. And then lastly, this is really important. During consolidation phases, the implied volatility of options gets sucked out of it. The stock's not moving. There's not a lot of demand for options. The option prices go down. So as a straddle buyer, if you're trying to buy during that consolidation phase, you're trying to, predict the impulse phase. Well, option prices are generally really low during those consolidation phases. So if you can time the breakout, you're going to get the most bang for your buck, and you're going to be buying the options at their most cheap, basically. So this is just a long-term chart of the VIX. This is a weekly chart. And you can see this impulse consolidation. So, in 18, impulse, long consolidation, little impulse, another consolidation, back and forth until, you had this long consolidation at the end of 19 and then the big blow up during COVID. So, the VIX went from 15 to 85 in a matter of a month. So had you been buying straddles in here at, early 20, it would have been a massive windfall for you. And you probably, would have made a lot of money during that period. So how do you predict when these impulses are going to happen? I like to start with a technical strategy. I sort of start with charts and then kind of dive deeper from there. And I can't go through all these, but you can look it up like on Investopedia or whatever if you're unfamiliar with these. They're pretty common technical patterns, and they're all consolidation patterns. So triangles, symmetrical, ascending or descending. Symmetrical triangles are probably my favorite pattern to trade with this strategy. There's not a lot of those setups out there right now, but you can still find them if you look hard. Rising and falling wedges, bear and bull flags. And then sometimes you'll get long, kind of sloppy consolidations at key price levels. Let's say, for example, 80 was key resistance 3 years ago, and then it was critical support last year. And then the stock has just been kind of churning around the 80 level for the last few months, whatever it may be, in a range. When that range breaks, given the historical price action around that level, chances are you're probably going to get a big move away from it, whether it be up or down. And again, if you're in straddles, you don't care up or down. You just want it to move away from it. And then you can use some technical analysis, and you can use the measured move principle to determine where the stock might go if that pattern breaks out. Now, this is really important, this note. None of these patterns should be used in a vacuum, but when combined with sentiment and option analysis and a catalyst, they provide a significant edge. So we're trying to layer multiple things on top of each other to give ourselves an edge and say, okay, for these 4 reasons, that may be why I'm going to enter this straddle right now. So catalysts, this is really important, and this applies to all option trading. Whenever you buy an option, especially when you buy double premium, when you're buying a call and a put, you need to have a why now. There's an embedded time premium element to these options. So from the instant that you click the buy button, time decay is working against you. So you need to have a reason why this stock or ETF can move in the very near future for you to enter the option. You have to be right on the time frame. And if you're buying, calls or puts, the direction, but with straddles, obviously it doesn't matter. So what do we look for? Like, what are some potential catalysts? Obviously, earnings are the big mover for stocks. For macro things, you may have Fed rate decisions, macro data, peer earnings. Let's say like, United Airlines is reporting earnings in 3 days. Delta's options haven't been bid up, as much as they should have. So you might get a sympathy move with United's earnings. So it might make sense to buy Delta options, that sort of thing. Investor meetings, conferences, FDA results on biotech companies, things like that. So we found that 1 to 2 weeks ahead of the actual event, That's going to be the volatility sweet spot. So the worst thing that you can do as an option buyer is go out and buy a call or put like the day of earnings or right ahead of earnings. The reason being is those options are bid up because everyone knows that earnings are coming. Everyone's speculating on that. And so the price of the options get bid up. The implied volatility gets bid up immediately ahead of the event. If you buy a week or two out, you're generally buying lower vol. And as the event approaches, the implied volatility will increase and that will offset the time decay. So you kind of get like a free ride for a week or two, and anything can happen in that week or two. So you're buying lower vol, you get a wider window for something to happen, and the implied volatility rising into the event is going to benefit your position. And then lastly, let the implied volatility term structure decide the trade's time frame. Again, with the earnings example, if a company reports on Thursday, you probably don't want to buy options that expire the very next day. Reason being, if you're wrong, you're going to take a huge loss. If you buy further out, the implied volatility is going to be generally lower. You're going to get more time for that position to work out. You potentially could get a much bigger winner by giving it another week or two past the event. And the implied volatility is going to be lower. And additionally, you'll have a little bit of a cushion beyond the event. So there will still be some time premium left in that position if you decide to get out of it. So the loss will be smaller generally. So some indicators that we like to look at when finding stocks that may be good straddle setups. First and foremost, short interest. It's no secret that stocks that have high short interest, they're more volatile than stocks that don't have high short interest. And additionally, I like seeing big rising trends in short interest. So if you can find something that's, at 5-year highs or whatever, you have the potential for a big event. You have the potential for those shorts to capitulate and or pile on even more. And you can get a big price move from that. Extreme readings and put call ratios, similar to the short interest. If you have a ton of call buying or put buying, there's some things that go on underneath the surface with the market makers. Those people holding those options, if they decide to close those, you'll get an unwind, and that can cause a lot of price movement in the stock. A technical indicator that I like to use is I like to look at Bollinger Bands. And basically what Bollinger Bands do is they plot 2 standard deviations above and below the current price, and it gives you like a volatility range. So when the bands are wide, that's basically telling you that the stock has been very volatile recently. When the bands are very narrow, that's telling you that the stock has not been volatile. And that ties in with that compression expansion idea that I told you earlier. When the bands are very narrow, volatility is compressed, that could be a sign that something is about to happen in the near future. If you see an uptick in volume, let's say the stock wasn't trading much at all, and then the past 2 days it's traded 2 times the average daily volume over the last week, that could be a sign that something's happened. That means that big money is coming into that stock. Big money can obviously move stocks more than the retail money. So that's something else to look at. And then lastly, cheap options. When you're buying options, cheap is good. When options are expensive, you typically tend to sell them. When options are cheap, you typically tend to buy them. So just a little example of a trade that we sent out to try to bring all these concepts together that I just told you. This was a recommendation in our weekly volatility trader strategy that went out on August the 23rd. It was about a 2-week expiration trade. And the rec was to buy the DraftKings 9-3, 53.5 strike straddle. We paid $3.20 for this. And this was our rationale for entering the trade. So first off, if you see these dotted lines, those are the Bollinger Bands. So you see in this area, they're pretty wide. The stock was volatile. They start to pinch because you get some consolidation. They widen again, yada, yada. So if you look right here, this green arrow is where we entered the trade. So if you look at these bands right here, they're very pinched. They're very narrow. So you've got vol compression. So that's one thing. Number 2, you have a technical pattern. It's a little sloppy, but this is an inverse head and shoulders pattern on a daily setup. So if this were to break in either direction, you're probably going to get a pretty big move on the resolution of that pattern. We use something called the Schaeffer's Volatility Index that looks at option prices, and it lets us know, cheap or expensive. At this given time, the options were priced in the 3rd percentile. So very, very cheap options on DraftKings at the time. You had multiple tests of this 200-day moving average, which is this blue trend line. Everyone knows that's a key moving average, probably has a lot of eyes on it. If and when that breaks either way, you're probably going to get a big price move. And then lastly, the Why Now, the Craig Hallam Gaming Conference was a couple days after we entered this trade. DraftKings was presenting at that event. Generally, if you get any sort of news or company updates, sometimes companies, they'll discuss guidance, whatever it may be. You have the potential for something to happen at that conference that could cause this vol expansion that we're waiting on. And then lastly, if you look down here at this blue rectangle that I kind of highlighted, you'll see the uptick in volume, right? You had very low volume. You had a little spike here for a couple of days, but low volume, little spike, low volume, and then it starts to spike again. So that was a sign that something could be happening in the very near future. So the way that we manage this, generally, if something hits 100% target, we'll take a half off, and then we'll let the rest go into expiration and try to get a little convexity working in our favor. So we took half off here to double, and then we let it run a little bit, and that was the second red arrow was expiration. So that's when we closed the remainder of the position. So 119% gain in 9 trading days, I think it was. So just an example. They obviously all don't work out like this, but I thought this was a good illustration of all the concepts that we just covered. So that's everything for now. Hopefully we have some questions. Hopefully I didn't confuse anyone, but if this is something that you might be interested in, take a look at our website. There's a lot of free content on there, a lot of educational type stuff. It's schaeffersresearch.com. You can follow us on Schaeffer's or at Schaeffer's, on Twitter. A lot of news information, a lot of free newsletters, things of that nature. So that's all I have. We have a couple minutes here if anybody has any questions.
Yeah, if you have any questions, guys, drop them in the chat for Bryan. We're coming into year end. It's always a time to, if not just reassess your entire outlook and portfolio, but consider what you have, what you're prepared for, what you're not prepared for. So thank you for all the information, Bryan. Let me just scroll here and make sure I didn't miss any questions, because there's a chance, because the chat is flying and I want to make sure. Okay, this one's like a practical question.
Okay.
Very specific from Jamie. All right, Bryan, quick question. So we're talking about ticker PATH here. But I'm just going to give you, I'll read, I'll bring it up on the screen. All right. PATH. Okay. Yeah. Trading at 46.70 right now. Earnings out tonight. Oh, that's interesting. Jamie, come on, Jamie. We can't give you specific advice like that. All right. I don't know, Bryan, if you want to comment. I'm sorry. I should have read the whole question before I put it up on the
I can answer that right now pretty easily. If they have earnings out tonight, buying options right now is not a winning proposition. You missed it.
All right.
Yeah.
Here's a better one from Mitch. What is your favorite sentiment indicator?
Probably short interest. Trending short interests. Whenever that data gets updated every 2 weeks, and that's something we constantly monitor. When you get big changes in short interest, that can lead to big price moves in either direction. Maybe shorts pile into something, and then some positive news comes out, and they all have to scramble and cover, or whatever it may be. But typically the shorts are the big money. Those are the big funds, and those are the ones that can really make stocks move. So I would say that's probably my favorite one.
I just want to do a PSA on short interest. What Bryan just said is that, and he's absolutely right, the firm number we have is updated every 2 weeks from FINRA, okay? There are other short interest data points out there from other firms, but the official number is out every 2 weeks. So that's point number one. It's not updated real time. Point number two is I see a lot of people on like FinTwit will like hang their hat on short interest as being like the indicator to rule all indicators. And even though you said it's your favorite here, it is not the only one you look at. And It should not be the only one anyone looks at. A rising short interest is not the be all end all, right? It does not mean squeeze coming. That's not what it means. It means a squeeze can come, but it is not that simple.
Absolutely. So, I think context is very important when you use short interest. So if you have a stock that's rallying, that short interest is also spiking. So the bears are trying to hammer this thing and the stock keeps going up. That's a really good sign that a short squeeze could happen. Yeah. Now, if shorts are piling into something and price is going down, well, the shorts are winning, right? Like they're getting paid. The more they short, the more. So why would they cover if they're in the green? And the more, as short interest rises, the thing keeps trending down. So again, you can't just use short interest in a vacuum. You need to look at the total picture and the context of price and the context of what's coming up in the near future.
All right. Tell the people how they can find you, because I know there's more questions and we don't have time, unfortunately. So tell the people how they can find you.
I'm not very active on social media, but I will write for our website occasionally. I would say follow at Schaeffer's, and then a few of the other guys that I work with, they're a little more active on social media than I am.
All right, Bryan Sapp, Senior Market Strategist at Schaeffer's Investment Research. Bryan, thanks a lot for coming on the Benzinga Small Cap Conference today.
All right, thanks for having me.
All right, let's move this right along here. How are we doing in the market today? We're doing okay. I'll be honest, guys. I checked out crypto right off the open. I haven't been paying too close attention. I'm gonna do a market update after our next guest here. But let's do him first. So let's bring up on the screen, if we can, Scott Kaufman. There he is, the CEO of Creek Road Miners. Scott, how are we doing today?
I'm doing very well. Thank you. Thank you so much.
All right. We have slides. We have them up. There they are.
Fantastic.
Nice. We're talking Bitcoin mining. I love it. The floor is yours, sir.
Fantastic. Thank you. And again, thank you everyone for joining us today. Creek Road Miners is a cryptocurrency mining company. However, we are a cryptocurrency mining company with what we feel is a differentiating objective that we are striving to achieve by utilizing our 5 cornerstone strategy. Now, that's a lot of words. So delving in, what is our objective? Our objective is quite simple. It is to utilize our own energy to power data centers that will mine for cryptocurrencies, enabling us, Creek Road Miners, to build a diversified portfolio of cryptocurrencies. Again, quite simple. Use our own energy, mine for crypto, build a portfolio. This is what our objectives are. This is what we are trying to achieve. How did we develop this objective? It really came from studying the industry, and we decided to start with mining for Bitcoin. And I think in understanding the industry, you needed to understand what it is you cannot control as well as what it is you can control. And obviously what we cannot control is how many people are mining for Bitcoin. What is the network hash rate? Of course, what is the price of Bitcoin? What is the block rewards, as well as what is the cost of the machines? Again, things we cannot control. But focusing on what we can control, at least do our best to control. Obviously, it's the cost of electricity, the number of miners. I mean, in essence, how much money do you have to buy the miners, and what methodology do you acquire these miners? You do your best to control the continuity of mining. Basically, you want to make sure you don't have shutdowns. And then, of course, you can control your internal expenses and overhead. Those are the things we can control. And by studying these aspects of the industry, we developed what we call our 5 cornerstone strategy. What are they? The first is vertical integration. Very simple. It's owning the whole process. It's owning the whole process from energy generation all the way up through the production of cryptocurrency mining. 1. The second, energy diversification. Basically, it means having multiple energy sources providing energy to one facility, as opposed to having one large infrastructure piece providing that energy. The third cornerstone is geographic distribution. Very simple. Would rather have 10, 50 megawatt facilities as opposed to one large 500 megawatt facility. The fourth is cryptocurrency diversification. Look, I think we all understand that Bitcoin and Ethereum are the staples of today's industry, but who knows what tomorrow will bring. This industry, from our perspective, is in its infancy. And the fifth in cornerstone strategy is revenue diversification. We feel that there need to be other forms of revenue generated by our company, other than that related to Bitcoin, as a means of covering operating expenses, enabling us to maintain treasury status with our coin. Summarizing each of the 5, let's delve into them each a little bit more detail. Again, the first is vertical integration. Again, the concept of owning the whole process, owning it from production all the way, energy production, all the way through the cryptocurrency production. By doing so, Creek Road is going to do its best to maintain control of its continuity, profitability, while decreasing potential regulatory risk that we see coming through into the industry. Let's focus on continuity first. The concept, again, of continuity is making sure that your miners are running, full stop. It's the first and foremost component of continuity, is making sure you actually have the energy. In studying the crypto marketplace, we identified many scenarios where larger companies went out, acquired switching stations, which means that they acquired the physical location where the energy was to be received, but did not own the energy, spent tens of millions of dollars, built out infrastructure next to said switching station, set up mining operations, and began mining. But then one day, the energy stopped showing up. What wound up happening is they had to move locations, spend another tens of millions of dollars to build new infrastructure, and off they went mining again. But because they did not own the energy, they fell subject to that. The second component is making sure that we have a constant flow of energy. Okay? I think that most cryptocurrency companies that we've been able to identify in some way or fashion either provide and or take energy from the electrical grid. And then we believe that it is subjecting themselves to potential continuity issues. I'm sure we're all very familiar with the roaming blackouts in California. And in fact, there's a lot of discussion in the media about the energy shortages in other states, and roaming blackouts will start in other states as well. By owning our energy, Creek Road is going to do its best to maintain its continuity and isolating itself from these issues. What I mean by that is right now, as we are on this conference, we are currently taking natural gas from a wellhead and sending it directly to our mining operations without touching any infrastructure. Literally, we could get on a plane and go visit our facilities, and you can stand on a 6 by 6 foot graded platform with a wellhead coming out of the center of it, looking down into the waters of the bayous of Louisiana. And you can stand next to this wellhead, and you can hear the natural gas come out of the ground. You can hear the pings of the oil hitting the flow lines. Okay? Again, this oil and natural gas hasn't seen the light of day in over 350 million years. And as you peer over your left shoulder, you can see our aggregation facilities where this natural gas is running directly into our turbine. Don't touch infrastructure, don't touch anything else but the systems that we have in place. Again, this vertical integration ensures continuity by the fact that we own this energy and directing it to where we want. And by the way, we also don't have to worry about a stressed infrastructure that is potentially leading to regulations. Again, that's something we'll talk about more in a minute. The second part of this vertical integration is profitability. And there are two components to profitability. And first is the simplest, in that by vertically integrating, you eliminate a lot of the middlemen. For example, when you buy miners as we do directly from the OEM, you don't have middlemen. When you produce your own energy, there is no need for the energy producer themselves to make a profit. All this added capital goes directly to our bottom line. It streamlines our process, and this obviously has a direct impact on our income and cash flow statement. Okay? Again, we are doing this now. But there's another component of profitability, and I call this the disconnect. It does feed into regulations as well, which we'll touch on in a minute, but the disconnect is actually quite simple. As we are doing today, we are taking energy, 1 MCF of natural gas, let's say, that we could potentially sell into a pipeline for a hen hub of roughly $4. By redirecting that 1 MCF and running it directly into our operations, we are generating roughly $30 of crypto on that same MCF. Let me say that again. Instead of selling something for $4, we are running it to our turbine and generating over $30 of crypto. It is over 7 times return, literally by changing 4 bolts and redirecting the energy from the pipeline to our turbines. So where this benefits Creek Road and our endeavors to physically own the assets, right, this also helps us from a valuation perspective. And let's look at that, again, by vertically integrating. And let me give some leeway here. Let's talk about an example where there's a facility that has 10,000 MCF of natural gas production a day. An institution that has 10,000 MCF and sells it into the pipeline for $4 an MCF generates roughly $40,000 a day, $1.2 million of monthly revenue, or roughly $15 million a year of revenue. But by taking that natural gas and running it into our turbine and generating $30 per MCF, we're not generating $40,000 a day. We're generating $300,000 a day of crypto, $9 million a month, or roughly $111 million of annual revenue. Now, there's a big VIG in there, and please, all disclaimers, and that's making the assumption you're utilizing 100% of the natural gas, but there's a big difference between 15 million and 112 million. You can be wrong by 50%, 75%, even 80%, and this concept of this vertical integration of us owning energy makes sense. We are looking to find these natural gas assets, acquire them at this oil and gas valuation, rolling them into our entity, and taking advantage of that valuation. However, this also then leads us to the regulatory environment. Right? I do think that cryptocurrency companies do not want a press release, nor do the municipalities, nor do the energy companies would like a press release stating that given the roaming blackouts, local hospitals, local schools shut down because of a roaming blackout, juxtaposed to the cryptocurrency mining operation having its energy and operation. I don't think they want to deal with that. We avoid that by owning our energy. The second issue with regards to regulatory is a little bit more in depth and more involved. I think simple economics states to us that if you can buy something for $4 and turn it into $30 of revenue, one of two things has to happen. The price of the raw materials is too cheap, or the finished good product is too expensive. Well, you have very little control over that $30 of that cryptocurrency, which theoretically means that the price of the energy itself has to come up in value. If price of energy comes up, that would be devastating for society. I mean, we're talking 2, 3 potentially multiples on the price of the energy, which means in some way, fashion, or form, there should be some regulation coming in with regards to either subsidies or the quantity of energy that comes out of the grid that is touching this energy and impacting cryptocurrency mining operations. By us owning our energy and by us vertically integrating, taking energy out of the grid, not touching this regulated infrastructure, we have done our best to maintain continuity, and will do our best to maintain continuity, impact ourselves from a profitability, and to do our best to avoid regulatory risk. Again, our energy doesn't touch infrastructure. So the vertical integration play is key from that perspective. And in fact, it is our largest component of our cornerstone strategy. I touched on other aspects of our cornerstone strategy. The second is energy diversification. As I mentioned earlier, we would rather have multiple wellheads, 10, 20, 30, 50, 100 wellheads, providing energy to one facility, as opposed to having one large piece of machinery, whether it's a turbine, whatever it is, providing energy to one of our facilities. Why? If the hydro plant goes down, all of the energy is gone. However, if we have 400 or 500 wells providing energy, if one of them goes down, it's okay. You have continuity. You're still okay with your production. The third cornerstone is geographic distribution, where it might be a little bit more expensive. The margins associated with cryptocurrency mining are very high. But as a means of maintaining continuity, again, we'd rather have 10 different facilities, each with 10, 20, 30 megawatts of power, as opposed to one 300 megawatt facility. Again, because if the 300 megawatt facility goes down, there's an issue. Cryptocurrency diversification. Another cornerstone. As I mentioned earlier, we think that we are in the embryonic stages of the industry. I almost equate it to a baseball game in that the national anthem has been sung and the players are running out of the dugout. Bitcoin and Ethereum are the staples today. And as we lean over the bow of the ship and watching the topography change in this cryptocurrency mining universe, you need to be flexible. You need to understand which coins in the future are going to be maybe join the Bitcoin or join the Ethereum, but you need to be flexible to be able to maintain production of your staple coins, but also move in and out of cryptocurrencies that might be in favor for a day, a week, a month. It is essential to have cryptocurrency diversification. And the last cornerstone is revenue diversification. We feel that by owning oil and gas assets in conjunction with our cryptocurrency mining operation, we can utilize the revenues that we generate from the other commodities to cover all of the operating expenses associated with our cryptocurrency mining operations, enabling us to maintain treasury status with all of our coin. Simply put, what we're saying is we'd like to drive revenue from other streams, other commodities. So every single cryptocurrency that we do mine, we have full flexibility to do with it what it is that we would like to do. Whether it's hedge it, sell it, we want to make sure and maintain our flexibility with it. Those are the 5 cornerstones that we are building Creek Road on and striving to meet our objective. Everyone talks about ESG as well, and we're doing our best to be ESG compliant. I mean, as we are in our embryonic stage of an entity, we are using natural gas and we're collating our facilities as a means of not having massive distances between any of the transportation. That's what we are initially doing. We are looking for phase 2, stranded gas opportunities, and of course, we're going to move into renewable energies, leading potentially to a phase 3, carbon capture. In fact, we are looking at hydrogen production facilities. And in fact, I had a very interesting conversation with an embryonic stage nuclear company. So again, in looking at ESG, we also firmly believe that with ESG, look, we would love there to be a totally green environment today, but it's going to take time. And as long as we all have moderation, we feel that we'll be focused on it. It is at the forefront of what we're doing in relation to us implementing our cornerstone strategy. So in summary, Creek Road Miners' objectives, differentiating objective, is to utilize our own energy, mine for crypto, build a diversified portfolio by implementing it through our 5 cornerstone strategy, vertically integrating, diversification of energy, locations, cryptocurrencies, and dual revenue streams. Which begs the question, this is our objective, but the question is where are we today? And what have we accomplished so far? This is an embryonic stage company. We are 6 months old, but we've accomplished a tremendous amount. And what I mean by that is that if you look along the flow line and timeline of what we've accomplished, we have not only developed the strategy and the objectives, we have not only acquired miners directly from the OEM and actually had them delivered. We've acquired the facilities to operate them. We've acquired our energy source. We've acquired our turbine. And as we sit here today on the phone, we have our proof of concept facility operating, sitting on a floating barge in the bayous of Louisiana. It's a very, very interesting operation at this point. It took us 22 hours from start to finish to install a 1 megawatt facility. And literally, as we are on the call here today, we can unscrew 4 bolts, remove a 4-inch flex line, and we have a mobile unit, whether it be on land or on water. And as we have publicly announced, we have ordered additional containers. We have ordered additional miners. And what Creek Road Miners needs now is just time to continue to grow and to deliver on its 5 cornerstone strategies and move forward. We can talk a little bit about the economics. I'm sure this is a slide that most people have seen, basically talking about the revenue, of course, with mining for Bitcoin, our cost of natural gas, turbines, operating expenses, gives you your profit and loss. Here's an example of one of our most recent operations that we installed. We acquired 270 miners, acquired a container, roughly $2.5 million of CapEx expenditures. And this is how we're operating today. We have a 75% gross margin at a $50,000 Bitcoin price. Our energy costs, which is just the cost of the natural gas, as well as it's natural gas, we're running at about sub 3.5 cents per kilowatt hour. And our cost to mine a coin is roughly $5,200. You'll notice, though, I state that this is without full strategy implementation. Because again, when I talked about vertically integrating, if we were to own, and when we will own, a natural gas and oil producing company, the profits associated with mining for for drilling for oil and natural gas go directly to our bottom line, which theoretically will reduce our energy costs anywhere from 20 to 60%. And we firmly believe that over time and by full implementation of the strategy, we can get our energy costs and our cost to mine much cheaper, at least 50% less than what it currently is today. So again, as we sit here today, we have a very interesting differentiating objective. We're currently operating Bitcoin mining operations. We are expanding our footprint. We are expanding our geographic locations, and we are looking forward to continued growth with both additional facilities as well as implementing on all of our 5 cornerstone strategies and achieving our ultimate objective of owning the energy all the way up to owning the cryptocurrency mining operations. So saying that, I'm not sure how much time I have left, but I'll
actually we're at time, Scott. You went right up to the clock. So we appreciate the insight, Scott Kaufman, as it says there, CEO of Creek Road Miners. Scott, thanks a lot for all the information, a lot to think about here, and thanks for coming on the Benzinga Small Cap Conference today. Have a good one.
Thank you so much.
All right, speaking of crypto, just real fast, before I bring on our next guest, I just want to do a quick look, if I can, at what's happening today in the crypto market. I can't make up its mind. We got some green, we got some red. Actually, the same thing applies to stocks today. We got a little bit of green, a little bit of red. No one's quite sure what to make of anything, but that's where we stand for the day. If you want some free Bitcoin, all you got to do is download that Voyager app, enter the offer code ZING, Z-I-N-G. Fund your account with $100, make your first trade, and they'll give you $50 in Bitcoin for free. All right, let's bring on our next guest, Jeff Ervin. He's the CEO and chairman, and there he is, and the co-founder of IMAC Holdings. Jeff, how are we doing today?
Doing real well, Spencer. Appreciate you having me.
Appreciate you coming on. I believe we have your slides. Yes, we do. There they are. All right, sir. Tell us about IMAC. Tell us what's in the pipeline.
Yeah, so Spencer, a little change of pace from your previous guest, although I will warn people that I went to IKEA and bought the last yellow chair. We can catch up on that in the Q&A session.
I hope there's more.
I don't know. I got the last one on the shelf. So,
all right.
And then made it back in time for this presentation. So
nice.
Appreciate you having me, and I'll walk through IMAC Holdings then for
awesome.
our guest today. So thank you for watching this Benzinga presentation. Today's December 8th. For historical purposes, 2021. IMAC Holdings is a company that I founded in 2015, and we went public in February of 2019. So we've been public for nearly 3 years now. And I think that we've gone through some ups and downs, and where we are today then as a holding company is we're broken into 3 different divisions. Our core business is the outpatient medical clinics, of which we founded the premise of our business. We also have a research division with a clinical trial underway, and then a recent launch of retail chiropractic centers under the name The Backspace. So today, as a NASDAQ listed company, actually I'll reference the September 30th filing numbers, where we had $11.2 million in cash and $3 million of AP, notes payable, and accrued expenses. And that was with just over 25 million shares outstanding and a $1.32 share price. As of November 15th. Today, we're right around that number as well. So why don't we dive into some of the breakdown here of IMAC Holdings. IMAC Holdings, again, has a core business of catering to movement restriction disease states. We ultimately were founded on this premise, and the holding company was established in order to grow this original IMAC clinic from its Western Kentucky roots and multiply that and replicate that model in contiguous markets. And upon growing this, we found that the demand far outpaced what we anticipated, which allowed us to pursue that public offering nearly 3 years ago. So today we have 18 outpatient medical clinics that are driven by medical doctors and nurse practitioners. Those medical doctors and nurse practitioners make up 65% of our revenue today. They work side by side with physical therapists under one roof, and that's a real benefit to the patient experience. So these patients that are ultimately faced with a knee replacement or a hip replacement or a spinal fusion can come to an IMAC facility and receive minimally invasive procedures, in most cases non-invasive, to stave off these prospective surgeries that they faced. So we're more of a prehab center than a rehab center, not a post-surgery center, although we do take patients post-surgery. We're really focused on preventing that surgery from happening in the first place. There's a real gray area for individuals that are faced with these decisions. And ultimately, it is up to the consumer to decide whether they want to go through that surgical intervention or not. If they choose not to, we can treat them in our facility where the medical doctors and the physical therapists work hand in hand on their patient care to drive that optimal function out of whatever joint or pain that they're experiencing challenges with. So while we treat a number of people in pain, we have never prescribed an opioid in our history. It's not within our DNA. So we try to go a non-opioid route to cater to that pain and treat the underlying cause of that pain in the first place. On our staff, we have 19 medical professionals, 19 physical therapists, and 15 chiropractors. Again, our chiropractors play a minor role in the revenue side of it, but a major role in the function of that patient's navigation through the course of care, which could be 15 to 20 visits. If you think that it takes a lifetime to tear a meniscus or really wear down your joint, it can't just be fixed with one shot or one visit. And receiving that course of care over 15 to 20 visits is the best way to strengthen that joint and stabilize it for that optimal function. Our locations are spread as far north as Chicago and as far south as Bonita Springs, Florida, and everywhere in between. We really do like we like that contiguous geography, so we're sticking in that Midwest and Southeastern realm of the United States for our recent and current growth strategy. When you look at our growth strategy here, in the 12 months from November 1st to October 31st of 2020 to 21, respectively, we made 6 acquisitions. Our target acquisitions are under 2 times multiple of cash flow. And we actually calculate that based on replacement staff that would need to be hired within that facility. We like to take on, in most cases, chiropractic facilities that ultimately allow us to trade at these multiples where full service medical facilities tend to grab a little higher multiple. Targeting that chiropractic facility is one that we like, ultimately because it's the stable patient base, a routine patient base that continues to come back to that facility, and one that we think execution risk is limited on an ongoing basis to retain that patient. All the while introducing the medical services that really drive the revenue in our business and adding that staff to that mix, delivering a service to patients that typically have not seen that type of service before, that where they've been used to receiving a routine chiropractic visit. They haven't been exposed to the medical integration that we offer under that same stop shop. So these smaller acquisitions of chiropractic clinics are going pretty well. And I understand that my slides have stopped. I'm going to try to reset this screen sharing. Try it one more time here. Sorry for the pause. And we'll get right back to it. If this doesn't work, I'll just continue to talk through it. But ultimately, targeting these smaller acquisitions do take a little more time to get them up and running to a full service IMAC. There's space modifications, there's staffing modifications that will take a little more time, and that's what comes with that cheaper price point. And so we've been able to do that with really 4 of our last 6 acquisitions. 2 of those last 6 were ultimately in a larger full service spectrum. Our most recent acquisition in Baton Rouge, Louisiana, for example, is a full service medical facility, and we're really excited about what potential that could bring to our growing network of IMAC clinics. So we're very excited about that. Again, when you look at the growing dynamic of aging baby boomers, ultimately there's really no end in sight to in the next 8 to 10 years to the demand that we see on that side of the business. Now, to complement that side of the business, we've actually seen a number of people with neurodeficit disorders. So it's not just orthopedic issues that we're dealing with. It's those neurodeficit disorders like Parkinson's or MS, other autoimmune conditions that may restrict someone's ability to move. And through that, in 2017, we took on the initiative to identify an opportunity to treat Parkinson's patients that we were already seeing in our clinic. We were having great success treating these individuals, but ultimately saw a limitation to whatever success they could see or expect through that course of care. And that's when we took on the initiative to launch an investigator-initiated trial, a clinical trial under the FDA, for which we've been approved with our medical doctors to serve as investigators for that trial. We did so after acquiring a regenerative technology from a major research institution and ultimately own the rights to bradykinesia due to Parkinson's disease using the mesenchymal stem cells derived from Wharton's jelly as the product. And so we are now nearly complete with our second cohort, which is the second 5 patients within a 15-patient phase 1 clinical trial. This is a study now that started in December of last year, and we're excited about the progress that we've seen here. It's not a huge cash drain, respectively speaking, to the business, primarily because of the doctors that we already employ being those investigators, and the fact that we have access to patients that may qualify for the study that are already coming within are in our clinics or aware of IMAC as a brand within their community. So we're excited about the potential here, and have ultimately done the math to identify where the quantitative risk lie in this study. So stay tuned on this. We're real excited about the progress here, and it fits right into a nice complement of our business. The newest complement to our core business is a project that we launched with Walmart. We're under a 10-store test pilot right now. This pilot program with 10 stores at Walmart started in June. We launched our first store actually in late May with a grand opening event June 5th. And we have since opened several more stores as part of that test pilot. We raised some capital in March and set aside $4 million from that offering to launch the Backspace concept. And the Backspace concept is simple. It's a walk-in chiropractic clinic that's accessible currently in the front of Walmart stores and these 10 stores that we're launching. So it's a walk-in or appointment-based, cash-based spinal health and wellness concept. So you can walk in and on demand received a manual chiropractic adjustment from a licensed medical professional in that facility. The other 2 services that we offer are percussion therapy or a muscle stimulation device that's conducted right there on site. And each service is $25. So it's very simple, cash or credit card coming in, no insurance. If you have insurance, where we find the complement to this in the core business is that if you wish to use your insurance or have a medical condition that requires more attention from a medical physician, then you can be referred to the local IMAC near you. In this test market, for example, we have 4 stores in Middle Tennessee to complement our Brentwood IMAC facility. We have 1 store that is near the largest chiropractic university in the country in Logan, that is in Chesterfield, which is just 5 miles from our anchor facility, the Ozzie Smith Center there in St. Louis. And then the other 5 centers that we have opening as part of this pilot are in Central Florida, near facilities that we've recently acquired in that Florida market. So it's a very simple concept. Those of you familiar with this space will recognize the Joint as a clear and front leader with over 600 locations. And if you're familiar with the Joint, they continue to say that there's more growth ahead for them. And we agree that there's more growth in this marketplace due to similar lack of awareness for the industry and lack of accessibility to consistent care within the chiropractic industry. So we think that there's room for both of us to compete in this space, given the positioning of our product within the Walmart, and have also seen great demand for our service, even in our early struggles in launching this pilot. The struggles are very manageable and expected. You're never going to launch a business or a concept without any headwinds. And we've certainly faced some of those. We've learned those now and think that this has a great potential to grow beyond this 10-store pilot. So that's the backspace. And again, that's the third prong of this business in no certain order, but that's where most of the interest is coming inbound to IMAC at this time. And in summary, what you'll see is that our recent growth is targeting clinics at COVID impacted valuations, which we've proven to do over the last 12 months with our 6 acquisitions. And we think those acquisitions will ultimately begin performing in a larger manner and have a greater impact on 2022 revenue and beyond. The strategic initiative with our proprietary neurological research has the potential to create partnership opportunities, either through a partial or full divestiture at some point, where we think we'll be able to monetize the potential of the product and springboard that into hands of development companies that know what to do with it. And ultimately, we think that we're positioned to leverage a large and growing market. When you look at the aging population and the need that they have for orthopedic and movement restriction diseases that they face, we think there's a gray area right now, and not every surgery is needed. So we're out there to try to create an alternative for that. And ultimately consolidating through fragmented chiropractic industry, not only clinics that we can acquire into IMAC facilities over time, but ultimately address that fragmentation by launching this backspace product and service with our Walmart partnership. So I'll leave it with that and appreciate your attendance and open the floor to any questions at this time.
Thank you, Jeff. Any questions for Jeff or for IMAC, drop them in the chat now. Speak now or forever hold your peace. No, in all seriousness, Jeff, tell the people, if they think of a question in 10 minutes, for example, how they can contact you.
Yeah, absolutely. You can reach out to jeff@imacholdings.com. Feel free to send me an email. I'll do my best to respond in a timely manner. You can always check us out online at imacregeneration.com. Our investor profile is at imacholdings.com. And back.co is a great platform that we're building around the Backspace brand. So feel free to visit back.co as well.
Boom. All right. Thank you, Jeff. Again, CEO, chairman, and co-founder. A lot of titles there of IMAC Holdings. Thanks for coming on the Benzinga Small-Cap Conference today.
Good to see you again, Spencer. Thank you.
All right. All right. We got a couple of minutes before our next speaker, if I want to keep the train running on time, which I do. So what I'm going to do real fast before I bring Everett Knight from the Valens company on the show is, as promised, I said I was going to do this throughout the day. I'm going to bring up the giveaway, the Slidell poll. Jesus, my mind just blanked out there. The Slidell poll on the screen. If you haven't seen this yet, all you have to do is scan the QR code that is on the screen right now, answer a question, and at like 5 o'clock Eastern today, we're going to hold a drawing, and we will give away one year subscription of Benzinga Pro for free. If you don't win today, that's okay, because guess what? We're doing it again tomorrow. I didn't even mention that. This is day 1 of 2. We have a whole nother day tomorrow of different companies presenting on what will be the final day of the final conference of the year for Benzinga. So that'll be fun. Brent Slava, the head of our news desk, will be your host for that tomorrow. Looking forward to Brent, as always. He is the man. All right, let's do this. Let's bring on our next guest. I see him backstage. Everett Knight, he's the EVP of Corporate Development at the Valens Company. And let's get Everett on the street. There he is. Hey, what's up?
Hey, Spencer. How's it going?
Doing fantastic. How you doing today? How's your week?
Hey, doing really good. Thanks for having me on today.
Excellent, excellent. I see your slides, guys. Let's get Everett's slides up. And look, I speak and it happens. So, Everett, take us away. The Valens Company. I'm familiar. The people may not be. Tell us about it.
Sure. So, Everett Knight, Executive Vice President of Corporate Development and Capital Markets for the Valens Company. Anyway, appreciate you guys having on me. The Valens Company, we're the largest product creation and manufacturing company in the cannabis space in Canada. And Spencer, maybe to start off, what I'll do is I'll kind of talk briefly about the cannabis space overall. I'll do this a little differently today, and then I'll tell you more about what we do. But there will be forward-looking statements throughout this presentation, so note that. But I'm going to be jumping around. This is a deck on our site that you can check out. But the reason I got into cannabis, my background is in fund management. I ended up launching the first long-only institutional cannabis mandate 8 years ago, and kind of grew up with the space. And I've got to over 200 plus facilities. And the reason, as an investor, I believed in this space was because I haven't seen a space where you have a defined black market already, right? And all we're doing is legalizing that with a double-digit growth rate over time. And you've seen that Canada has now legalized it. You see what the US states have done. And now you're seeing other places around the world like Germany, Mexico, Switzerland, Luxembourg. I think this is just the second inning of the cannabis market overall. And I wanted to put in perspective, for the viewers today on where I see this going, right? And I think that if you look at the cannabis market, it has the potential to be a top 4 CPG industry. And if you take the US market today, which I think where most of our listeners are, it's a $17 billion legal market in the US today, and it's a $65 billion estimated black market. If you just add those two together with no growth from that, you get an $82 billion industry in the US, which would be 4th overall, right in between tobacco and coffee. Right. So I think, again, this puts it in perspective over the long term. I think we have short-term volatility right now as everyone's trying to trade around US legislation with the SAFE Act. I think the long-term fundamentals remain intact. And that's what we're focused on as the Valens Company. So who are we today? Our mission is to bring the benefits of cannabis to the world. And we're doing that through next generation innovative products that you can see on the left and you can see below for some of our brands. Now, skipping ahead, for where we are today is we're focused on narrowing the gap between our competitors. In Canada, we have driven the most amount of revenue per dollar invested than any other of our peers. And we have a high focus on revenue generation and long-term profitability for our shareholders. And I think this chart on the right really shows that and the discipline we've had. And today, what we're trying to do is close the gap and narrow that gap. I don't think we've done a good enough job there. And I think one is drive market share gains and revenue growth. I think you're seeing us take a lot of market share with some of these innovative products that I'll get into later on. And then obviously we've increased our total addressable market, which I'll also touch on. And probably the biggest one on this list for time's sake is NASDAQ. We've said we're going to be on NASDAQ in December, and I'd look out for that here shortly. So with that, kind of on the next slide, where do we operate in the cannabis market? In Canada, we operate what I believe is in the 2 best segments in the marketplace. We operate in 2.0 products and premium cannabis. And what do I mean by 2.0 products? I mean extract-based products. Think about oil-based products. If you look at the Canadian marketplace, we started only with 10% extract-based products back in 2019. It's now 30% of the market. It's the fastest growing area, as you can see. And when we look at more sophisticated, mature US states like California, Colorado, and other markets around the US, it's usually a 50-50 split between extract-based products and overall dried cannabis. Now, where we think that's going long term is we believe that 75% of the market will be extract-based products. And the reason we believe that at Valens is, one, I've never met a doctor that wants you to smoke cannabis. They want you to consume it in different ways. And two, when you look at Thanksgiving, for example, and are you going to roll a joint at the dinner table with your family and light it? No, you're gonna take a cannabis-infused beverage and cheers someone. Right? You're going to take edibles and pass them around, or conveniently take a vape out of your pocket and sip on it. And that's really the basis of our company. And we're really positioned for the future in that growth in the Canadian market with the most sophisticated manufacturing base in that marketplace. And then the second area we focus on is premium cannabis. Now in Canada, if you've been following it, It's very difficult to brand because of the consumer package regulations. But what has a brand today is genetics and high quality cannabis. We acquired a company called Citizen Stash, and they're one of the leaders and have a cult following from consumers in this area. And if you look at this chart, this is the other highest growth engine of the cannabis space today in Canada. If you look at it, 14% of the market is premium cannabis today. In California, it's 31%. And if you look at it, those two segments, we believe these are the two highest growth segments in the Canadian marketplace, where you have an oversupply of dried cannabis on the low quality end, where we do not play. We believe we've actually pivoted to the two best areas. And if you were going to create a cannabis company in the Canadian market and believe in these two areas of growth, there's no better company for an investment opportunity than us. I'm going to skip some of the Canadian market opportunities here just to kind of show you. I think you guys all know the growth of the marketplace and the overall addressable market. But maybe quickly, just to show our business model, we have both our own branded B2C side of the business, which is on the right-hand side, as well as we do a B2B side of the business where we're helping customers and other LPs in Canada actually manufacture their goods. We have a sophisticated manufacturing base where a lot of even the big players can't make a lot of the products we're making. So what we're doing is increasing the utilization of our facilities and helping up. We started in this industry to be an ally for both customers and consumers, and we have a lot of innovations to go around for both. The reason this is unique is really because the Canadian marketplace and how it played out. I think it's a competitive advantage for us. And what we're doing is we're following in the footsteps of some of the giants, right? And this B2B and B2C business model, it's been done by Constellation, Pfizer, Jameson, Maple Leaf, etc. I always like to use the analogies of, as you look at Jameson Wellness, you see some of their products that they make for themselves branded on the left-hand side of the shelf. And on the right-hand side, you see the products that they make for their competitors. And that's just like us in the Canadian marketplace today. These are some of our formats. If you're in Canada, I encourage you to try them. We've been a lot of firsts. We were one of the first one with a 1 gram vape in the marketplace. We were, one of the first with live resin pens, which I think is the future of the vape pen market. And we were first with a lot of the edibles market, whether it's chocolate covered gummies, baked goods, or even THC beverages in the Canadian marketplace. So we have a lot of first and innovation that you can see on the slide. This is a unique slide that I wanted to go over before we get into questions. If you look at this, we really have what we view as the highest value add part. And I don't know if you guys can still hear me here. I just got anyway. I don't know what happened. There was a little bit of a glitch, but if you look at this slide, Valens in the value chain.
Yeah,
Spencer,
Everett, you're all good. Just so you know, you're all good.
Okay, perfect.
Yeah.
I was just gonna keep going for
Yep.
Sorry about that. But if you look at the value chain here, we view ourselves as operating in the highest part of the value chain. Where you actually get the best kind of return for your customers. If you look at cultivation in Canada, we still have double the amount of cultivation than demand for canopy. And then we have outdoor coming online. We overbuilt it in Canada. We're buying biomass today in Canada for lower cost than a lot of these producers can grow it for, which is a good input kind of generator for margin for us. We extract that, purify it, formulate it, and then put some of that innovation around that product set into our branded products, and then actually distribute those into the provincial governments today. We've really been in a launch, grow, optimize mode. For those of you that know us early on, we were B2B primarily, and what we were doing is more on the extraction side. Manufacturing was always a part of this business plan, and what we've done is accelerated that growth. We really transitioned to that manufacturing side, and what you've seen us do in the last year in 2021 is really increase our B2C part of our business, our branded products ourselves, to have more control on the consistency. What we found in the Canadian marketplace was that a lot of our customers, we wanted to be ally, and they're great companies. However, some of them, small and mid-tier guys, could not meet the consistent targets that they were going to meet. So to help with the consistency of our platform, we launched our own brand, and we think it's in the best ROI of our shareholders to actually go down that road. So we've been in a launch mode for the last kind of 6 to 9 months of launching products, and we've been launching products into a global supply chain pandemic. So what we've been doing is really having to pay shipping costs and air freight of 200-300% to get packaging in. We haven't got a lot of the automation equipment in. But what you really see in that as an investor coming into the name, you're going to see that benefit in 2022 as the 6-month wait times in some of these automated equipment, or a lot of the kind of the margin profiles that we're paying for air freight will slowly go away. And it's a great exercise for us to really make sure that we can find different distribution channels and different suppliers to make sure that goes away. And again, in the growth stage, which we're entering in 2022, I think you see a lot of the benefits on the margin. This is just to show you where we've been. I think this is anyone that wants to invest in us. We were the largest kind of extraction company. If you look at 72% of our revenue came from toll processing and co-packing in 2019, showing the extraction. We accelerated our push to manufacturing in 2020. Our manufacturing facility was going to come online in Q4. And what we did is during COVID, a lot of our customers went bankrupt and had problems meeting demand for the extraction side. So what we did is pivoted a little quicker. I think it was one of the most successful pivots in the Canadian marketplace. And then if you look at 2021, this is really a story of us increasing, the consistency, and we have all this innovation. Why don't we launch our own brand? But you're seeing the differentiation now between our B2C side, which is now almost 50% of our overall revenue. I think you see that continue to grow. We acquired a company called Citizen Stash subsequent to the quarter. And what you see there is my expectation for this next year is to be around 75% B2C, our own product brands. So I'm going to touch on some of our IP, and then what I'll do is I'll kind of I'll try to conclude here quicker, and then I'll leave it for some questions. IP is very important to the marketplace, and if you're a new consumer, we've invested a lot of money in this. I've looked at over 120 different emulsion technologies. Sourced by Valens, emulsion is by far the best, especially if you rate them on these 6 criteria, which we do. So if you look at oil today, cannabis oil floats to the top of water. Any oil does. This emulsion technology makes it completely water compatible. The difference of this versus others is that it's consistent with every sip. So the first sip is the exact same dose as the last sip. And we have shelf stability studies that have actually been over 2 years that actually show that. So you can take it home, put it in the shelf, and it'll still be good later. And we can really customize the smell and taste. The problem with cannabis infused beverages today is that it tastes horrible. Right? You see that cannabis taste. We can really mask that taste profile. And that's why we have 9% beverage market share today and growing in the Canadian marketplace. Now, onset and offset. Now, onset in the marketplace, if you and I had a cannabis infused beverage on this call, we'd have to wait for 30 minutes to 2 hours to feel the high of that one beverage. And that one beverage would last for, call it 4 to 8 hours. Right? So a long period of time. This emulsion technology speeds that onset up to 5 to 15 minutes. You feel it right away, and it starts to go away in kind of 45 minutes to 2 hours. And what does that remind you of? It reminds you of beer, and beer is sold in 6-packs for a reason. It's because it's social. It's sessionable, and this is really bridging the gap for cannabis. This is a small part of the market today, but look for it to grow in the future. We also have one of the largest U.S. CBD companies today called Green Roads. This is a company that has over 30,000 5-star reviews and obviously some of the highest ratings on trust of the product. The unique thing about the CBD industry, I think it's one of the best industries longer term for health and wellness across the world. And this company, what it has is a trust that is higher than anyone else. And
I think we just lost Everett there, which is a shame because he was about to wrap up. Let's see if we can get him back. In the meantime, loving the chat. Everett, yep, we got you. You're back.
I don't know. It just paused for me, Spencer. My apologies, but
I don't know, man. Glitch to the matrix, but we got you back.
All right. Well, good. Well, I'll kind of, I'll finish this next few slides, Spencer, and I'll switch over to questions here. But I would say that if you look at this Green Roads brand in general, you can actually scan the QR code, and you can get the certificate of analysis from the actual product that shows you the actual test results of where it came from, that they're verified. The trust with this brand is really what makes it go to the next level. And this is a company that I think you should keep an eye on in the marketplace that is just in the beginning innings, but already a top 10 brand in that market.
Awesome.
I'll just touch on one more of our parts.
Go ahead.
Stashes are kind of our overall premium cannabis brand. If you look at this brand today, they actually use a craft growing part of the market where they're really a genetics company. And what they do is much like other CPG companies do. And I think this is the future of growing cannabis, where if you look at Driscoll, and you've had Driscoll raspberries and strawberries, what Driscoll does is actually they have the genetics, and they supply it to all the farmers. The farmers grow the actual strawberries and raspberries, and they come in and pick the best products. So it's a quality specific. They say, oh, you have a good crop. We're only going to take 30% here, 70% of this one. And what it does is maintain that quality of cannabis. This is much like California market today. Citizen Sash is 6 to 10 contract growers that does the same thing. They have a cult following. Again, the #1 selling brand above $12 per gram in Canadian market. And this is an acquisition we closed just a few months ago, but something to keep an eye on. I think there's plenty of synergies there from this acquisition. Obviously want to take that premium brand that they have in dried cannabis and pre-rolls, and we're going to take it into vapes and concentrates. So maybe with that, maybe with time, I'll just touch on kind of the Canadian recreational market. We're the fastest growing company when it comes to provincial listings. That with the government, without provincial listings, you can't get actual sales revenue. So what this does is basically, I think it's a 6-month forward indicator of kind of getting products to the shelves. And for us, we've been the fastest grower in that because of some of the innovation that we have. And you're seeing those products take off and continue to take off. And that's what we're focused on, is bringing innovative products really to the consumer and focus on them and what they want. So with this, I'll finish off in this slide and open up for questions. But if you look at us today, we traded a significant discount to our cannabis peer group. What you see is you see us turn around the business in Q3 2020 to Q3 2021 on the right-hand side. And what it has is it has more incremental revenue growth. I think as we take a step forward and get all 3 cylinders of our business firing on all aspects and around this turnaround, which I think we're in a pivotal point to do, I think you see an acceleration of that revenue growth, and you see that in the analyst numbers below on what they're forecasting for implied revenue growth. So, we're currently trading at 1.5 times analyst revenue next year. They're forecasting us to grow over 100% of that revenue going into the year, which is not only higher than our peer group, but trades at a significant discount. And with this NASDAQ listing, what we're focused on is really kind of narrowing that gap, which we should see a listing here in December, as well as kind of focusing on the business. I think market share growth will determine it all, and the innovation on the product. And during the volatility in this marketplace, that's where our head is. Their head is down, working on the business, and I think you're going to be excited for some of the products coming out in the new year. So with that, Spencer, maybe I'll open up for some questions.
All right, Everett, thanks a lot. I don't see any. There was one that's been bugging me really since you brought it up. Is on the beverage side, what is the most difficult thing? Is it the taste profile, or is there something else?
It's the taste profile. Like if you look at the IP in the beverage market, we've seen a whole bunch of companies figure out a few of those criteria that I brought up. there, Spencer, and whether it's fast onset, whether it's they can make it compatible. But I'd say the two biggest ones are probably smell and taste, which a lot of the Canadian beverages, if you taste them in the market, taste like cannabis. I think that can't happen long term, especially as you look at these CPG companies, as well as offset, right? So offset of a beverage as well. Like, you don't want to be high, you want to be able to drive home, you want to be able to plan your day, you want that sessionability and have multiple. So I'd say smell and taste as well as offset are probably the most important too. And that's I would say the biggest differentiator with Sourced by Valens technology. And I think it's we haven't been able to make a lot of the POs on the beverage side, and we already have 9% market share out of our small facility. We have our bigger facility that just came online, and I think you're going to see growth in that number because of that.
All right. Everett Knight, EVP of Corporate Development and Capital Markets at the Valens Company. Everett, thanks a lot, man.
Thanks for having me, Spencer. Appreciate it.
All right. And Jamie in the chat, the Valens Company trades on the OTC markets, so it may not be available on your platform, and also does not have options on it. So there's that. Okay, let's bring on our next speaker. I see him lurking backstage. There he is, Timothy Carroll, the CEO of Entheon Biomedical, ticker ENTBF here in the U.S. Timothy, how are we doing today?
Absolutely fantastic. Pleasure to be here.
Fantastic. Pleasure to have you on. I see your slides. Let's roll, man. The floor is yours.
Okay, wonderful. So I'm Timothy Carroll. I'm the CEO of Entheon Biomedical. We're developing a new dimension in addiction treatment. Just a bit of disclaimer language there. So yes, we're developing a personalized system of medicine within the emerging psychedelic therapy industry. Our intention here is to increase the safety and precision of psychedelic therapy using DMT and diagnostic tools. So at Entheon, we're powered by an unwavering commitment to significantly improve the odds of beating addiction and improving patient care. And to satisfy that, we have three distinct divisions. Entheon RX is focused on the development of drugs using DMT as the pharmacological benchmark. Entheon ID is focused on the identification, analysis, and predictive use of genetics and EEG biomarkers in selection and management of drug treatments, understanding that over the course of the next 5 or 10 years, a multitude of new drugs will come online. We're interested in pairing the appropriate patient to the appropriate drug. And Entheon IQ is focused on the development of treatment algorithms through the analysis of patient data to better optimize that form of care. So yes, we have a near-term human trial called EBRX 101. It's designed to be, in our estimation, the most rigorous and comprehensive study of DMT to date. We're looking to leverage DMT's unique pharmacokinetics for a flexible therapeutic program and to optimize the dosage and duration of the treatment to suit a variety of patient needs. And we're also developing a personalized medicine platform that uses EEG and genetics to predict mental health risks and characterize metabolic factors that may be related to various drug states. And our intention there is to aid in drug selection and personalization of therapy. And we intend for this to be applicable to not just DMT, but to a variety of psychedelic molecules and indications. We're a bit agnostic in terms of that. We understand that different people will be better suited to different forms of care. We're also investigating new chemical entities. We'll go into that in a bit later. And we're also researching proprietary DMT delivery systems, not just intravenous administration, but alternate forms of administration to better provide care to those that it may better suit. So yeah, the situation that brings us here today is actually really quite dire. We're in the grips of a public health crisis related to addiction, and there is a significant unmet need and a huge addressable market. Approximately 21.2 million Americans have some form of substance use disorder, and yet only 1 in 10 of those people receives any form of care, and we may see why in a minute. And as a society, it costs us anywhere in the range of about $750 billion per year, comprised of healthcare costs, policing, etc. And this year, we passed a very grim milestone. In the US, over 100,000 people died over a 1-year span. And globally, we see approximately 11.8 million people die prematurely as a result of addiction-related issues. And some of the shocking statistics here may boil down to the fact that there aren't really many effective means of treating addiction. We all know that residential treatment, rehab, whatever you call it, is first line of defense and often stays there can cost anywhere from $5,000 to $30,000, and the efficacy is only about 5%. And the lived reality is that individuals may need to go to 2, 3, 4, 5, 6 treatment centers before they even receive any form of relief. And as was the case with my brother, who I lost in March of 2019, he went to 7 different drug treatment centers and to no avail. So yeah, it's quite a shocking reality. 12-step recovery is amazing for those that it works for, but there are certain features of it that make it ineffective. There are religious connotations, and certain parts of the self-discovery process can be shame-based and shame-reinforcing. Medication-assisted therapies like Suboxone and Methadone are effective in getting the person off of the drug, but in reality, it simply replaces one dependency or another, and doesn't really address the root causes. And so we see a high rate of relapse when people stop medication-assisted therapy. And smoking cessation, of course, the options are abundant and cost-effective, but in spite of that accessibility and low cost, efficacy is limited to about 20%. There is a bit of historical evidence pointing to psychedelics being useful in the treatment of addiction. Meta-analysis of LSD used to treat alcoholism showed 58% improvement. Ayahuasca has been shown to reduce the severity of alcoholism. And very recently, one of our advisors, Matthew Johnson, conducted a psilocybin trial treating those that are suffering from smoking or from nicotine addiction. And very surprisingly, 87% of those people that took part in that reported abstinence at 6 months, and still very high, 67 and 60% at 12 and 16-month endpoints. So a lot of the difficulty of treating substance use disorder may boil down to the fact that it is highly complex. Substances are generally used to self-medicate a state that individuals find overly distressing. So that's the waking conditions of life. And that may be informed by trauma, certain behavioral patterns that just upon waking, an individual may find the world intolerable. So the removal of the substance alone does not guarantee any form of abstinence, but rather returns that person to that unmedicated, distressing state. So often we see abstinent and unsupported addicts suffer relapses quite frequently. So yes, the root of addiction is thought to be psychological and emotional in nature, independent of the specific substance of abuse. So the solutions that we create must be targeted at those base psychological and emotional causes. Where serotonergics or psychedelics are have so much potential is that they can actually elicit a change from a state of pathology to a pivotal state change. So addicts often suffer from a pathological state where there's very deeply entrenched thoughts and behaviors, and so strong habituation where the brain doesn't operate in a very critical way, and often people are just responding by default to certain stimulus. Psychedelic therapies can induce a state known as entropy, which is, in general terms, a state of randomness. But in the case of sort of neural connectivity, is a state of interconnectedness, in state of heightened plasticity. And this state of heightened plasticity can move the brain to that state of criticality where new learning, novelty, reordering beliefs can happen. And so on the right, we see a brain, on top right, we see a brain that's representative of the non-psychedelic state, where you can see that the thought patterns are characterized by about, a couple of dozen different default pathways. And on the bottom right, we see that upon the introduction of something like a psychedelic, or specifically a psychedelic, we see a massive explosion in terms of connectivity. And this explosion of connectivity is responsible, in our estimation, for that notion of having new perspectives, new beliefs, where even in response to old stimulus or triggers, a person can, rather than default to their own patterns or their old patterns of thinking, learn how to experience that anew. So the molecule that we've chosen to focus on for development is dimethyltryptamine. DMT elicits the desirable entropic effects of classic psychedelics, but has a very unique pharmacokinetics that make it very promising for clinical use. So just a bit of background about DMT. It belongs to the classic serotonergics along with mescaline, LSD, and psilocybin. All primarily act on the 5-HT2A receptor set. DMT has been used in the form of ayahuasca for hundreds, if not thousands of years by indigenous populations that use that within their holistic medicine systems. It's been pretty extensively scientifically studied. It's present within hundreds of different plant species. And very importantly, it's endogenous to the human body, meaning we're believed to create DMT, which means that we're very adept at metabolizing this. And our ability to metabolize this very rapidly and safely results in DMT being very short acting. And that short acting characteristic is something that we're leveraging in terms of our development. So the DMT molecule, in our estimation, possesses some very significant advantages over classic psychedelics. Ayahuasca, psilocybin, LSD are all capable of eliciting this highly entropic state and being transformational, but they are bound to some limiting factors. The reality is these forms of psychedelics generally have quite a long duration, anywhere from 6 to 8 hours plus, including the trailing effects. And given that the psychedelic treatment paradigm requires a physician or a therapist to oversee the entirety of that experience, it means that from a commercial perspective, it's very difficult to scale. It's a full day engagement, and during that time, as individuals are dealing with some of their base foundational triggers and stimulus, difficult experiences can occur. And with these longer form psychedelics, there's no means of ending a negative adverse event. And so, from the perspective of patient safety or from physician liability, that becomes a very tricky thing. There's also a lack of precise dose control due to the long duration and long half-life of some of these drugs. When ingested orally, there's no means of modifying that dose downward. DMT, on the other hand, delivered intravenously, we can generate short session lengths anywhere from 30 to 60 minutes. And this provides more accessibility and more scalability to physicians and patients. So this enables higher patient throughput. And it also provides us with the ability to end the session quickly if clinically necessary, as they're dealing with typically very difficult subject matter. When an overly distressing scenario occurs, we can simply stop the flow of DMT and that person will return to a functional baseline in about 10 or 15 minutes. And it also gives the ability to titrate or modify the dose if required based on what the physician perceives is appropriate for that individual. We can dial the dose up or down to arrive in that therapeutically useful range. This enables a more flexible therapeutic design, where instead of building up to a long 6 to 8 hour long session and then unpacking that after, we can intersperse short psychedelic sessions with integration therapies. So building up, not tossing someone into the deep end, but saying, hey, test the waters, let's talk about it, and we'll build toward that point of effect. And this may result in potentially less time required in that psychedelic state in aggregate. So just a bit of interesting science jargon. DMT is more potent than psilocybin, twofold more higher activation of the 5-HT2A receptor set than psilocybin. It's rapid pharmacokinetics, 5 minutes as opposed to 50 minutes for psilocybin. So this allows for near real-time clearance of drug effects when the flow of DMT is stopped. And there are also qualities such as increased dendritic spine density and synapse formation that essentially just mean that there are indicators that there may be long-term plasticity on top of the momentary instance of plasticity from the actual experience. And this may enable long-term and positive growth. So yes, the psychedelic experience is very weird. It's difficult to characterize, but those that do, have reports about it generally experience vivid visual imagery and some somatic or bodily feelings, accompanied by a wide and powerful range of emotions outside of the scope of what is normally felt. And I think that's very important for people that are stuck in a depressive or addicted rut. And this broadened scope of experience can often lead to deep clarity and insight into one's life and relationships, and result in a dismantling of deeply held beliefs, which was super important for those that may have detrimental belief systems. And from a physiological or phenomenological perspective, there's some very interesting things that we're tracking and putting into our technology platform. There's something called alpha power drop, that's responsible for the indication of visual activations. And very importantly, there's something called Limpel-Zipf intensity, which is a direct measure of entropy, as well as the reversal of cortical traveling waves that are indicative of predictive coding. So yes, these are all features that are observable via EEG, and we'll get into the platform in a second. So yeah, our progress in our estimation has been pretty stunning. This is a very rough overview of things that we're currently conducting, and we encourage everyone to visit the Entheon website to do a bit of a deeper dive. But yeah, Entheon RX, our drug development division, we have EBRX 101, which is a clinical trial of DMT. It's adaptive, single dose, double blind, placebo controlled, 5 cohorts of 10 subjects at ascending dose ranges per cohort. That's taking place with our amazing partners in the Netherlands. The primary aim is, of course, a safety trial, pharmacokinetics, pharmacodynamics, but we're also very much interested in associating the EEG data associated with those various dose ranges to understand the subjective effects from an objective viewpoint of EEG. And we're also correlating that with genetic data to see if there are any metabolic factors that may indicate a differential response or a differential rate of metabolism. Of course, we're conducting a battery of non-clinical studies in support of predicted FDA engagements over the course of 2021 or 2022. And yes, Entheon RX is also developing new chemical entities. So we're developing DMT-based molecular entities evaluated on the basis of docking, binding, and ease of synthesis. We've conducted an exhaustive literature search, and we're currently in the process of evaluating certain synthesis partners. We anticipate to file some patents around our new chemical entities in the earlier part of 2022. And some of the properties that we're after in terms of our new molecules are neurogenerative or anti-ischemic effects, as well as non-hallucinatory forms of DMT, as well as forms of DMT that have enhanced pharmacokinetics. And we have some very good leads that we're looking to pursue. Additionally, we are looking, as mentioned, at alternate routes of administration to suit people that may not benefit from a intravenous form of administration, just based on life experience or maybe a history of intravenous drug use. So we identified our development partner and selected our dose ranges, and we expect to do a feasibility study around that over the course of 2022. Our biomarker platform, as we mentioned, is taking place. EBIQ 101 is an EEG analysis of the neurological activity of those that are undergoing ketamine treatment in patients with major depressive disorder. That's taking place with our amazing partners in Heading Health in Austin, Texas. That study is currently recruiting, and so we anticipate an imminent initiation of that project. And similarly, we're capturing EEG data associated with what happens to a person following ketamine administration. We're also measuring neurophysiological changes from beginning to end over the course of that treatment, with the intention being to determine what treatment efficacy looks like so that physicians can validate if something useful or therapeutically useful has happened, and to track progress over time following treatment to see if there has been a maintenance or degradation of that treatment effect, so that they can then recommend at these various touch points following over the continuum of care, more refined form of therapy. And of course, as mentioned, our DMT biomarker program is associating electrical activity with various dose ranges, understanding that there are specific therapeutic or subjective thresholds that physicians are very interested in knowing about. You don't want to push a person too fast, too far, but you also don't want to keep someone too shallow in terms of their immersion. So yes, we've witnessed a lot of interest in that project. Yes, and our biomarker program is also supported by our genetics division, our genetics arm. We recently acquired 2 companies in the genetic space, Halogen and Lobo. They have a direct-to-consumer genetic test kits looking at potential risk markers associated with psychedelic and cannabis use, and also with metabolism related to both of those drug categories. We're currently in the process of updating, expanding the gene markers to be inclusive of more molecules, and we expect for a new version of the Halogen test to be commercially launched before the end of 2021. So yes, we're developing a personalized system of psychedelic medicine. Our integrative approach to personalized medicine seeking to change the current landscape of psychedelic psychiatry. We're leveraging the unique pharmacokinetics of DMT to create safe and adaptive drug experiences, pairing that with genetic biomarkers to predict drug selection and response, and pairing that also with EEG biomarkers to guide therapeutic programs, inform physicians of patient state during experience, and to track efficacy of those therapies over time. And this all results in a personalized psychedelic-based psychiatric care system that has utility at every stage of the psychedelic care journey and gives physicians additional objective touch points that can better inform their care, but potentially even generate more revenue opportunities for them to have callbacks, have more opportunity to do reassessment, and to pepper in different forms of psychotherapy. So yes, our executive team is a lot of lovely faces. I know we're running short on time, but represent a broad background of traditional pharma discovery, pharma tech stacks, cannabis litigation, technology, and our scientific advisory board is the all-star cast representing, in our estimation, the best, brightest, and most entrenched in psychedelic research, as well as people that are very much in the field when it comes to patient care. And yes, I think we've seen this figure before, compound annual growth rate of the psychedelic drug market, 12.36%, expected to hit 10.75 billion by 2027. And we intend to have multiple instances or multiple opportunities for revenue generation to support that growing figure. And yes, some basic financials. We're trading on CSE under the ticker ENBI, on the Frankfurt Exchange 1XC1 and OTCQB as ENTBF. Thank you so much.
Wow. A lot to think about here, Tim. And I think the chat is also saying the same thing. This is very, very exciting. And frankly, presentations like the one that you just gave are why we are doing, is basically why we started doing this conference, right? Because companies like yours, these early stage companies are oftentimes the ones at the forefront, frankly, doing the coolest stuff, right?
It is very cool stuff. Yeah.
Trying to push or pull or drag us forward. It is a really, really fantastic thing that you're working on, and it seemed like you may have been answering questions from the chat as you went. We do have a few questions. A lot of them you did already address, but I would implore you to, after you're done here, to go check out the chat, because the comments are, we're all rooting for you. Basically, is the summary here.
There's a huge need. And we sit at that very rare intersection of satisfying a massive public need. I think we're all aware of what society needs right now, and we just so happen to be in that very opportune moment of actually having the science there to bring about solutions. And we're working as hard and as fast as we can to bring this to reality.
All right, here's one from Mitch, and he always asks this question. He wants to know where you derive your DMT from.
It is fully synthetically derived. We've had amazing manufacturing partners, absolutely to the highest degrees of GMP standards. We're putting this into humans, so it has to be over 99.7% pure. Fully synthetically derived.
All right, and here's a good question. We'll do one more, and then we do have to wrap here. But this is from Ben. At the end of the day, you are a business. You do need to make money, right? Who are you advertising in front of right now? How does this treatment get paid for, et cetera?
Absolutely. Yeah, our intention, of course, is to follow the very rigorous and pretty easy to understand, as difficult as it is to follow, just from a time and cost expenditure perspective, the regulatory pathways to have this be a fully FDA and EMA approved drug. The intention being to have this be totally sort of like insurance covered. With the intention of having this be an option for physicians to prescribe and to have copays occur. So, and we're seeing a massive proliferation of the actual last mile type of clinics that are taking shape over the course of North America, and more physicians are actually emailing us, calling us every day, and saying, "Hey, when is this actually going to be something that I can prescribe?" So the intention isn't to replace the medical system. The intention is to slot into the already established prescribing models and insurance copay systems that already exist.
And then last one, I promise. How do you give doses? Intravenous?
Yeah, currently intravenously, but as we know, or as I mentioned, we're very deeply interested in alternate forms of administration. I can't say what. That's one of
Right.
those little secrets for now, but that release will likely be coming over the course of Q1. But yes, intravenous, it's super direct, it's super understandable, but we're looking at different forms of administration to make it a bit more palatable or a little bit less, I guess, ominous. No one really likes a needle in their arm, but they'll take it if it's life-saving.
Exactly. All right. Timothy Coe is the CEO of Entheon Biomedical. Timothy, as I said, very thought-provoking presentation. Thank you so much. And go to luck. We're all rooting for you.
Appreciate it. Thank you all.
All right. Hey, guys, let's bring on our next speaker here. It is 11:55. We are making good headway. We are on time. The trains are running on time. It's never a guarantee with me, but we're on time right now. Hey, I see our speaker now, Mike McConnell, CEO of Easy Fill Holdings. Mike, how are we doing today? You're on.
Doing great. How are you?
Doing
wonderful.
fantastic. I do see your slides. There they are. Oh, man. Never pump gas again?
Absolutely.
Oh, tell me more, sir.
Okay, well, let's get started. We'll go ahead and get in the presentation. But basically, Easy Fill on-demand fuel delivery, one of our key slogans is never pump gas again. And we'll show you why, fundamentally, there's just a better way for customers and fleets to get gas. So Easy Fill brings the gas station to you, and we believe that mobile fuel delivery is the next big on-demand opportunity. What we'll go through today is really this space has really been untouched by technology. The last big change occurred in the mid-'80s when you introduced a credit card reader at the pump. But fundamentally, since then, nothing's really changed as far as choices for the consumer. So as we start with highlights here. As we said, technology has really been untouched here. So it's really fertile ground to make some really big fundamental changes. The industry is really starting to attract investments from the big oil majors and some VC firms out there. They're really taking notice of this space and notice that there's something that's fundamentally can change. Easy Fill is a big growth story, a future expansion into regional and national markets, including New York, which I'll get into a little bit more detail there. And it's also important to note, I think, because there's a lot of headlines and a lot in the media about electric vehicles. 95% of the vehicles manufactured in 2020 were gas powered. So there's this big demand for gas and a long runway of decades as far as the need for gas powered vehicles, which we'll get into in a little bit later. Some key trends that really are indicative and really show you how valuable and really just the opportunity that's in mobile fueling. First is real estate. So gas stations have been on the decline for years. There's simply just a better use for the real estate that they sit on. And as they decline, that creates opportunities for on-demand mobile fueling. Electric vehicles are definitely growing and will continue to grow in the future. And as they do, that'll continue to put pressure on the traditional gas station, which will continue to decline as well, which again creates opportunities for on-demand mobile fueling. The on-demand space, we all know how that has taken hold, and it's basically the new platform for consumers today, especially with everyday purchases. So that consumer behavior shift for convenience and on-demand is going to stay. Efficiency, everybody values in the business environment a high focus on efficiency and use of resources and time. On-demand definitely feeds into the convenience of that. Crime doesn't exist with mobile fueling. You have gas station crime, credit card skimmings, a risk to consumers, simply does not exist with mobile fueling. And then mobile fueling is this new thing, and this touch-free, contact-free product or service with what we're going through now with the pandemic and everything else is very important for consumers. And on-demand mobile fueling is touch-free. In fact, you can see on the next slide, there's been several studies out there that show that a gas station pump handle is one of the unhealthiest things you can handle. And in fact, it's 11,000 times dirtier than a public toilet seat. This gets completely eliminated by using Easy Fill and on-demand mobile fueling. Talking about the management team, starting with myself, as CEO, I have 32 years experience in automotive sales finance at Nissan North America, managing a $60 billion balance sheet company. Cheryl Hanrahan is our COO. Cheryl has got a lot of experience in the global supply chain, so logistics and supply chain. Rick Derry has a 34-year career, all of it in the oil and gas industry, starting at Gulf Oil, where he was the vice president of sales and marketing. And then Arthur Levine, our CFO, this is the third company that he's been in to take it public. He's got both public and private sectors, starting out with a Big Four accounting, and is responsible for really managing our compliance and GAAP with the public company. Our board of directors, the chairman is Al Weiss. Al had a 39-year at Disney. His last position was president of worldwide operations for Disney's 10 billion plus 95,000 employee park and resorts business. We also have Lou Reyes, who's going to be on the board. He has deep experience in both the public and private practice. Also served in the public sector as a senior government positions, including a White House official and aide to the President of the United States. Jack Levine is on our board as far as our compliance and audit committee. He owns his certified public accounting firm. And then Mark Lev is the president of Fenway Sports Management, which will be key in our branding and marketing efforts as we go forward. It's important to note with our management team and our board of directors that we built this team in this organization with the goal and in mind of running $1 billion plus company. So now let's start talking about the real opportunity to really innovate. The retail gas industry is a $500 billion industry. And as I talked about before, it's really been untouched by technology, so it's ripe for change. This next slide over here really shows you the opportunity and frames it well with on-demand products and services just being the new standard. You can see in the transportation segment and look at the market cap and the market size. Fundamentally, before Uber and Lyft and the on-demand platform hit, there was one way to really get it, transportation through a cab. Same with meals. Before the advent of DoorDash and Grubhub, as far as takeout is concerned, there was really only one way to do it. It fundamentally changed forever with the on-demand with DoorDash and Grubhub. Groceries with Instacart Ship, same type example. Grocery shopping before has been the same way, the same experience until you got the on-demand platform and being able to change it for a convenience factor for the consumer. And then you have fueling. All these things they have in common are these are things that people in the transportation, meal, grocery, and fueling segment is something they do every day, every week. So you can see how this matches very well in the fueling industry to take this on-demand platform and convenience and this fundamental change. Before on-demand or being able to get gas a different way, there was really only one way to go to the gas station. So now we'll start to really put some dollars or monetize the opportunity as it looks at as the on-demand share in the total market. So you can see fuel delivery is about almost a $900 billion revenue market annually. Grocery sales, 1.4 trillion. And then mobile fueling, as we talked about, is $500 billion. So it's a little orange band is just the year-over-year growth with the on-demand share. So you can see in food delivery, it's over 17 billion year-over-year growth. Grocery sales is over 35 billion, 41% year-over-year growth. And then we have mobile fueling just estimated at 100% because it's so new. And with this new opportunity or a choice for a consumer, it's going to mirror and match, has the potential to mirror and match the same type of explosive growth that you see in food delivery and grocery sales. Now we'll start talking about this long runway or demand for gas and what's really out there as far as what consumers are using today. You can see 143 billion gallons a year of U.S. motor fuel consumption in the United States today. Over 95% of the cars sold in 2020 were gas powered. So even though there's a lot of the headlines about electric vehicles and the growth and how that's going to occur, the vast majority of cars on the road today are gas powered. You got 121 million commercial vehicles on the road, 276 million consumer vehicles on the road with about an average life of 12 years. So the runway for gas powered vehicles is long and extensive. Now we'll start talking about this new vision, refueling, reimagined. And it really is as simple as this slide. You pull out your phone, order via your app. Every consumer knows how to do that. They choose how they want it delivered, either at home or at work. And then we show up and execute in the time frame that they ordered. It really is as simple as that. And the customer never has to pump gas again. Traction to date to show our performance. We've been in operation since about the second quarter of 2019. We've done over 10 million in sales to date. We have a very strong customer rating of 4.8, 80% plus customer retention in our subscription service. And we've done over 3.6 million gallons to date. So now let's start talking about really the business model. And it really is a pretty simple 4-step business model powered by technology. So step number 1 is just on-demand and recurring orders, consumer orders via their app. Direct sourcing leads, for us, we buy direct from the fuel depot. We don't really carry inventory overnight. We use the logistics and route optimization for our orders for fast delivery within specified time windows, and we're constantly learning from that and really re-inputting that information to optimize our route delivery. And then payment processing and user analytics. We have a lot of billing, can see customer behavior, which helps us with push notifications out to our current customers. So now technology, fuel on demand, and the screens that you see are literally the ones that a customer would choose. It's as simple as 3 or 4 touches, and they're ready to go as far as their fuel delivery. So starting with the consumer app, customer gets it, downloads the app in less than a minute. They create their profile, place their initial order, and our goal, and the goal for the customer is recurring orders. You can actually set this up once, for example, every Thursday at 5 o'clock, and you literally never have to do it again. Of course, they're available on the App Store and Google Play. Next really is for the fleet side, is integrated platform for proprietary software. You can see the fleet customer portal, operational dashboard. We have an easy tech driver app, route optimization, and then fuel inventory tracking. So this integrated technology is a big piece of what we do. Now to start getting into our customers, there's really 3 different classifications of customers. We have consumer, where the consumer downloads, order it. The price is based on an average over a gallon and also a delivery fee of $4.99 or $9.99 unlimited monthly. Commercial or fleet accounts, they sign up with our customer success team on a delivery schedule that meets their needs. Most of these return to base at night. And then specialty, especially for us, is marine, construction, agriculture, and other type of fuel customers. So consumers, they order via the app. They can do it at home, either single family homes, condominiums, or subdivisions. You can order at work. We do business with corporate campuses, and we have several of those reopening now and relaunching, office buildings and job sites. As you can see our customers down below as far as we go to their business and actually fuel services while their employees are at work. We can fuel the cars in the parking lots. Commercial, we fuel fleets at night, so they're on the road the next day. It's really a no-brainer from a business point of view, especially if they're on fuel cards. You can see the benefits are increased route capacity, reduces driver downtime, lower emissions, eliminates fuel cards. Our client profile, we do business with multinational online retailer, essential services, delivery companies, rental car, and governmental agencies as well. And then last is specialty, which specialty for us is really a customized service, marine, boat, construction. And you can see on the bottom, the different fuel types that we offer is Rec 90, off-road diesel, regular gas, and on-road diesel. And you can see the quote from one of our big customers is MarineMax. Market players, you can see our competitors with shows a screen, but the biggest part here is the lead investors. You can see some of the VC firms. You can see GM Ventures, Exxon, and then Shell with Tap Up as well. So there's a lot of people looking in this space and what's going to continue to evolve in this market. So growth really quickly, you can see through our advent of our company, we've had about 10 quarters almost with a small dip during the heat of the pandemic from our revenue growth for 10 quarters in a row. Growth initiatives, our first big initiative is expanding our footprint from Miami, so growing in the Florida market, which is a $20 billion market north. You can see on the map some of the other markets that we're going to go to, and it's important to notice that we have relationships with those 20 commercial accounts that will leverage that from an anchor strategy to continue to expand as we go into new markets. New York City is a unique opportunity for us, which I'll get into here in a little bit later. So we've entered into a strategic licensing agreement with a company called Fuel Butler, and this license agreement is unique IP and technology, patent pending technology on the build of a tank for use in fueling in New York City, where it's currently not allowed by law today. So the Fuel Butler principals have been marketing petroleum products in the New York market for decades and have the right relationships with the AHJs, the approval authorities, and the fire marshals. It's important to note there's only 6 gas stations south of 125th Street, Manhattan, where there's 1 million automobiles registered. And New York City and Long Island have about 39% of the registered vehicles in this state. So as we go through this process, hopefully get this approval, it'll be a game changer as far as fueling in the city of New York, an extremely dense market. The next initiative is Technology, of course, we'll continue to invest in that and optimize. And we've already raised our investment in that, hired people in innovation. We'll continue to do that. And then strategic partnerships through acquisitions and strategic alliances as far as integrating and buying smaller players, partnering with large fleet operators, and anybody with in need of a fueling strategy. Last slide is really highlighted just to sum up to the current market that we have today. You've got about 400 registered vehicles. Over 95% of the cars manufactured in 2020 were gas powered. Gas stations continue to decline. Technology really hasn't touched this space. So the advent of on-demand with a different choice for consumers is we see that this is really a perfect marriage for Easy Fill as far as taking the opportunity and changing the way that customers get gas in the future. That's it. Thanks. Be happy to answer any questions now.
Yeah, I actually want to say, as somebody that's from New Jersey, I did not have to pump my own gas. I didn't have to learn until I was 18 and I went to college.
Sure. Yep.
So this company is after my own heart. We got a lot of questions here.
Okay.
Let me just start with this one. Mike, what exactly is your competitive advantage? What, in other words, what is to stop Shell from doing the same thing, or the gas stations, the other companies from doing the same thing? What exactly is your advantage here?
Yeah, I think it's the convenience factor as far as the on-demand platform. So the on-demand platform basically turns it over to the consumer to really dictate what they want, when they want it, and how they want it as far as delivery and those kind of things. So our edge is utilizing technology, some of our proprietary technology to continue to build and refine that process for the consumer. So, I think our biggest advantage is that, and then also the diversity of our customer base being both consumer, fleet, and specialty, which a lot of the other people aren't in as diverse as we are. So I think it's continuing to offer all those different segments, utilizing technology the way that we're utilizing it and investing in today. We'll continue to refine that. Now, as far as other players being in the market, that's fine, especially the big oil companies, them being involved in it just shows, we think, the potential value in the future as the evolution of the gas station changes in the future.
We got a lot of questions here from the chat. This is an interesting model. Let me just ask this one from Sean. It's a very broad one. What are your marketing plans?
Well, the marketing plans is a great question because, pre-IPO, we really didn't do any marketing at all. And you remember I showed you the revenue slide. We had 10 quarters of revenue growth with really fundamentally no marketing plan and no sales team, which we've hired both an agency and a sales team. So we'll have a comprehensive launch plan. We're going through rebranding, relaunching, comprehensive media plan as far as social, outdoor, all the things that you would look at as far as a traditional plan. We've hired the agency, we've got the plan ready to roll and launch that, as part of our growth and expansion strategy.
We've had several questions about EVs. Do you have any plan to diversify on that front, service EVs at all?
Not yet. Our goal is if we can get the business model adopted, so just don't think about the fuel source for a second, get the on-demand process. As the fuel source changes and driven by consumer demand, we'll continue to evolve and change along with that. We've got people involved in our business that are very knowledgeable about the EV space as well. So we feel we have good visibility to what that looks like, going forward and what the opportunities are for on-demand mobile fueling as EV continues to grow in the future.
And then I would just love to know, based on all the things we've seen in the last few months about supply chain disruptions and a shortage of drivers out there, how are you seeing that? Are you guys having any problems, on your end securing trucks? And we saw,
Sure.
I think it was the UK earlier this year that had a nationwide shortage because there was a shortage of truck drivers. So they had a fuel shortage. So are you experiencing that at all?
Yeah, no question. It's a challenge for anybody in that space. We feel good about it. We recently announced we've ordered 33 additional trucks, which we're actually starting the deliveries of those next week. We're having continued discussions with our supply chain partners on how to get ahead of that and secure not only the trucks, the chassis, the tanks, the parts that go in those. We've also hired in our HR recruiting department a person is dedicated to our operational team with the sole task of drivers, dispatchers, and station managers. So
Nice.
It's definitely a challenge. I think we've got the right resources dedicated to be able to support our growth strategy in the way that we want to do that. But it's definitely, we're in kind of uncharted water, you know, as far as the supply chain that everybody's in together. But we feel like the things that we can control, we've got those lined up and handled on our end.
Got it. Mike McConnell, the CEO of EasyFill. I had no idea this business model existed. So props for that alone. Mike, thanks for joining the Benzinga Small Cap Conference today.
Great. Thanks for having me.
And yeah, in case I wasn't clear, Max is correcting me in the chat. Right. The UK did not have a fuel shortage. They had a shortage of fuel drivers, people whose job it was to actually transport the fuel from point A to point B. So yes, thanks for correcting me, Max, in the chat. Always love to be corrected. And always love feedback. If you have feedback, good, bad, or otherwise, drop it in the chat. Email us, events@benzinga.com. All right, let's move on to our next guest here. You know, it is my core belief that everyone should have more real estate in their portfolio. So let's bring on, there he is now, Joseph Corradino, the CEO of Pennsylvania REIT. We're at a round table here. What's up, guys?
Good afternoon.
How are we doing today?
We're doing good. To my left,
so we've got Joe. We've got Joe. We've got Ellery, correct?
Joe Corradino.
Joe Corradino. And
the CFO.
And Heather Crowell.
Awesome. All right, guys, I see your slides. Can you just put them in present mode, please? And we'll bring the slides up on the screen. And then we'll pull them up and then we'll roll. Because I see your slides now, and if you could just put them in present on the PowerPoint on your end.
We're having a slight technical issue, but we can walk through the slides, and in a moment we will pull them up. If that.
Well, the good news is we can still see them as they are.
Oh, okay.
So when you kind of go into present mode, go for it. But otherwise, we can still. I mean, I can read it on my screen. So if I can read it, I'm saying it's good to go. So why don't you start rolling through it and
sure,
and we'll go.
Why don't we take you through it?
Awesome.
So, I mean, Preet is an owner in 19 high-quality malls that we have transformed, that continue to transform into community hubs. Our portfolio is concentrated in the Mid-Atlantic with a strategic focus on Philly and DC markets. And to the extent our assets are not in those markets, we tend to be the strongest property in the market. We like to call it the last man standing. Our portfolio is sized so we can dive deep into every asset, but it's strong enough that we can attract a diverse array of businesses and drive strong traffic and sales to our properties. I mean, all things considered, business right now is excellent. We think we've been able to see around corners and value our portfolio of irreplaceable real estate. We've recognized the changing landscape, and today we're really focused on 5 core areas of growth for our properties. Multifamily and hotels, apartments are a big part of our future. Healthcare and wellness, grocery is an essentials. We're adding tenants like Whole Foods and Aldi to an enclosed mall environment. We're doing experiential tenants, entertainment, etc. And of course, retail remains at the core. And we have a history that is that's rich with action, as the slide indicates. We like to think that we carefully curate to best serve our communities. Again, we're sized to be able to really drill down into the assets, understand our markets, our properties, our customers. And with Philly and DC, we're a compelling opportunity for retailers, for multifamily, for all the things that are contributing to our continued growth. And the way we got here, by the way, there's a lot of talk about the death of malls and we're over mauled, etc. And to a certain extent, we don't disagree with that. We got here by selling off over 19 lower productivity malls in secondary markets. So what's remaining is quality assets. And the other issue that's gotten a lot of attention on the scene is department store boxes or anchor vacancies. We've replaced over 19 anchor boxes with 36 new tenants, with a differentiated tenant base that is comprised of 30% of the kind of tenants you'd find in an open air center. So we've enhanced our credit quality. We've got better credit in those department store boxes, and we've increased the traffic and sales coming out of those properties, and thereby the traffic and sales in the malls themselves. So we were destined not to be victims of this shrinking department store landscape. And when you look at what we've done, those 19 anchor boxes filled with over 30 tenants, we're generating 3 to 4 times the sales volume and creating new traffic flows. So the tenants we have that we replaced the likes of Sears and JCPenney with are Burlington, Dick's Sporting Goods, Home Goods, Yard House, Aldi, Whole Foods, greatly enhancing the underlying credit of our portfolio. And we like to think that the size of our company and the footprint really enables us to be nimble and respond to the changing needs of each of the markets we serve. We have the unique ability to tailor and to pursue innovative new opportunities. And we got a great example at Moorestown Mall, where we took a Sears store and it's going to be replaced by an outpatient facility operated by the Cooper Health system. That it really is a differentiated tenant that will drive traffic to the property, but is certainly not a retail use. We also received approval at Moorestown to build over 1,000 apartments, and we're close to final approval on that as we speak. So the work that we have done has really added value to the portfolio and has positioned us for future growth. We also focus on cultivating retailers, small and emerging businesses that have been choosing our properties in droves, driven by the efforts of our teams and the market positioning of our properties. Our local leasing is set to yield double the volume it did in 2019. Double the volume in 2019. I'm skipping 2020 for obvious reasons, but comparing it to 19, double the volume. We brought in some unique shops and pop-ups, from yarn vending to fidget toys to baked goods, on and on and on. Our programs have been so successful that we expect to have fully occupied inline cart and kiosk space in over 60% of our properties this holiday season. It's our belief that these merchants are selecting our locations for their businesses because of the quality of the assets within the markets they serve. Now, if we look at the operating highlights, we've had a strong third quarter. Rolling 12-month sales grew by 6.1% compared to rolling 12-month, again, in 2019, standing at $581 a square foot on a comp basis, a traditional measurement for our business. Our total core mall lease space remains strong at 91.7%. And there are 637,000 square feet of leases signed for future openings, which will contribute annual gross revenue of about $10 million. And those tenants include entertainment concepts and restaurants, etc. Again, the properties are seeing significant growth in our leasing volume. If we look at Q3 21 financial highlights, more recent results from the quarter, same store NOI excluding lease termination revenue increased 36%. Yes, 36% for the 3 months ended September 30th, 21. Total liquidity was strong at 96 million at the end of Q3, and collections continue to improve to 92%, up during the quarter, up to 93% for October. And recently, we have very exciting tenants that are opening. We're opening a brand new theater in Grand Rapids, Michigan, at Woodland Mall, one of our premier properties, a dine and recline concept, as we like to call it. We've welcomed our first Aldi grocery store at Dartmouth Mall. And this is an interesting one. Adding a food store, one can think about it and say that, geez, you won't go food shopping and go to the mall. But our traffic during weekend of opening of the Aldi store increased 33%. 33% increase in traffic inside the mall. We opened up Tilt Studio, replaced a JCPenney at Magnolia Mall, which is a very exciting multimedia entertainment concept. We've got some online tenants coming in. Warby Parker, Amazon 4-star, signed leases at Cherry Hill Mall, and Turn 7, a hot new concept, is opened up this week at Moorestown Mall, validating our merchandising strategy of adding unique to first-to-market retailers to the malls this holiday season. If you look at our balance sheet, and that's a real focus of ours as we have continued to recover from COVID. It's critical that our operating results are doing well, but we need to improve our balance sheet. Toward that end, we announced a plan to raise over $120 million by the middle of 2022 through the sale of multifamily land sales, hotel land sales, out parcels, and other uses. So again, big focus on the balance sheet, progress being made in terms of entitlements and anchor approvals in order to be able to execute on raising the capital to improve our balance sheet. With that, I'll pause for a moment and open for questions.
Yeah. I've actually got a couple questions myself here, and then there are a few from the chat. What do you say to the people that are just like fundamentally, maybe they've been scarred from the last 2 years or whatever, but they're just fundamentally just against the physical space, right? Physical retail, mall-based, all of it. Just what would you say to those people?
Well, I would say that a couple of things. One is, sitting at home in your pajamas and shopping has got to get old after a while. That's the first thing I would say.
You would think so, wouldn't you?
The second thing I would say is that, again, we're seeing dramatic increases in sales at our properties. Restaurants are doing business, retailers are doing business. I just came back from an in-person International Council of Shopping Center meetings where we met with all of our retailers. Retailers are in a brick and mortar space are doing fantastic right now. Okay. But the other point is that I don't think they're mutually exclusive business models. There's a reason that, we're opening up an Amazon 4-star and we're opening up a Warby Parker and a Purple. And that is that there's brand exposure that one can get from a brick and mortar store that's valuable, number one. And number two, eliminating the cost of shipping through things like buy online, pick up in store are critical. I mean, Amazon can get it to you tomorrow. We can get it to you today. Right. And that's the difference. Right. And that's an important difference. I think also, as we look at this holiday season,
I was going to ask you about the holiday season, and that was my next
go
point.
Ahead. I'll
pause
for a moment.
What are you seeing, this past month?
Well, I mean, we're extremely optimistic about the holiday season. I was looking at a JP Morgan study. consumers have amassed $2.5 trillion in savings during the pandemic lockdown. And I'll tell you, if we look at our sales, which is up in the, in the mid to high teens, people are out shopping, no question about it. They're out shopping. And part of it, by the way, is the fact that, that there is a shortage of merchandise given the shipping crisis that we're underway. And you can go see it, touch it, buy it, take it home, as opposed to order it and get a note that says it's out of stock. So we're really seeing very positive results in the portfolio. And again, that probably is best illustrated by the fact that we'll lease over double the amount of space this year than we did in 2019. Again, not in 20. That's an easy one to beat. We were closed for 4 months in our portfolio, but compared back to 19, we'll lease over double the space.
Let me check on the time here. I think we have time for one. Yeah, we got a couple more minutes here. Great. So, question in the chat. If you have any questions, drop them in there. Question about your debt to equity ratio. Can you address that?
I'm going to ask Mario Ventresca, our Chief Financial Officer, to address that.
Yes. Good afternoon, everybody. It is obviously, as Joe pointed out, a focus of the company to improve our balance sheet, and the corollary of that is obviously improving the debt to equity ratio. The initiatives that he laid out on the last slide that he spoke to, in terms of harvesting capital, obviously that will lead to significant improvement in the balance sheet. We have a number of asset sales underway. Through these efforts, we expect to close on the sale of 12 parcels for over $120 million in gross proceeds. These will close by mid-2022. This includes the sale, again, as Joe had said, of several parcels of multifamily land, which are currently vacant parking fields, at our assets. We have $99.1 million under contract for those parcels under phase one.
And there was, I know you had mentioned the dividend. I believe you said early next year, correct? Is that what was said?
No, we didn't. We did not mention the dividend.
You didn't? I apologize.
That's okay. We're precluded from paying a dividend under our current banking arrangement.
Okay. I would imagine you will give an update when there is one to give.
That's correct.
Okay, great. All right. Any other questions that I didn't address in the chat? I believe I have gotten to all of them. So with that being said, Joseph Cordino, the CEO and of Pennsylvania REIT. Guys, thank you so much for joining us today on the Benzinga Small Cap Conference. And
you're welcome, and happy holidays, and go shopping.
All right. Yeah. You'd like that, wouldn't you? Yeah. Have a good one, guys.
Thank you.
All right. Oops, sorry about that. Okay. Real fast. What I wanted to plug before our next presentation is, if you haven't already, check out benzingaevents.com. All right. We are doing events all the time, some virtual, some in person, some like this, some a little bit different. Benzingaevents.com is where we keep our up-to-date calendar of all the things that we're doing. So, for example, you see the Global Small Cap Conference that's happening right now. You're watching it. Congratulations. Next week, we have our next All Access show. It's basically our one-on-one conversation show with me and some C-suite execs. And then December 29th, our final Benzinga boot camp of the year. These are one-day events that are like gung-ho on trading and investing education. So check it out, benzingaevents.com, to learn more. And you can see our whole calendar for 2022 is basically already done. Props to the events team. Getting things done early. We love it. We love it. All right. I'm sorry, Matty Ice. I missed you. I apologize. You can always email the company. Sorry. Okay, let's do this. Let's bring on our next speaker here. I see, there he is, Ellery Roberts, the founder and CEO of 1847 Holdings. Ellery, welcome to the show.
Thanks, Spencer. How are you?
Doing fantastic. I see your presentation. Let's get them on the screen. There it is. All right, the floor is yours, sir. We're talking private equity.
We are, and
Yes.
I want to thank all those that are on the call today. Given the fact that we only have 20 minutes, I figured I'd give a high-level overview for the first 10 minutes and then leave the last 10 minutes for Q&A. Let's see if we can move the pages on the presentation. When I started this platform in 2013, after having been a partner for 10 years at a private equity firm focused on consumer-related businesses that was very successful, I realized that I wanted to do something unique. And I heard from many peers and colleagues, Ellery, why swim downstream and look at guppies when you can swim upstream and look at whales? Why not acquire, quite frankly, larger businesses? Those businesses are easier to market to investors. They're easier to diligence for the purposes of acquisition. They have deeper management teams. They can absorb add-ons and tuck-ins more efficiently. And they're easier to sell, quite frankly. There's a larger universe of buyers and a larger universe of willing lenders. I thought to myself, as I'm sure many of you are thinking about that as I make those statements, they're right. It is easier. But in that, evaluating those statements, they left out one critical factor, which is price. Because of those statements, there is, and there has been for quite some time, an imbalance between institutional capital that is willing to acquire, manage, tend to, and try to develop smaller, what would be viewed as old economy businesses, because they just quite frankly aren't viewed as providing an opportunity for outsized returns. But I think when you factor in the price differential and the fact that there is a burgeoning leverage market available for those assets, you can generate those outsized returns, and you can do so while paying an annual yield to your investors. The very fact that we can buy businesses for anywhere from 3 times to 5 times EBITDA, which on an inverted basis is a cash-on-cash yield, or using the EBITDA and dividing it by the purchase price of 20 to 33%, I feel personally, is a very exciting place to be. And although it's taken a long time to get here, we feel that we've arrived, and we're very thankful for the shareholders who've had confidence in us during our time as a public company. Rather than flip through the pages of the presentation, I think it's probably best to focus on the statement that's on the screen. It's not always easy to do what's unpopular, but that's where you can generate above average returns. Buy businesses that look mundane to narrow-minded investors and hang on until their real value is recognized. That's exactly what we have done and intend to continue doing at 1847. The best thing to do, probably to speak to that point, is to go to the slide that will describe what we were able to achieve with our Goedeker investment. We encountered the bankers for Goedeker in the fall of 2018. I think the deal had been in the marketplace for quite some time, actually, and that's fairly consistent with the types of transactions that we see. These are the deals that, as I said, don't draw the attention of institutional capital because they're viewed as either too small, they're viewed as too slow growing, or they're viewed as having challenges upon an initial review that can't be solved or that might lead to a negative outcome for an investor. We looked at Goedeker and thought probably the same things that many investors did, which is Amazon or Wayfair could wake up one night and put this company out of business. Why invest? But after doing our diligence, working with operating partners, really trying to understand the industry, we realized that what they were doing, which is managing the logistic delivery of complex machinery in a way that was satisfactory to customers and led customers to return as shoppers, was unique. And as a result of that, and as a result of the fact that we were looking to look at something that someone else wasn't looking at, we were able to buy it with zero equity. We were able to take hold of a 65% stake in the company based on the fact that the leverage level was appropriate for the lenders. They weren't concerned about our purchase price. And we generated what I think is an extraordinary return. Whether or not we can do that to that level is anyone's guess, but I know that we can do it consistently and generate a very attractive return going forward. We now have 3 operating platforms. We are starting to build them up as we have acquired a couple of businesses to add on to Kyle's, and we're looking at other businesses for Wolo and for ASINs as well. With that being said, Spencer, I'd like to throw it over to you for any questions that there might be out there, and I'm pleased to answer them at this point.
All right, let's do that right now. Let's start with this question here. I guess what's in the pipeline? Let's start there. What else is in the pipeline?
Well, that's a great question, and I'm glad that you asked that. I can't speak specifically because we're public. I can't disclose non-public information. But I think what your question highlights, and one of the reasons why I get excited about it, is because there are. I once saw a statistic, and we used it, I believe, pretty consistently at my old firm in our marketing materials, which is only 10% of the capital is pursuing 90% of the investable opportunities in the U.S. Those opportunities would be defined as businesses that have upwards of $100 million in revenues and have more than $1 million in profit, but they're not public. And the reason is, quite frankly, we live in a world where we have companies that are with market caps that are exceeding $1 trillion. Pools of capital seem to move in and out of markets that are more efficient. This is an inefficient marketplace, and that's why we think it's exciting. And that's why our pipeline is incredibly full, and it's probably more robust than I've seen it in years.
But what can you say, maybe not about the pipeline per se or what's in it, but about like your deal sourcing? Because that's like 3/4 of the battle, right?
Sure. I think I benefit from having spent now 24 years as a principal, someone who could sign a document and pull the trigger on a transaction, that I have a pretty broad set of relationships. That being said, the playbook that we have is to consistently reach out on a systematic basis throughout the year, starting with a refresh in the first week of January, rolling all the way through to the last week of December, of trying to touch base with any one of thousands of business brokers, lawyers, accountants that we have in our database, to remind them that we're out there and that we're interested in adding to our holding company. And it's not, I would say, anything unique or proprietary relative to other private equity firms, except for perhaps the message that we get to brokers when we get on the phone, which is, don't tell us about the business that's growing at 30% that you're fairly certain is going to be leverageable to 4 or 5 times. Tell us about the business that you're excited about, that you haven't been able to relay that excitement to the marketplace, and maybe we will see something that you see as you look at your client. And that's where I think we fit a unique space, because people always seem to have deals that have, for some reason or another, been left behind. And we think that there are opportunities there to figure those out and generate pretty good returns.
I just want to clarify a question from the chat
Sure.
that was asked by Jamie. And the question was, so Ellery is I'll just bring it up on the screen. Let's just do that. And Jamie is asking, basically, Ellery and Goedeker's, you guys are the same, and I'll just let you answer.
Yeah,
I have my own answer, but I'll just let you answer it.
Absolutely. So we owned EFSH 1847 Holdings LLC owned Goedeker, was the majority owner of Goedeker from April of 2019 until July of 2020. Goedeker was spun out. It is a standalone public entity traded on the New York Stock Exchange. 1847 Holdings is its former parent, and we no longer, as a holding company, own individual shares in Goedeker, as those shares were all distributed in October of 2020 to our individual shareholders. So we are completely unrelated businesses, but Goedeker was birthed into the public market by 1847 Holdings.
One of the things that's interesting here, Ellery, is you're what 1847 is doing, and what a small handful of other companies do, is they give the broader investing public access to a market that is very unaccessible for most investors, and I'm referring, of course, to the private equity market, right? If you're accredited, or you have your money at a hedge fund or whatever, you have access to private equity. Most of us, though, don't have access to private equity. The only access we have is via private equity companies that are also publicly traded, which 1847 is. I'm just curious if you can just talk a little bit more about that. And,
I think you hit the nail on the head. I'll tell you an anecdote for you and for those viewing this presentation. And it speaks to the popularity and I think the way in which private equity and investing, venture capital investing, angel investing has permeated our society. My wife is taking our kids to school this morning, and she shows me the extracurricular activities that the kids have. One of the extracurricular activities from 3:15 to 4:15 is Shark Tank. I thought it was incredibly interesting, but I thought it spoke to the fact that, Spencer, knowing, we're probably not too far apart in age. I mean, 20, 30 years ago, kids weren't learning about this at 6, 7, and 8, what it's like to invest into a company, what it's like to create a company. But yet and still, that's where we sit today. And I think, to your point, what we'd like to do in 1847 is give the individual investor a chance to access an ownership stake in a private in what largely have been private companies that are now band together under a holding company structure, where that investor can, quite frankly, trade their shares and seek a market price for their equity interest at any point in time, versus in a private equity fund. And listen, I benefited as a partner at a private equity fund that's a very successful model. Obviously, there are managers who've been incredibly successful. There are investors who've been incredibly successful. That being said, any investor buying a share of 1847 knows full well that they can always exit rather than being locked up into a 10-year term or 15-year term because they're taking a commitment in a fund structure. So I think I appreciate that question, and it's really helpful, because that's exactly what we'd like to do, which is we like to bring the opportunity to invest in small private companies, many of which you've seen in your neighborhoods, in your local towns, in your cities near you, to the average investor.
So let's talk about the obvious question here, which is, of course, you guys trade on the OTCQB right now. What are your plans to uplist, if they are?
We have an S1 on file. We are in the process of raising capital, and I believe that when we execute on that S1, the intention is, as stated in it, to uplist to a major exchange, so the New York Stock Exchange American or the NASDAQ. And we're looking forward to that. That's something, as has been one of our stated goals for years, to start paying a dividend currently, which we will do as of January 15th of 2022, and to trade on a national exchange, which we believe will then give us also the ability not only to attract more investors as a result of the ease of the way the shares trade, but also to use our stock as currency, which I think will be incredibly powerful for many of the business owners with whom we interact.
Sadat78 asking, what are your management fees? That's a great question, Sadat.
Yeah, our management fees are typically 2% on assets under management, which includes the leverage. So really, the enterprise value of the companies that we acquire multiplied by 2% reflect our management fees. In certain instances where we believe there have been unique cases where we've spent more time rather than not, we have charged a higher management fee. But ultimately, on a weighted average basis, that's the goal, which is 2% of assets under management.
Okay. And I believe you guys also did some financing a couple months ago. Can you talk a little bit about that?
We did. We effectively did wrap our holding company level financing. We worked with a firm called Silac to effectively clean up and take on some leverage to add or bulk up our Kyle's cabinets business, which since acquisition has grown from a business with one location generating about 4.2 million of revenues and 1.4 million of EBITDA to a business that now will generate about close to 25 million of revenues and about 5 million or just under 5 million of EBITDA. So we're very excited about that. Also, given the terms of the loan structure, it allows us to pay out our dividend. And that was also another tangential benefit of both the holding company level financing and the add-ons that we were able to bring in.
Sadat in the chat, are you in private equity by chance? Sadat's asking if you focus on stable companies or distressed.
It's a good question as well. I think it's easiest to focus on stable companies. I personally benefited from some turnarounds in which I've been involved where they weren't profitable upon or at the time of acquisition. But there's so many opportunities out there to acquire stable, healthy businesses with EBITDA or cash flow north of $1 million that I think it would have to be a really unique situation. One in where we think that the risk reward dynamic is worth us investing largely our time to focus on a turnaround situation, because in most instances, it's not the initial capital that you spend when you do when you take on a turnaround. It's really the time and additional capital that you have to invest once you take ownership. So I think it's probably best for us, given that we realize that we're telling a more complicated story than most, to focus on stable businesses with existing cash flow.
Got it. And Sadat, my hunch was correct. Awesome. Ellery Roberts, CEO of 1847 Holdings. I guess as we wrap it up here, Ellery, what is one thing that people don't understand about private equity? In looking at the larger publicly traded firms in the space, the ones that everyone knows, right? Carlyle, Blackstone, for years, for quite some time, really prior to the last 2 years, those stocks underperformed, and it's been a pretty good year in the last couple of years. They've caught up here, but in terms of just investing in private equity, what don't most people understand?
Yeah, that's a good question. I think that what's little known is that from a public investor's desire to invest in private equity through a public platform like ours, there really aren't that many true opportunities to invest directly into the income generating assets. So when you invest in a Blackstone, when you invest in a KKR, in many instances, you're investing in, because they have multiple platforms that are public, you're investing in the manager and the fee stream that the manager takes in, both in terms of annual management fees and a profit participation. With a company like ours, you're actually buying a stake directly in the income generating assets that we, the external manager in 1847 Partners, manages. So really the most analogous, and I'm very familiar with the CEO of this company, Compass Diversified Holdings, and I kind of preach their praise from the mountaintop as often as possible, because we're simply a much smaller version of them. Is really the only opportunity that I know of, other than ourselves, to invest directly in the income generating assets. And that's why we think it's important to pay out a dividend yield on a current basis that comes from the income generated by the operating companies. And that's why we're excited, because all of our investors participate directly in the upside of those businesses when and if we are to sell them.
Got it. Ellery Roberts, again, founder and CEO of 1847 Holdings. Ellery, a pleasure to chat with you, man. Thanks for coming on the Benzinga Small-Cap Conference today.
Spencer, really appreciate it. Thanks a lot.
All right. Let's keep this train running on time. Let's bring on our next guest, Don Schmidt, who is the chairman of the board, the president, and the CEO, Rapid Therapeutic Science Labs. There he is. Don, how are we doing today?
I'm good. How are you?
Doing fantastic. I see your slides. There they are. Look at that. All right. I'm going to hop off here and give you the floor.
Great. Thank you. Welcome, everybody. My name is Don Schmidt. As the moderator noted, I'm the CEO of Rapid Therapeutic Science Laboratories. I note that we don't have a lot of time today, and I want to leave a couple of minutes for people to ask questions if they'd like. Appreciate everybody's time. So let's jump to the third slide in our presentation. And obviously the presentation is available through Benzinga for a period of time. Nevertheless, we are an aerosol company that is in the hemp space. We manufacture meter-dose inhalers with pharmaceutical grade isolates in a certified laboratory here in Addison, Texas. Of note, meter-dose inhalers, of which many people are familiar. They've seen them a lot of times with people who are asthmatics or have COPD. It's a very preferred way of delivering medication through the lungs if certain criteria are met. In this instance, we use patent-pending isolates, and we use other FDA-approved ingredients and excipients to deliver medication, which CBD, cannabidiol, is considered a drug under the FDA. We use that to deliver CBD to the lungs. We launched our second inhaler brand in 2020. It was a consumer-focused brand. We made the decision to take it off the market and pursue FDA approval through an IND. I would ask everybody that's watching this broadcast today to take a few minutes sometime today or as soon as practical, take a look at our current filings. They'll give you a lot more direction and a much broader discussion of what we have time for today. Nevertheless, an investigational new drug application with FDA, we made a decision that was optimal way for us to pursue the use of cannabidiol in delivery of the medication into the systemic bloodstream. And so in doing that, we are prohibited from selling our meter dose inhalers with CBD under FDA rules. So we made a decision to pursue that. We were fortunate that all of our aerosol equipment works on other aerosol products. And so we'll get to how that fits into our business model shortly. But we believe we'll ultimately be successful in our IND simply because of the fact that we have been able to come up with a meter dose inhaler using this pharmaceutical grade isolate that removes the biggest challenge that people face with any drug in front of the FDA that's delivered through the lungs, and that's airway irritation. We're not the first group to try this. We're just the first group we believe has perfected this. Nevertheless, I'm not going to spend a lot of time on why meter dose inhalers are so effective or why the medical community likes them the way they do. That information is available on our website and is available in this presentation further down. Nevertheless, we are morphing into what I would call a little pharmaceutical company. We're beginning to associate ourselves with the pharmaceutical space through our outside activities. We've talked about our patent pending pharmaceutical grade isolates. We make these isolates based upon the way that Big Pharma manufactures any medication for the aerosol space. And in fact, you can read in our filings and in some of our press releases that we have former employees of Glaxo and Pfizer who are come out of the aerosol space that have worked with us extensively in developing our devices. Nevertheless, since we made the decision to pursue the IND with our flagship product, we didn't want to be just a one-horse show, so to speak. And we made arrangements to pursue the marketing of other branded products using pharmaceutical grade cannabinoids, such as not only CBD, but CBG in something other than a pulmonary spray, like an MDI. So we'll take those isolates and we'll deliver them in what is known as novelty sprays, either sublingual or topical. I know that you guys have seen other sublingual products, and you've also seen topical products. Our machinery that makes our meter dose inhalers allows us to make those products. For instance, we'll be going to market, not in the fourth quarter as this slide shows, but in the first quarter, hopefully, with a new product line that's branded under the name Yoka. That product line will have both cannabinoids in it for sublingual sprays. It'll also have topical sprays, and it will have non-cannabinoid products. If you're reading our filings this morning, you'll see that we've got a very clean balance sheet and a very properly positioned capital structure. It's a well-known fact that we are pursuing an uplisting to a national exchange. And so that's what we're primarily working on at this point in time, is the pursuing of the listing on a national exchange and the investigational new drug application with the FDA. And I know that I've kind of run through that a little quickly, but if you took a look at our recent press releases, you'd understand why where we are in our business model. We are leaving our laboratory that we've been in for 2 years. We are building a new lab that's approximately 5 times bigger to house both our filling equipment, which is all FDA listed equipment, and our isolate lab. That new lab will be is being built up the street about a quarter mile from where I'm sitting here in Addison, Texas, which for those of y'all that don't know where Addison is part of North Dallas. So we're packing up and moving out of here. So we're having to hustle to make sure that we have plenty of product on hand for our anticipated phase 1 studies this spring, while we're under the current constriction with breaking our existing lab down where we're building a new one. So we've got a lot of things going on. There's a lot of exciting times in this market that we're trying to take advantage of. Obviously, we're wanting to be one of the first players in the CBD space to get through an FDA approval process, and at the same time use our excess capacity to manufacture pharmaceutical grade isolate at a pharmaceutical grade level. I'll note that the patent pendings that we have talked about are slowly being converted into non-provisional patents, and we anticipate we'll have some more patents just based on R&D and what we're doing in that space. One of the advantages of R&D in the space we're in is that we're small and nimble. So if we run across something that seems promising, we can quickly turn to it. For instance, water-soluble CBD isolate. So far, I'm unaware that anybody's come up with anything that's truly water-soluble. They're all dispersibles. But we're one of these companies that, because we're handling isolates on a daily basis in a manufacturing facility in an R&D lab, and we're doing it to pharmaceutical standards, we're able to I'm going to use a big pharmaceutical word here, play with the idea of water soluble in our lab. So that's one of the things about the fact that we're still small enough we can do things like that. At the end of the day, I think 2022 will be a good year for us, in the sense that we've managed to fulfill most of the business model objectives that we listed in 2021. I know that everybody on this call has had enough of COVID and the interruptions it's made to them, not only in their business models, but with respect to funding, sales, and so forth. We're not any different. We had fairly significant revenue when we released our prior branded model the week that COVID started. But we were like everybody else. It's hard to go see physicians when nobody can get in to see them. So, we worked through that. At the same time, while we couldn't get out and actively market our products, we were in the laboratory, and that's reflected in the patents that we filed so far. So we've come through 2021 relatively unfazed as a company, other than we expect to, upon listing on a national exchange, to accelerate the activities that we do. And that'll be our first goal here in the first quarter of 2021. Our second goal will be to to get products back out on the street. Yoka will primarily be a distributor product and will be primarily sold through distributors with some online digital activity. We built a entire marketing platform around Yoka and other similar branded products that we will develop that use these pharmaceutical grade isolates. So I've quickly jumped through that simply because at the end of the day, we have released our plans. We've pretty much executed on our plans. And now here at the end of the year, we're transitioning to the next phase in this company. I like to tell people that we're telling them what we're going to do, then we do it, and we told them we've got it done. And that's kind of where we are. So I invite you to take a look through this presentation so you'll understand why we're so excited about aerosol and why it makes a lot of sense for our product. Let's just jump down here real quick because my guys in the aerosol space would be a little bit offended if I didn't give you guys just a little bit of background. Needless to say, a metered dose inhaler is basically as effective as an IV, and the dosage is very consistent. When you have a systemic metered dose inhaler, you deliver medication into your deep lung tissue. This is the same thing that you get when you smoke or you vape, except in this instance, we have an engineered particle size that has a much higher bioavailability. And simply that's human physiology. It's not complicated, but it's expensive to formulate and to research. These inhalers are already in drug master files with other medications. So with our IND, we're just tasked with convincing the FDA that the ice that we're using is safe and provides some sort of efficacy with respect to a therapeutic claim. So we don't have to reinvent the wheel with this product. We just had to do the research in order to get it to work correctly. You can see some of the benefits of metered dose inhalers on this screen right here. If you're not familiar with them, we're all about safety. We don't touch or use anything that's hasn't already been used in this space in aerosol, other than our isolates. The other thing about metered dose inhaler are they're very quick. You get very accurate dosing, and they're very fast acting. I tell people that you typically can fill them immediately, and I've seen that happen numerous times in testing. You can feel the product anywhere between seconds and a couple of minutes. So in a product that's meant to be utilized for a therapeutic relief, the faster that you can get it to work, the better off the consumers, in this instance, patients, will be. Dosing is very problematic right now in the CBD industry. Nobody really knows what safe dosing is. This will be one of the things we'll cover in our IND, and that there are a few other firms covering an IND in oral consumable products that are going on that we're aware of. But nevertheless, the best part about a metered dose inhaler is you get it, and the reason why it's called metered is simply because you get the same dose every time. So physicians don't have problems with dosing with their patients. These are the benefits of a metered dose inhaler. At the end of the day, this is why we were so excited about them. Very simple device to utilize and to manufacture once your formulations are correct. We've already talked about accurate dosing. It doesn't require any heat or fire like vape does. Our metered dose inhalers contain 100 doses. It's inexpensive. People say, Don, why do you, besides the medical side of this, how are consumers going to be interested in, or why are they going to be interested in buying your product? Well, we can deliver cannabidiol, CBD, in your bloodstream for about 30 cents retail with a metered dose inhaler. That's about 80% cheaper than the closest gummy and about 90% cheaper than the closest vape pen. And I'm talking about high quality gummies or high quality vape pens. It's just you need a lower dose through your lungs simply because when it's absorbed in your deep lung tissue, the dose goes up your aorta to your brain. It doesn't go through your liver, so it's not degraded in that process. It's portable. It fits in your pocket or your purse. It's tamper resistant. Doesn't need batteries. It's waterproof. So there's a lot of advantages to it. So needless to say, we started this about 4 years ago. We've been improving it ever since. We bought a company along the way to help us with the isolate production, and then we approached former guys with Big Pharma to help us polish it at the end of the day. But needless to say, when you use our product on the meter dose inhaler side, you get a exquisitely good dose of CBD that has nothing else in it. You're only using an isolate when it removes all the things that are contained in full spectrum oil that you probably don't want in your lungs, and you may not want in your system through an ingested product. And these are consumer education things that we talk about all the time, and our presentation has a full list of those in it. So we've talked about value and what one inhaler equates to. I tell people one inhaler equates to about 1,000 gummy bears. Our gummy products with CBD. Most people don't believe it until I prove it to them mathematically. So if you've got questions about that, I'd love to talk to you individually. So like I said, the inhaler product was our second branded product. And then we're moving into the sublingual spray and topical spray area. Obviously, the sublingual spray, anything containing CBD, will be sold under their safe harbor provisions related to no therapeutic claims. All the other cannabinoids are currently considered supplements, but we still shy away from making any claims. We make structural functional claims, and you can see this in our marketing material related to our sublinguals. Like I said, this is a picture of our old laboratory. It's being disassembled, and all of our proprietary equipment is being moved to our new facility, and we should be up and running again by the end of the first quarter. Last is just a management team and the guys that assist us in research and development. So I think we've only got a couple minutes left. I've learned that if I get too far in the weeds about the technical aspects of what we do, we're going to run out of time. So I think I've got about 2.5, 3 minutes left. So I want to take any questions from the moderator, anybody who's watching the presentation this morning, and tell you if you would like to discuss a potential investment with us. Please feel to reach out through Benzinga or through CRKR, who's handling our marketing for us. And we have a website that you can contact me through directly. It doesn't come to me directly, but through my staff, info@rtslco.com. So with that said, I think we have about 2 minutes left. Go ahead.
Question from our chat here. Is your product similar to Mankind's Afeza? I hope I'm saying that right. It's from David Lynn.
I'm not familiar with their product. I know that there's a few other companies out there that are trying to do this. And I use the word trying because it is very difficult, and there is some disinformation in the marketplace.
Yep. What is the most difficult thing about it?
Well, from a human physiology standpoint, you can't just put something in a can and pressurize it and expect it to get in your deep lung tissue. If we go back just real quick to this slide right here, to this slide right here, this is a picture of your alveoli and your deep lung. There's between 500 and 700 million of these in your lung tissue. It's where oxygen CO2 gas exchanged. In order to put a medication in your systemic bloodstream through your lungs, you've got to get your medicine through the neck of the alveoli, which is about 5 microns in diameter. If the particulate that's being sprayed down there is too big, it won't go in. If it's too small, it won't stay in because it's molecularly too light. Cigarette and vape is a fine example. They only have about a 31% bioavailability rate simply because the molecule is nano. It's submicron. And so engineering that droplet size to get into that alveoli is a very technical scientific process, and it has to be done in conjunction with a number of different things, not only your formula, but the consumables that make up your product. Everybody else in this space thinks you could just put a formula together and spray it out, and it's going to come out with the right size liquid drop to be absorbed through the deep alveoli. That's factually impossible. And that's why these products on the pharmaceutical side, something such as Advair or Salbutamol, those products are engineered at great expense over great time, and it's not a fast process. So yeah, it's a difficult. There's been beliefs out there that you could just pressurize something, and when you spray it, you can't tell the size of the droplets in the aerosolized spray. You can only see that it is aerosolized. You have to have special equipment to measure the size of droplets and so forth. So it's
so interesting,
very unique physics experiment.
This is so interesting to me because like I have asthma. I've been taking an inhaler for basically my entire life. I've been taking an inhaler probably for like 27 years ish. So this has been enlightening for me. So thank you very much, Don Schmidt, who's the chairman of the board, president, and CEO of Rapid Therapeutic Science Labs. Thanks a lot, Don. Have a good one.
You bet. Thank you. You guys have a great afternoon. Bye-bye.
I just learned a lot about the science behind the sprays I've been putting into my body, or not so much the sprays themselves, but the devices. So thanks a lot to Don. Real quick, let's take a quick look at how we're doing in the crypto market today. Heat map decidedly mixed. You can see it right there. Bitcoin still in the red, ETH in the green. You don't see that every day. You don't see divergence between Bitcoin and ETH every day like you are seeing today, which is interesting. And the reason I bring up the crypto heat map on benzinga.com/crypto is because our next speaker is from a Bitcoin miner. Let's get him on the show. There he is, Ben Gagnon. He's the Chief Mining Officer at Bitfarms. Ben, how are we doing?
Thank you. I'm doing well. How are you doing?
Doing fantastic. We've got you. Do we have your slides? Not yet.
Let me put that on the screen.
Excellent. Firat King in the chat. We are back to our regularly scheduled programming on Friday. These are virtual conferences we do every so often, and this is actually our last one of the year. So don't worry, Firat King. Regular programming on Friday. For the moment, Ben, the floor is yours. Tell us about Bitfarms.
Great. Thank you so much. Well, everybody, welcome to this Bitfarms corporate presentation at the Benzinga Small-Cap Conference. As you know, I'm Ben Gagnon. I'm the Bitfarms Chief Mining Officer. Bitfarms is one of the largest publicly traded Bitcoin mining companies in the world. We have over 1% of the Bitcoin network, and we're traded on both the NASDAQ and the Toronto Stock Exchange. We've been mining for 4 years, and I personally have been mining since 2015 because we live in an uncertain and volatile period in human history, defined by both boundless fear and optimism and powered by outdated systems and high-speed technologies. The technological progress currently taking place is so great and so rapid and so disruptive that the progress we have seen and will see in our lifetimes vastly exceeds the progress that any other lifetime before us has ever seen. From education, communication, commerce, and culture, this progress touches nearly every aspect of our lives. And as a result, we now live in a world of abundance with the most food, doctors, scientists, entrepreneurs, developers, trade, space programs, computational wealth, and the highest quality of life the world has ever recorded. But despite all that, it does often seem that things are becoming increasingly difficult, confusing, and expensive. That all this technology that was supposed to make our lives easier, cheaper, and more free has done the opposite and made our lives harder, costlier, and less free. Because of this, it is easy to become disillusioned, to feel confused, and to be lost. But we have here today in this very room and in every other internet connected room and device around the world an opportunity to fix what's gone wrong, to correct the course of human history, and create a completely new voluntary economic operating system powered by Bitcoin. With every year, as Bitcoin expands its reach across the world, it discovers new users and new markets and new use cases. Its infrastructure, made up of both advanced data centers like Bitfarms and tiny at-home data centers, expands into new areas, develops new sources of power, and acquires new owners. And while the appeal of crypto around the world can be attributed to a myriad of reasons and projects, the appeal of Bitcoin around the world is always the same: to escape the ticking time bomb of inflation, which started over 100 years ago and accelerated with the dissolution of the last remnants of the gold standard nearly 50 years ago. With the exception of Paul Volcker, who was the only central banker since that time to try and run the system with discipline, easy credit and cheap money have quickly become the norm around the world. And in 2008, staring at a financial crisis, the world had a distinct choice: to do the hard thing and enforce the practice of fiscal responsibility, or take the easy path and do a bailout. Economists, politicians, journalists, and bureaucrats the world over said we had no choice, that we had to implement QE. They said that this would be a special event, a one-off, a once-in-a-lifetime needed fix to the system, and the consequences for not acting would be unimaginable. But they were wrong. It wasn't a one-time thing. It's never a one-time thing. Before long, we had to implement QE2 and QE3 and QE4, and over the last 18 months, the world has collectively overseen the largest expansion of credit and monetary inflation ever recorded. Not limited to a few countries like hyperinflation after World War I, this expansion for the first time in history was truly global. No country and no currency has escaped this trend. And the effects we're just starting to see now. Supply chain disruptions, low labor participation rates, inflation impacting every industry, every commodity, every pocketbook. There really is no way out of this. There's no way to unwind. There's no way to taper out. The only way out is through Bitcoin. And the mathematics to support Bitcoin as a long-term value investment are abundantly clear and simple. Bitcoin's current supply is approximately 18.8 million out of 21 million total, meaning 89% of all the Bitcoins that have ever been mined, that will ever be mined, already exist. And a further 10% will be mined over the next 14 years. And the remaining 1% over the next 100 years following that. Due to the way new Bitcoins are produced through mining, we know, and anyone in the world can verify exactly how many Bitcoins have, are, or will be in existence now, or at any point in time, down to a 10-minute interval with a very small margin of error. No matter what you look at, commodities, currency, money, whatever, this level of precision and forecastability is unheard of and unrivaled. Nobody can tell you how much steel, gas, grain, or even USD exists right now with a high degree of precision, let alone how much will be produced over the next 1, 10, or 100 years. Bitcoin is entirely unique in this aspect. And Bitcoin accomplishes this through mining and the difficulty adjustment. By adjusting the difficulty and resetting to 10-minute average block times roughly every 2 weeks, the network ensures that no matter how much or how little investment is made or technological progress and development happens with Bitcoin mining equipment or infrastructure, the future supply of Bitcoin is entirely predictable at any point in the future. And while Bitcoin supply will increase at exponentially slower and more predictable rates, the supply of currencies around the world are increasing at infinitely faster and less predictable rates. This long-term trend is compounding, inescapable, and the driving force behind Bitcoin regularly establishing new all-time highs, and can easily be mathematically shown as infinite currencies over 21 million Bitcoin. Bitcoin is arguably the freest market in the world. It trades globally and incessantly by passionate and skilled traders who have made Bitcoin incredibly liquid. But as with any free market, it is subject to volatility, to swings, to corrections. And this makes Bitcoin famous as a volatile asset. But its true defining characteristic is its predictability in performance and supply. For the first time in history, Bitcoin provides anyone, anywhere in the world with the technological means to escape inflation. And with this last year, Bitcoin is now being embraced by both individuals and boardrooms around the world as the premier hedge against inflation. Because the question is no longer whether or not Bitcoin is necessary in a portfolio, but when and how to get exposure to it. And these are tricky questions. What kind of exposure should you have? Which platforms should you use? What tools do you use to keep things safe? Whom do you trust? And most importantly, at what price and time do you enter? For many people, the simplest answer is just to buy and hodl for the long term. And while this is easy and effective, it's far from optimal. Mistiming these trades can easily lead to long-term negative portfolio performance and less Bitcoin in your wallet at the end. While the long-term trend of Bitcoin is abundantly clear and predictable, the short-term volatility does scare and prohibit many new market participants. But buying Bitcoin is only one strategy, and there exists another way, a better way. Like any other technology play today, whether it be Google, Facebook, Apple, Twitter, data centers are what drives and enables the technology. Data centers are the largely invisible and irreplaceable foundation of the world, and as such are the most foundational investment anyone can make into a technology. Amazon's AWS is a great example of how fast the data center industry is growing, how valuable computation markets are, and how insatiable their demand is for compute. Bitcoin mining is the same thing for Bitcoin. Bitcoin companies and projects may come and go, but mining itself is irreplaceable. It is the foundational layer that enables all of this. And as Bitcoin grows, so does the security of the network and the companies that mine it. In September to October, we had a 12.5% growth rate, comparable what Amazon's growth rate was in their data center business. And despite the halvings that take place every 4 years, which cut the block reward of new Bitcoins in half, and the exponential increase in network hash rate, the Bitcoin mining industry continues to grow and shows zero signs of stopping. Starting from really humble beginnings of just a few computers, the incentive to secure the network has created an entirely new industry for compute, which has grown at a tremendous pace and completely organically. Despite the block reward being cut about 87.5% since Bitcoin launched, and an exponential growth in hash rate, the current value of the Bitcoin mining industry is at its highest point ever, currently worth over $21 billion and generating approximately $60 million worth of new Bitcoins through mining every single day for a cost well below market value. Whether it's a 5-year-old Bitmain S9 or the most efficient miner you can buy and operate today, a Bitmain S19j Pro, Bitcoin miners are mining and acquiring Bitcoin with incredible margins well below market value. With fixed electricity pricing, rents, and labor, our cost at Bitfarms to operate a Bitcoin miner is constant. It is only the revenue measured in BTC or USD that changes over time. And these fixed operating costs means that as the price of Bitcoin grows, so does our upside in margins. When Bitcoin is in a bull market, the price of Bitcoin can and historically does grow significantly faster than new miners can be manufactured and deployed. This gap means that a properly managed mining company can function as a leverage play to Bitcoin. Now, typically, leverage comes with increased risk, but with such low costs to produce a Bitcoin relative to market prices and established Bitcoin support levels, Bitfarms is already effectively hedged against downside. But mining now is all about scale. While a single miner could have mined hundreds of Bitcoins a day when Bitcoin started, it now takes thousands of miners to mine a single Bitcoin in a day. And the Bitcoin mining economy of scale curve is inverted and looks a bit like a Nike swoosh. It makes some sense at small scale, is difficult in the middle, and makes a lot of sense at industrial scale. Economies is running one of these machines is relatively simple and easy. It doesn't take a lot of work, engineering or outside contractors. A lot of people can do this in their existing homes or businesses. But scaling up to operating hundreds of thousands or tens of thousands of these machines is a very different game. Between sourcing low-cost industrial scale power, designing and constructing highly specialized data centers and HVAC systems, training and retaining the specialized labor that is needed to operate, maintain, and repair this equipment quickly to ensure consistent revenues and strong profitability, and the capital markets, market understanding, and strategies it takes to develop these farms, purchase large quantities of miners, and scaling at the right times, it is incredibly difficult to compete with the biggest players in the industry. And then again, why would you even want to? You don't make your own toothpaste, cars, computers, or iPhones. Large industrial corporations do that because they do so cheaper, faster, better, and easier than you can yourself. And the industry is evolving every year. Public miners like Bitfarms give you the exact same exposure to the fast-growing industry with all of the advantages of scale, none of the overhead or hassles, and complete liquidity through public markets. This is where Bitfarms has the advantage. Founded in 2017, Bitfarms is by far the largest Bitcoin miner in one of the most abundant and cost-effective hydroelectric regions of the world, Quebec, Canada. There exists enough excess hydropower in Canada to run the entire Bitcoin network, giving us a huge opportunity and advantage to scale operations with cost-effective, clean hydropower and multiple decentralized facilities. But we are not stopping there. We are becoming a global player, expanding into Paraguay and Argentina at a rapid pace while exploring new opportunities in the US and abroad. Bitfarms has over 4 years of experience building, designing, and operating facilities. We have our own electrical engineering subsidiary, a full operations team, in-house developers, finance and accounting teams, and an in-house repair team. We are consistently improving upon our facility designs and efficiency over multiple years of operations and generations of Bitcoin miners. And Bitfarms has developed one of the most skilled and experienced teams in the world. Our operations team is able to install over 2,000 miners in under 24 hours. And with our proprietary management software, maintain some of the highest uptimes in the industry. Our executive team is filled with experts in Bitcoin mining, finance, electrical engineering, public markets, and project management that cumulatively have decades of experience in each category. And Bitfarms has achieved industrial scale. We have powered approximately 1% of the Bitcoin network for several years. We are nearly doubling the amount of our farms, tripling our installed electrical capacity, and quadrupling our hash rate between now and the end of 2022. This is expected to vastly outpace network growth, gaining market share and generating more Bitcoins every day as a result. Bitfarms has integrity. We are currently the only publicly traded Bitcoin miner audited by a Big Four firm, and we have done so since 2018. We did not enter the market through an RTO or SPAC. We walked in the front door with both the Ontario Securities Commission and the SEC. We didn't do this because it was easier. It was significantly harder. We did it because we knew it was necessary to provide confidence in our numbers and operations to investors when they were looking to invest in this new and emerging tech industry. Bitfarms has community. We currently have approximately 70% retail investors, many of whom are long-term holders around the world and are either the largest or one of the largest allocations of numerous Bitcoin mining ETFs. They have all picked Bitfarms as their favorite horse because they understand the unique value we have as a company and whom actively cheer and promote our company and brand in person and online to other investors. Bitfarms has conviction. We did not pivot from another business to mining because it was hot or topical. We have always been miners, and we will always be miners because we understand and believe in the positive technological transformation that Bitcoin is to the world. Many members on our executive and operations team have been mining Bitcoin for years, experiencing the joys of bull markets and surviving halvings and bear markets. Bitfarms has a vision. We are here for the long term, and we are building the infrastructure that will power the future Bitcoin economy with vertically integrated operations, decentralized global facilities, clean and cost-effective power sources, strong governance, audited and verifiable numbers, and huge amounts of Bitcoin being mined and added to Treasury every day with an 8 exahash end of 2022 target. We will be one of the largest and most trusted Bitcoin miners in the world by the end of next year. And we want all of you to be a part of that. In the words of the late, great JFK. But some may say, why choose this as our goal? And they may well ask, why climb the highest mountain? Why fly across the Atlantic? We choose to go to the moon. We choose to go to the moon in this decade and do the other things, not because they are easy, but because they are hard. Because that goal will serve to organize and measure the best of our energies and skills. Because that challenge is one that we are willing to accept, one that we are unwilling to postpone, and one that we intend to win. We are Bitfarms. Come join us on NASDAQ, and let's go moon.
Damn. And they on a high note there, Ben. Nice job. A few questions here before we wrap up from our chat. One of them was, let me pull it up here. I guess we'll just start with this. What is the hash rate? What is your hash rate?
What is our hash rate? Our hash rate is a little over 2 exahash right now, constantly growing. So we've got 48,000 miners scheduled for next year. So that's 400 petahash a month that will be growing. And we're always looking for new purchases and new expansion opportunities.
Are you just doing Bitcoin right now?
We are a pure Bitcoin miner.
Okay.
We have mined other coins in the past, but they don't give the same sort of reliability and predictability that investments in Bitcoin mining hardware does. So we focus only on Bitcoin.
Got it. Does Bitfarms plan to provide a hosting and infrastructure for fully managed blockchain hosting solutions similar to what Core Scientific is doing?
We actually don't have any other business lines or products or services that we offer to any customers. Okay. We're a completely self-operated miner, and the reason for that is the mining profitability is incredibly high. If we operated a hosting business and we ceded that profitability to other people and other individuals, we simply would have lower margins and less profitability. So we develop and maintain all of our power resources, and we mine them completely for ourselves to get the highest profitability and deliver that for our investors.
Paul in the chat requested me to please, he did it nicely, he said please ask Ben about the status of the at-the-market raises.
So we put out an announcement on our Q3 on the at-the-market. I unfortunately can't make any other comments beyond what's already been publicly disclosed on that. It's just, I can't make a comment on anything.
See, Paul, you ask, I ask, and Ben answers as best he's legally allowed to, which is all we can really say. So, Ben Gagnon is the Chief Mining Officer of Bitfarms. Let me just run through, make sure I didn't miss any questions, because I know there are a few. Few people asking how often, how long it takes to mine a Bitcoin for you.
So we're mining 11 to 12 Bitcoins a day right now. Okay. So approximately 2 hours.
There we go. Okay, sweet, awesome. Ben, thank you so much for joining us today on the Benzinga Small Cap Conference.
Thank you, Spencer.
All right, guys, we have entered what I'm going to refer to as like the how do I want to put this? Like the high flying part of the day. For whatever reason, a lot of the companies that we've had people clamoring for are all bunched up together. We've had a few people in the chat asking about our next speaker, actually, Petros Pharma. And I do see Fadi Bakhtar here. He's the president and CCO. So let's bring Fadi on right now. There he is. Fadi, how are we doing today?
Doing well, Spencer. How are you?
Doing great. You're a little quiet, so just try to speak up if you can. Do we have Fadi's slides, guys? Yes, we do. There they are. All right, just try to speak up, Fadi, and the floor is yours.
You got it. Let me know if this doesn't come through. I tend to have a lower voice, but let's dive right in. So one of the key components that we'll be sharing with you today is unhindering and expanding the access of good healthcare to men in terms of pharmaceutical therapeutics, device therapeutics, and the like. Petros Pharmaceuticals, our mission is to help enable men to live their life to its fullest potential. It is such an underserved market. We're going to touch base on erectile dysfunction being a flagship among them, Peyronie's being another, and we'll dive into solutions that address both markets. So a lot of what we're going to be talking about is going to be dependent on FDA. It's going to be dependent on other forces outside of our control. However, we have solidified plans, ambitions, and schedules to get us to where we want to go. They will be speculative, they will be ambitious, they will be tentative, and so we'll advise you to always check into our 10Q for more specificities and to tune into conferences like this for the latest and the greatest. Our stock profile, our company's profile, we are currently at $2.34 as of today. We have range anywhere from $1 to just under $6. Nice range there. We've actually significantly increased our average daily volume in trades. We're at 12 million. And if you've followed Petros for some time, that has been a significant enhancement to our daily trade average and volume. We have about 16.5 million common shares outstanding, a market cap of just under 39 million. We are an emerging pharmaceutical company, and we aim to be the premier men's health company in the world. And we're going to talk to you about how we plan on doing so and the cornerstone assets that will get us there and give us a nice launch into that realm. So if you think about where we're currently residing, our cornerstone marketplace, erectile dysfunction. Believe it or not, after almost 2 decades of erectile dysfunction being brought to public by ways of Viagra and Cialis, destigmatizing it to some degree and to a great extent, it is still considered a nascent movement, a nascent therapeutic area for men. And we'll talk about the specific numbers in a second. The global erectile dysfunction market continues to grow. It's projected to reach almost $5 billion by 2026. The US driving about 30% of that at about $1.5 billion. When you think the ED market has met its full potential or has met its maturation, not even close. It continues to grow quarter over quarter, year over year. And the number of men that are gaining the confidence to get therapeutics are starting to mobilize. And a lot of new platforms are enabling them to do so. We'll touch on some of those as well. So we talked about the underserved markets. It's been estimated that there are about 30 million men suffering from erectile dysfunction in this country. And again, I'll go back to the advent of Viagra, Cialis, Levitra, the big players. Billions spent on direct-to-consumer and marketing and promotion messaging. It's touched the realms of Hollywood, and it's become well known. It went from impotence to erectile dysfunction. And yet still, of the 30 million men suffering from erectile dysfunction in the US, only 25% of them are estimated to have sought pharmaceutical treatment. therapeutic treatment. The rest tend to suffer in silence due to stigma, discretion, any number of reasons. They have not mobilized to address their erectile dysfunction. We believe predominantly due to stigma and the hurdle of having to be exposed and vulnerable. We have a pathway towards it. And we talked about the 4.7 billion global potential by 2026. It continues to increase significantly. One key feature that I want to toss in there, we always thought that erectile dysfunction was an issue for 40 plus, men of age 40 years plus. It's actually been recently identified that nearly a quarter of the men that are emerging with erectile dysfunction are now actually under 40 years old. So even the younger gentlemen of the U.S. are starting to step forward and looking for therapeutic value. So the market has greater potential to expand into those younger years as well. So we talked about how it continues to grow. We talked about the 30 million men. We talked about new platforms that are enabling those men to seek treatment in a destigmatized fashion. We're nowhere near ideal or optimal, yet the FDA has recognized a few different pathways, Ensure being one of them, non-prescription safe use regulatory expansion. This is essentially taking a prescription drug and adding a technology to it that enables a person, a patient, to capture that therapeutic without a prescription. That is in existence today in dialogue with the FDA across many different therapeutic areas. That's one platform that's of interest to us and of potential. The zenith of the potential, we believe, is the over-the-counter switch from a prescription medication to becoming now over-the-counter accessible to the consumer of choice. We think that the way to mobilize the silent sufferers in erectile dysfunction will be to attain, for the first time ever, over-the-counter designation for a prescription erectile dysfunction medication. And I'll touch on ours, our brand in a second. That is our goal. We want to be the first movers in the space. We believe we're equipped with both the talent, the pathway, and the molecule that will enable us to get there. And there are a number of emerging technologies that we're currently also sifting through to understand how do we make this therapeutic available to millions of men without the hindrance of having to be exposed or vulnerable or having to go through that uncomfortable initial dialogue. We'll touch on that in greater detail. The brand, Stendra. Stendra today is in market and commercialized. It's available in just about every pharmacy across the country. It is distinct and patent protected, the last standing prescription grade erectile dysfunction medication that is patent protected and remains in market. And if you'll recall, and if you've kept up with our press releases, you'll know that we have an exciting collaboration with 4Hims. We'll dive deeper into that in a minute. But on the 4Hims platform, we announced that we had exponential growth. Year over year, we saw nearly a 470% increase in prescription tablets dispensed by way of 4Hims. That's remarkable. Stendra is alongside generic Viagra, generic Cialis for different price points, and yet the consumer continues to select Stendra for any number of reasons. A very exciting indicator of what Stendra should be, can be, and will be in prescription world. And so we'll dive deeper as to why we think Stendra has the potential of becoming the first mover in the over-the-counter space as a prescription-grade erectile dysfunction medication. So imagine for a moment, it's 9, 10 o'clock, you have your local grocer, to be able to go down the street and pick up a prescription-grade erectile dysfunction medication from your local pharmacy. That is our vision, and that is our mission. It is ad hoc, it's on demand, it's truly accommodating to the lifestyle of a gentleman and the events that occur that warrant this type of therapeutic and medication. And we think by doing so, we'll actually engage men better in their healthcare by giving them an opportunity to purchase it based on their own efforts without having to have that prescriber intermediary. That is our goal. If you've kept up with our press releases, we recently announced that we've executed a draft over-the-counter label. We've also taken that over-the-counter label into a pilot label comprehension study. These are required by the FDA. We had good results that encouraged us to move towards a pivot grade over 450 patients label comprehension study. That has now been completed, and we're moving into the next phase. which will be ultimately the self-selection study, and that will be coming to announcement to fruition soon. So stay tuned. In addition to the landmark achievement of potentially bringing a prescription-grade erectile dysfunction medication to over-the-counter status and access to millions of men across the country, the first of its kind, unprecedented, we're also pursuing this landmark achievement towards Peyronie's disease. We'll talk about the therapeutic in our portfolio that addresses Peyronie's disease. Quick background on Peyronie's. If you have not heard of it, Peyronie's is a fibrotic condition. Micro injuries to the penis cause scars and collagen-based formations that ultimately deform the penis in a multitude of ways. This is tremendously debilitating to the gentleman and their partner, and that is unacceptable. Today, the treatment options available to that individual are a series of injections, FDA approved, and certainly the gold standard of today, invasive surgery, and devices, traction devices and the like. Beyond that, the gentleman has no option for something that is an early intervention, something that could potentially still be leveraged even in the stable or chronic phase. Our goal and our mission is to find that therapeutic, hence H100. This is the first prospect that is in gel formation and has actually been proven in a pilot study, a small, well-controlled pilot study with multiple endpoints showing positive results from both from mean stretched penile length increase of 22% to mean curvature reduction of 40% and pain level reduction by about 86%. Remarkable early results in an investigational pilot study. We are now working with the FDA to understand what is our development roadmap. If you've kept up with our press releases, we recently announced that we are approaching FDA with a roadmap that includes the potential for a 505(b)(2) approval, which could significantly help abbreviate or make efficient our developmental roadmap. And more on that will be announced shortly. If approved, this topical gel would be the first non-invasive therapeutic in this highly invasive marketplace of Peyronie's disease. Stay tuned. This is another landmark achievement that we hope to execute in the very near future. Another portfolio division within our organization is within the device industry, the device specific to ED therapeutic industry. We have two flagship brands known across the country and really across the world, Osbon Esteem and Postivac. They both have automatic and manual versions, multiple accessories that go with it. This is essentially a vacuum erection device, also known as an induction-inducing device. This helps infuse oxygenated blood within the penis to organically and naturally induce an erection. This could be done for therapeutic purposes, for example, post-radical prostatectomy, or it could be done for on-demand leverage and utilization for sexual engagement. These devices have been around for some time, and they continue to be the top performers and most credible brands, especially around physician-based prescriptions and recommendations. We have ambitions to take this device portfolio, modify, and do some remarkable technical and technological enhancements to it to take the patient empowerment to self-treat with these devices, to self-condition their penile health to new heights. And that is something that we are constantly working on to continue to bring this division to its full potential. So we talked about over-the-counter, and early on in this presentation, I said we believe we have the right talent as well as the right molecule. So in terms of the molecule, I'll encourage everyone to go check out Stender.com, take a look at our clinical trials, take a look at our promotion and our messaging, also with the important safety information attributed to it, and understand some of the distinct features of Stender. As for talent, we have a tremendous board. Within that board, we have John Schulman, who is our executive chairman, and he is also founding partner of Juggernaut Capital Partners. And Greg Bradley, president and CEO of Foundation Consumer Healthcare, a company within the John Schulman and Juggernaut portfolio. They brought Plan B one step from prescription to over-the-counter. driving it to become the #1 selling SKU in the country. So if you're not aware, Plan B One Step is emergency contraception. And if you look at the prescription base prior to over-the-counter status, you'll see a very different scale of utilization versus when it went over the counter. You'll see a robust movement of patients who are unhindered by having to make an appointment with a clinical practitioner, and were able to acquire it over the counter. It mobilized millions and again became the #1 selling SKU in the US. This team has the network, the talent, and the resources, and they understand how to take something in a highly complicated path and to bring it from prescription grade to over the counter, working alongside the FDA. We are happy to say that this is these two individuals are a key component to our board and to our competitive strategy and differentiating strategy and competitive advantage. Let's take a look at them a little bit closer with a little bit of history for my background as well. I'll quickly mention John Schulman also has within his portfolio brands like Vosswater, Zoa, which he partnered with Dwayne "The Rock" Johnson on recently launching. If you haven't checked, obviously the Rock's Instagram page, you'll see Zoa featured amazingly. Those are the sorts of brands that John Schulman's associated with, and we're excited to be a part of that consumer intensive and consumer savvy team and ecosystem. Greg Bradley has a tremendous history. From GlaxoSmithKline to Advantage Consumer Healthcare, Greg has a number of products that he's taken from prescription to over-the-counter status. He's well versed in that process, and we've actually seen that the FDA is in tune to that process. They recognize that the consumer wants to have more control over their healthcare, and Greg Bradley and his network is very well aware of that, and they've been strong advisors, continue to be significant contributors. I've had the fortune of being a part of the pharmaceutical industry now for a little over 20 years, and I've been a part of tremendous organizations like Merck, Endo, most recently Adapt prior to joining Petros. These companies brought first-in-class innovations and in many ways defined the new marketplaces. I'll go from anywhere from cardiovascular diabetes all the way to men's health, to ICU grade antibiotics by way of Merck, and most recently by Narcan nasal spray with Adapt Pharma, where we actually were able to take naloxone, a key component for rescue as a rescue modality for opioid overdose, to a simple intranasal, and it became a remarkably chosen asset and therapeutic across the country. We are in tune and highly ambitious to do a number of landmark achievements, with a cornerstone of taking a prescription Stendra to over-the-counter designation, potentially alongside the FDA, to launching the first potential topical gel, non-invasive, in the Peyronie's landscape. We have our sights set on a number of landmark disruptive technologies and biologics to follow. So exciting team and exciting prospect. Quickly review, we have rapidly growing revenues, patent protected and commercially viable and in market today Stendra. We have the first ever potential candidate for Peyronie's disease, and stay tuned for our device division and the projects we're undertaking from that perspective as well. It is a relatively low cost of entry in terms of purchasing share, and we've demonstrated nice market responsiveness and greater trade volume of our shares. I'll stop there and see if there are any questions that I can address during this call.
Hey, if you got questions, whoa, weird echo there. If you got questions, now would be the time to drop them in for Fadi Bakhtor, the president and the CCO of Petros Pharma. Don't worry, guys. Funware is up next. I see some people in chat. Let's one thing at a time here. One thing at a time. Fadi, just to sum it up here. First off, whoever was the person in chat that was asking about Petros like all day today, if you don't have a question, I'm going to be very angry at you. Let me see. Firot King asking how much do the devices cost?
Devices today in market will cost anywhere from $150 to $300 per device.
Okay. Let me see. I don't remember who the person was that was asking about PTPI like all morning. Wherever you are, speak now.
Spencer, I got a proactive question that I know is often asked if we want to give him a minute to show up.
Yeah.
So it's the pathway. How do you take a prescription to OTC? I'll give a quick 15-second overview. The FDA essentially requires 3 different pivotal studies. So label comprehension, self-selection, and actual use. And some of them will require a couple of iterations, but that is essentially the roadmap and taking the FDA along the way. We want to be able to communicate to a low health literacy population to self-select appropriately without a physician intermediary.
Awesome. All right, Fadi, back to our Petros Pharma. Fadi, always a pleasure, man. Thanks for coming on the Benzinga Small Cap Conference today.
Thank you, Spencer. Good to see you again.
All right. We have come to the portion of the day you all have been waiting for. The part where I sit here and just fill time for 20 minutes, right? You guys don't want that. You guys want to do like a crypto update? You want to look at some stocks? Should we play a commercial right now? What are you feeling? No? All right. Not feeling any of that. That's fine, I guess. All right, let's bring on Randall Crowder, the COO of Funware. He's here. Hey, there he is.
What's going on, Spencer? How you doing? I would take you up on that. I love when you dive into crypto and stuff. You know me. I'm ready to go.
I mean, I can read, the Berkshire Hathaway annual report out loud. We can do that. We can do lots of things here. Nobody seems to want that though. So with that being said, I will just see myself out of here and let you do it.
Yeah, Spencer, this is a swan song. This is the last time I think I'm going to give this presentation. I want to say thank you to Benzinga. Y'all have done an amazing job building an incredible community, especially of retail investors who actually want to learn about the companies behind the ticker, behind the meme. And I think,
thank you.
Hats off to y'all's team. I have loved, just getting to know a lot of the folks across the Benzinga universe. And so for me, this is always, very hard because there's certain things I want to really talk about tactically, but then there's so many new people coming into the Benzinga universe that I feel like I got to kind of, start from square one, because you got to really understand who in the hell Funware is. Why is everybody so excited about it? And so I'm going to give this presentation, one more time for the people who are new to the story. And then next year, it's going to be a new one. So stay tuned.
All righty. Let's get.
All right. So for those of you who don't know me, COO, Randall Crowder, I'm going to go through a quick disclaimer, agenda. But this is really what I want to start off with. Many of you guys have to drop off. In the Army, you always kind of give a bottom line up front or front bluff. It is an inflection point in our history right now, and this is why. And so we have a $60 million plus war chest. We just did 50% growth in Q3. We're on track to do over 100% growth in Q4. One of the big things that I think a lot of people are not paying attention to, and a lot of people didn't pay attention to me when I told you that $1 a share for Funware was a joke. The people who did pay attention to me are still sending me thank yous. I'm telling you, where we're at now, I feel like is a joke. And this bullet right here is one of the big reasons: indirect channel activation. We've got a partnership with Carrier, a $20 billion heating and cooling giant. We've integrated our software into one of their flagship products. And I'll talk about that more in a little bit. Cox, Cox Enterprises, y'all know them, broadband, telecom, multi-billion-dollar company. If you Google Cox ProSite, they're playing in healthcare in a big way, and we've partnered with them on that. HID, access control giant, another multi-billion-dollar company, part of Assa Abloy. If you have swiped a key card or a key fob to open a door in the last 10 years, I bet you it was HID technology. We've got they're licensing our smart workplace solution. So, this is how we scale fast. This is how we start building, a indirect channel business that's high margin, and we start ramping revenue. It's activating these indirect channels. And then, it also makes julienne fries, right? So blockchain, everybody loves blockchain right now. But we've been doing this for a while, and we've been doing everything methodically and correct, because the future of blockchain rests with real companies solving real problems in the real world. And that's what we're doing in a compliant manner. So not only do we have a feature-rich mobile application portfolio that we've begun to deploy called Fun Wallet on iOS and Android. Download it today. We've got FunCoin, a security token, which we're working with Securitize on. We have Fun Token, which is probably what you're more familiar with, a utility token. And I'll talk about the interaction of all those pieces here in a second. And along the way, one of the things that we didn't do a great job of, and I think it's why so many people got really great entry points into our stock over the last couple of years, is we didn't play the game. If you're going to be a public company, you got to play the game. You got to be able to get your story in front of people. And it's a what have you done for me lately type of environment. You got to keep pushing that story. That's why I keep giving similar presentations and talking to anyone and everyone who will listen. That's why Alan does the same thing. We're excited to have new research coverage from Roth Capital and H.C. Wainwright, joining Taglich Brothers and Ascendiant. We also have a lot of great new IR initiatives with Gateway, Grosso Global, Barretto Pacific. This is all about sharing our story with a broader community, both institutional and retail. That's how you generate that slow, steady up and to the right, limiting some of the volatility, which can be a little daunting for some institutions. But we're seeing really great stock price appreciation, volume and liquidity. We've been a top gainer on NASDAQ multiple times. You can't pay for that kind of commercial. So people should be thinking in the back of their mind, wait a minute. You've got a company that did $6.5 billion in trading volume in a single day. What could they do if they start swinging hard in the cryptocurrency space? If they start swinging hard with their security token or their utility token, it's a lot more than a coin with a variation of a dog on it. We've got a lot of interesting things going on. So, I get it. A lot of people have maybe come for the meme, but stay for the company. So without further ado, let me tell you exactly what we do. We've been around since 2009, before the App Store. We helped Apple think about what the App Store would be. We helped large brands transition from web to mobile. It was a huge idea back in 2009. We helped build the first NFL app, the first NASCAR app, all of Fox's mobile application portfolio, Sochi Olympics, WWE. These are the passion verticals. They were the ones that understood how important mobile would be to reaching consumers, because it was always connected to a human being and always connected to a network. Fast forward to today, now everybody's thinking about digital transformation. It's not just a big screen to consume content, watch movies, fight with people about politics or mandates. It's a powerful computer that happens to be mobile, that happens to be connected to a customer and connected to a network. So it's no longer good enough just to have a mobile application. It's what are you doing with it to not only engage your ultimate consumer, but how are you engaging them to drive profitable behavior? And that's what we're trying to do. We're trying to build a platform to drive your digital transformation initiatives, which is exactly where the world is headed right now. People always ask about COVID. By any industry account, COVID has actually truncated the adoption curve for things like what we're doing by 5 to 7 years. So we're seeing a lot more activity. People who used to think it was a nice to have are now starting to get, oh, wait a minute, this is a must have. And so I'll explain more about that why. But really, if you want to think about easily what we do, you've been watching it in the movies since probably before you can remember. So Tom Cruise, Minority Report, walking through the mall, all the advertisements are personalizing to him. He walks up to the Gap of the Future, a hologram pops up, talks about his purchase history. That's digital transformation. But it's really easy to do in CGI. It's very hard to do in the real world. I know, because we've been doing it. We live in a very connected world, but we exist disconnected from it. Think about the last time you went to a grocery store. Maybe you cross an RF signal to open a door. Maybe you swipe a credit card to leave, but that's it. I mean, at least in my world, maybe if you visit Singapore, you see some of this, but at least in my world down here in Austin, Texas, I don't see any personalized holograms. No computers are talking to me, and I'm just wandering around the grocery store buying stuff I probably don't need. This is the problem. We need a software layer to bridge the gap between all of that technology in the real world and digital transformation. We need an internet of experiences. That's what MaaS is. Multi-screen as a service. It's an enterprise cloud platform that will allow any brand to get the right content to the right customer on the right screen at the right time in the right place. It's game changer. This is the future. So all of these other meme stocks that you guys are chasing with bygone business models, come join the fun, because this is the future. This is where everybody is headed. Every space will be a smart space. Every engagement will be tech enabled. So in a world where all of the products you get are Amazon enabled, I want all of your experiences to be funware enabled. And that's a big idea. And we're getting it done across a lot of industries. Really what it allows anybody in almost any vertical to do is to standardize on us. That's a huge competitive advantage. When we were doing that passion vertical work, we were getting 30-40% gross margins. We raised over $100 million as a private company. We built a platform that will allow any brand to standardize their mobile ecosystem on us. Their mobile ecosystem designed for engagement. And so just like you can license a CRM from Salesforce, or you can standardize on AWS, you can now do that with Funware. So we can give you a fully feature-rich mobile application portfolio on iOS and Android, and we can do it in probably a week or two, and we can do it at 75% gross margins. That's a game changer, especially for shareholders. If you're looking at, how do you really scale? You got to be able to do this fast, and you got to be able to deliver on the tech-enabled experiences that these industries want. So, when we got our start in passion verticals, here's where we're focusing now. It's a lot of folks that were kind of late to the mobile game. A lot of these folks have been getting by with websites. Maybe they're optimized for mobile, or just really basic kind of content-driven apps. Now they're thinking, okay, how do we standardize operations on a mobile ecosystem? How do we really tech enable, our customer journeys? So hospitals are huge for us. Smart spaces, retail, hospitality, corporate campuses, politics. I know everybody loves to talk about politics. Politics is huge. How are you going to engage your constituency? And that's really becoming interesting for a lot of people to own that platform. That's the same reason why, healthcare, they want to own that platform, be able to own that engagement with their patients. And then we still see some media and entertainment just because we have such a long lineage in that. Think about this, the hospitality experience. Nobody wanted to do this before COVID. Certainly nobody wants to do this now. This is the kind of pain point that we solve. We'll send you digital keys directly to your phone. Use your phone to access the elevator. Use your phone to access your hotel room. Later on, while you're walking around the property, say like a big, large Vegas casino, or we're launching in Atlantis in the Bahamas, you can actually have a live, immersive, interactive map. Now start thinking about like augmented reality experiences, but there'll be more on that next year. You can think about booking amenities, scheduling events. Lord knows if you've played, any sort of game in Vegas, they never seem to bring the waiter or waitress to you when you need them, and you're always asking for them and craning your neck around. We solved that. Order food or drink, anywhere you are, and they'll just bring it directly to you. You just enjoy your experience. That's tech enabling the experience. The mobile app is not about booking a hotel room. It's about getting the most out of a real world experience by tech enabling your journey. That's the future. Hospitals. If I know by looking at your EHR, you have mobility issues, I can have a wheelchair waiting for you when you arrive. But how does that all happen? I have to have an enterprise cloud platform that not only integrates with asset management system, but understands the patient's needs, understands the patient's location, can bring that all together to make that engagement contextual. That's huge. We do it for employees. There's a lot of talk about returning to work. A lot of Fortune 500 companies right now are thinking about how to tech enable the employee experience with Funware software. We're doing a very large deployment for Norfolk Southern, one of the largest railway operators in the world. They're building a brand new, beautiful headquarters in Atlanta, Georgia. And they wanted to basically have, I'm dating myself now, but a tricoder. Turn your phone into a tricoder a la Star Trek, everything managed by that mobile ecosystem. That's a really key thing to understand about Funware. We're not one app to replace them all. We're one app to rule them all, because every building, every industry, every customer is going to have different vendors they work with. So Norfolk has somebody they're working with for parking management. They're using Microsoft for their conferencing and scheduling, somebody else for access control, somebody else for vendor credentialing. We bring all that together because, again, you're standardizing on our platform, and we give you one single sign-on, one seamless mobile experience, and you get access to everything that you would need being on property, at venue, or engaging with the brands that you know and love. So I'm going to go through this fast. We are no longer a digital agency, but a lot of people still do that. Low margin, non-recurring, no thank you. A lot of people always ask, what about the big boys and girls? Look, at the end of the day, you could throw enough money at something, you probably damn near do just about anything. That's not where the customers that we target want to go. You know, a hospital system is lucky if they have 1 or 2 people with CS undergrads. They're not trying to stand up a 15-person dev team and engineers to manage an SAP instance. They're just not. So they love our ability to just give them software out of the box. They can focus on their business. We'll see some people here and there, point solutions or by industry, smaller players like Purple, do a good job with kind of content management, but they don't have some of the features that we have that really drive engagement. Probably our best competitor is going to be someone like an Accenture. And it's somebody who we actively work to partner with. So, you know, a lot of these folks don't have, like I said, engineering teams. So they'll say, look, no one got fired for buying IBM, but I don't want to buy IBM or manage IBM. So I'm going to hire a consultant to go figure it out. And they'll cobble together a bunch of point solutions that were never meant to be interoperable. We solved that pain point. We are out of the box, outsource end-to-end solution. It just works. Everything comes pre-integrated. You get access to everything. We can either license specific features from us if you already have a mobile application, or you can license optimized solutions. And so those features come in 2 flavors, you know, software development kits or application program interfaces, or you want to take the guesswork out of it. We've already got optimized solutions. You can license those full tilt, and again, just go to work. And so you can not only license it for a customer, but you can also white label it. So a lot of the indirect channel partners that we're talking about, that's what they do. Location is a huge piece of this. So that's a competitive advantage for us. We beat Google for Kaiser Permanente's business. We did it on a cruise ship after 3 or 4 other vendors failed. The ability to find a mobile device in 3 dimensions indoors is a huge problem. A lot of people can't do it. Sub 1 meter accuracy, sub 1 second latency. I can't engage what I can't locate. We've done it for a lot of customers across industries. But even more exciting to me than this slide is this slide. It's going to be our indirect channel partners. That's how we scale. And so, whether it's hardware vendors, software vendors, system integrators, or carriers, these are the people who have already a huge distribution network, great sales teams. So we want to really, grab that tailwind, work with them. So we've been doing that over the last 12 to 18 months. We didn't chase revenue, we chased partnerships. So hopefully revenue will chase us. And we've been successful signing up some pretty big partners. Like I said, Cox, Carrier, HID. You'll note, Carrier's not on here. Everybody's always screaming at us. Why can't we talk more about our customers? Why can't we talk more about our partners? A lot of it's contractually obligated. We told Carrier we wouldn't use their logo. And so a lot of times, we are beholden about what we can say, about what we can do based on, the contracts that we execute. One thing that a lot of people don't realize about us is we're also a data company. So we have a customer data platform that is pretty impressive. One of the early hypotheses of the company was, could we create a Phunware ID for every human being on the planet with a mobile device touching a network? So far, we've generated about 17 billion with a B Phunware IDs. When operating at scale, our platform manages about 1 billion active devices at a time. That's huge. And so we thought, how cool would it be if we could blockchain enable that? If everything we're talking about today is contextual engagement built around mass, and I can engage you if I can locate you, it's also very helpful if I can identify you. So the concept of FunCoin is this idea of owning your data, giving control back over to users. Every time your data is sold, I want to pay you. It's your data. You should be cut in on every single time someone makes money on you. Along the way, though, there's this idea of Fun Token, the value of engagement. If Fun Coin is my gold mine, then Fun Token is going to be my picks and shovels. So every time I engage you, every time you click something, like something, do something, you're informing your data profile, you're making it more valuable to a brand. You know what? I'll reward you for that as well. So that's a utility token. You can get it right now, buy.funtoken.com. In the next couple of weeks, you should see FunCoin on Securitize's platform. All of this dual token economy is managed by FunWallet on iOS and Android. You can download it today. And so we're trying to move away from this concept of, I want to surveil you and exploit your data and I'll make money. You just, pat you on the head and, go check out some social media feeds. And that's all, you get out of the deal. The future of data is a decentralized data economy that puts consumers first. First party data, brands managing consent, you're in charge. And we're building the platform to deliver on that. It's a huge idea. And we're now managing 2 really exciting crypto assets. How do you even value a public company with that kind of, asset on its books. I'm excited to see it. So how does this all come together? Let's say I'm a cruise ship. I want to locate a bunch of people to engage. I might buy data. And then in this particular case, it's location data. So I'm identifying the people I want to get content into. I'm going to pay you with FunCoin. But the cool thing is we can white label our blockchain ecosystem. So you can call it whatever you want. Call it Cruise Coin for all I care. Once we've identified you, maybe we want to engage you with some really rich content. Maybe I want to try to sell more excursions to you while you're going to be on your trip. So now you get a push notification that says, earn Cruise Coin just for watching this video. So now I'm engaging you. That's going to be a different asset. So I sold your data. That would be theoretically run by FunCoin. I engaged you. That could be driven by FunToken. And then, we'll let you spend that while you're on your trip. You can go buy a drink. You can go, buy some merchandise. And so you kind of close that loop on an ecosystem where now you're putting consumers first. So this is a huge idea. It's not a pivot. We're not pivoting to a blockchain company. We're an enterprise technology company that is being built to better engage people, but being able to engage people where they're in control. So again, that concept of decentralized data economy, contextual experiences, and we got a lot of really exciting things on the product roadmap, and that's why I'm going to change this presentation and talk about kind of going forward things like augmented reality, what we're doing to enable a lot of this movement towards the metaverse. Really exciting things when you can think about digital identity and ensuring that that identity is sovereign and ensuring that people are part of that conversation. Really excited to be able to leverage our platform and all of our experience in order to do that. Be remiss if I didn't say follow us. Investors.funware.com is a great resource for everything we push out. At FunToken, at FunCoin, at Funware. All these are great. You can find us on Telegram, same thing. And so please, follow the company, reach out, really learn about what we're doing. It's so much more than just a meme or just a spike because of a PR or any one customer. There's a lot that we're doing, and we're excited that you're learning more about the company. So with that, if there is time for any questions, happy to answer them. Spencer, happy to talk to you for a little bit, or we can virtually arm wrestle.
We could do that. I don't want to do that with you. No. Let's do this. We do have a few questions. Surprise, surprise, from the chat. So let's get to a few of them right now. Can you ask him, referring to you, Randall, ask Randall how he plans to always protecting users' privacy and getting consent to a user allowing Funware to track, ingest, and digest and use their digital footprint to
I love it. So first and foremost, our customer data platform is built around that, right? So we've been doing this longer than most people. So when we have over a petabyte of data that was at scale is growing at about a terabyte a day. We work in healthcare, which is managed by HIPAA. We're already GDPR compliant. We're already CCPA compliant. We're already taking it one step further. And look, I know everybody talks about it, so I don't mind mentioning it. We did the presidential app for Trump, and we never got hacked. We had a lot of attacks, never got hacked. So how you manage data, how you manage privacy, just has to be woven into the culture of not only your company but also the technology. And so far, we've done it in every vertical, and we've done it well. Now, going forward, there's a lot of really exciting things that we're going to introduce using blockchain, like NFTs. And so being able to have that kind of identity tied to who you are, but then just like you get royalties on artwork, we'll give you royalties on your data. That's going to be exciting.
Several questions all related to the same thing. What is the nature of your relationship with the DWAC?
We no comment. We don't talk about customers. Everybody's, for those that are new that keep wondering what's going on, we pitched our services to Democrats and Republicans. We are a platform for engagement. We don't touch content. We don't do content. So, the Trump team in 2020 had their own content. We gave them a platform to better distribute and engage with that content, especially being a mobile-first world that's quickly becoming mobile-only. And so now, obviously, a lot of people, wonder what role we'll play in politics going forward. And we'll just comply with Reg FD and report on that, as we can.
This is an interesting one. So can you, wait, what was the question? Okay, so it's more of a clarification question. Would multi-screen as a service basically just use the digital footprint of your cell phone as you walk into a store to just give you personalized ads or coupons? Is that the idea?
It can. And so, but you're in charge, right? So anytime, so think about even the workplace example. I might want to share my location while I'm at the office, but I don't want to share my location when I go home, and I don't have to think about turning it on and off. So that automated switching has to be part of any platform that's going to, basically gain mainstream adoption. But yes, once you're in, a store or a smart venue, you'll be able to be engaged. And it's not like, don't think of it like banner ads. It's more about like I'm walking past a restaurant and they're going to say, hey, if you book now, we'll give you 10% off. Or I'm walking past a store, hey, we've got a special, buy one, get one free of XYZ.
All right. And then last one here, Randall, and this is the one that everybody wants to know. Speculation.
I thought the second question was the one everybody wants to know. There's a more.
Yeah, this is okay. There's two. This is the other one here. There's speculation about you and the mayor of Miami. Can you address that at all?
We did meet with them last week. I gotta tell you, he gets it. How he's bringing together hospitality. Almost creating a digital chamber of commerce. We have a smart city solution that we launched at Pasadena. And Miami would be a perfect example. You think about what he's doing with city coins and Bitcoin, his tech forward approach to hospitality, his how can I help, Twitter campaign. So, a smart Miami that is funware enabled would be a pretty cool thing. And so we were excited to, begin having that conversation with them for sure.
Okay, Randall Crowder is the Chief Operating Officer of Funware. I think I got to most of it, if not all, the recurring questions in chat.
I thought you were going to ask the most important one. It's like, where do I get that awesome shirt that Randall's always wearing?
No, actually, in all seriousness, how's your arm thing doing? Is that better?
It's good.
Okay, it's better.
Healing nicely.
Better.
It's healing nicely.
Yeah, now I definitely don't want to arm wrestle you. All right, Randall, always a pleasure, man. Have a good rest of your week.
Appreciate you, Spencer. Take care.
Thanks for coming on the Benzinga Small Cap Conference today. Everyone, guys, smash the like. If you're in here for Randall or any other company, do us a solid. It takes literally 1 second. Just hit the thumbs up button. It looks like that. That's what it looks like. Just hit the button on YouTube. It sounds dumb, but it does help. I hate asking like that, but it really does help. Because I feel like a schmuck, but here we are. All right, let's move on here. It is 2:21. Our next presentation, our next speaker is here. Kunal Chopra. There he is, CEO of Caspian Holdings. Kunal, how are we doing today?
I am doing good. How are you?
Doing fantastic. I see your slides. There we go. I'm going to step off here and let you do your thing.
All right. Well, thank you, Spencer. Appreciate you having me on. Well, again, thank you again, everyone. I'm Kunal Chopra, Chief Executive Officer at Caspian. We trade under the NASDAQ symbol KSPN, and excited to share with you today what the company's been up to, what our plans are going forward. Of course, before getting started, I'm going to make some forward-looking statements. Just want to make sure that every investor here on the call is fully protected. So let me start with just giving you a very high level on the company, what we do at a big picture, and then get into details right after that. But the best way to do that, I've realized, is to show you a video aligning very well to our mission, which is to optimize and grow brands on today's leading online marketplaces. So let me start by just playing you this short video.
Hey, just FYI, Kunal, there's no audio to this video.
Oh, you're not getting any audio?
Not getting any audio. So just tell us what it said. How about that?
I think I'll just skip that then. If you've missed the audio, the whole purpose of that will be lost. So yeah, I'll just tell you exactly what the video said. But big picture, Caspian, at the end of the day, our mission is to grow your brand on today's leading online marketplaces such as Amazon, Walmart, eBay, Target, among others. And we provide a complete platform of software, tech-enabled services, multiple business models to help brands grow online. As you can see on this slide, we pretty much are your single integrated back office solution for brand growth and optimization. Whether it comes to everything on the demand side, digital marketing, creative services, anything on the supply side, when it comes to inventory management, supply chain management, and anything in the middle, brand protection, data and insights, account management, compliance with taxes, and doing that across multiple marketplaces and doing that globally, your one-stop shop for everything marketplace growth is what Caspian is all about. Really, our vision for the future is to be number one in gross merchandise value, GMV, in a very highly fragmented seller services market. And seller services are specifically those companies that help brands grow businesses online. We think that we've got the right technology, the business model, the set of services fully connected into one platform to facilitate this long-term vision for our company. The landscape right now is an extremely fragmented market. As you all know, you're hearing a lot about the Amazon seller ecosystem in the media. There are 1.6 million active Amazon sellers that represent more than a $300 billion GMV market opportunity. And these folks completely dominate the Amazon marketplace. The total GMV as a percentage of total sales on Amazon driven by third-party sellers is more than what Amazon retail drives. And that has continued to grow on since 1999. It's more than 60% today. It's all coming from third-party sellers. Over time, I predict that we will see Amazon move into more of a platform company as being retail only. And it's extremely fragmented, as you can see on that top right graph there. There are tons of smaller sellers and there are a few large sellers. That really represents the opportunity in front of us, is to help consolidate this highly fragmented market. Here's our history as a company. We started off in 2013 as greencupboards.com, reincorporated that company into eTails. And as eTails, what we were doing was really just focusing as a seller ourselves. We were one of those sellers that you saw in the previous chart. We were just using the third-party marketplace, and we were one of the first few sellers on the platform. And at the time, there was really no technology available. So we built everything in-house. We've been collecting data. We've been using those data to create more insights, building our tech know-how on top of that data to perfect that system to facilitate our own business. Over time, we were acquired by a company called Transworld Entertainment. I was hired as CEO of eTails. We diversified our business model to now become more of a one-stop shop platform, leverage the technology that we've been building over time, and really repositioning ourselves as a platform company to facilitate multiple marketplaces, multiple business models, multiple integrations, and truly becoming a one-stop shop. We rebranded the company recently to Caspian last year from eTails and Transworld Entertainment. And over time, we have now facilitated this growth strategy where we hit $1 billion in lifetime revenue earlier this year with a focus to expand to multiple marketplaces, countries, categories, introduced a number of different new business models, including a new brand acquisition strategy, raised capital earlier this year as well, and we're well positioned, we believe, for growth in the future. So what are these seller services? I already defined what that is for you, but really they are all the companies that help brands build their businesses on marketplaces. It's the seller services industry. Our goal is to create a one-stop shop marketplace growth platform for optimization and growth. We are one of the pioneers when it comes to the seller services market, and we have the right value proposition of all the services, technology, software required for a brand to build their business online. And this matters a lot because you know that we saw this acceleration in e-commerce happen during COVID. Then there were supply chain issues that the industry is facing this year. And again, a service like Caspian that includes the know-how, software, and technology all coming together can really help brands take advantage of the tailwinds in this space, but also help them through headwinds that come when it comes to supply chain issues, for example, like we're seeing in the industry today. So let's talk a little more about our platform very specifically. The Caspian platform is driven by proprietary, built in-house completely by us, artificial intelligence-based software, and it powers predictive insights, automation, and efficient solutions. Right from real-time analytics, supply chain management, brand optimization, algorithmic advertisement, multi-marketplace integrations, multiple category integrations, all sit on top of our AI-powered software and technology. It's pretty much a one-stop shop technology platform that has a bunch of connected services. And that's how we differentiate ourselves from some of the others in the market out there that claim to say that they have the best tech. We've got technology, but we've layered on top of that connected services to create a true one-stop shop platform that is extremely customizable and very comprehensive. Comprehensive because we can support everything out there, everything on the supply chain, multiple marketplaces, multiple categories, and customizable because we can customize it because of our services for every brand out there. So we're not just a cookie cutter shop, we customize our offerings for different brands. Now let's talk about the business. So that's our platform. That is all the software, has the services. Now let's talk about our business. How do we actually make money on top of that platform? We've got two core business models, and they're subdivided into two smaller business models with them. On the left-hand side, you'll see that our core business model is what we call retail, where we own the inventory. This is where Caspian will buy the inventory from brands, and then using our platform, we will sell them on different marketplaces. We also have a slight variation of that model, which we call Caspian Brands. In Caspian Brands, we have incubated our own brands as well as acquire brands if the opportunity is provided in front of us. So that's the model in which we have access to the inventory. We hold the inventory, we take control of it, we manage the entire value chain end to end. On the other side, this is where the partner or the brand owns the inventory. And we've got two models here. One is our agency model where we provide them with services. This is a recurring revenue business. We get paid a retainer as well as a small fee of the transaction and the volume that we drive. As well as we've commercialized aspects of our platform for brands to take their own operations in-house. And so pretty much trying to serve brands across the entire spectrum, depending on who they are, where they are, and what their goals are. So let's talk about the first piece, which is we own the inventory. The first model is retail as a service. This is exactly what I said. We buy inventory, similar to a third-party retailer would, and then we sell it on these different marketplaces. We've seen an average increase of 40% in revenue per partner as they come onto our platform. And that's our value proposition to our brands. As you come to us, we can increase your revenue by 40%. That's what we've seen as part of our data. It's a simple model. We use our platform, we buy the inventory, and we sell it. Then a variation to this model is Caspian Brands. We've used our own platform. We've found opportunities in the market where there were gaps that existed, and we used our platform to be able to incubate our own brands. And these are some of our brands that you see on the slide. Jump Off Joe, Keto the Great, Koi Beauty, Big Betty. These are brands that we have incubated and we will continue to incubate over time. And again, our platform helps us identify gaps. We've got relationships with multiple contract manufacturers, ordering, reordering products, etc. A variation to this model is our brand acquisition strategy. We've also realized as part of the evolution of a brand's growth path is to exit at some point of time. And if we find that that's a good way for us to be able to control the entire value chain, be able to access a better margin profile, we've got a number of different opportunities in our acquisitions funnel that we're also actively pursuing to continue to build out that Caspian Brands portfolio, not just through incubation, but also through acquisition. Then if you go to the other side of our business model, which is where the partner owns the inventory, our first model is an agency partnership. Like I said, the partner manages the inventory. We provide you with all the services and the software required for you to be able to grow online. So everything we talked about, inventory management, digital marketing, creative services, all the stuff that we talked about is available for brands to utilize through Caspian, but more in a services model. This is great for brands, and it's sort of sharing the workload between the two brands. And for us, it's great because it's a recurring revenue model. And we also start getting a transaction fee on the volume that we drive. We've seen this business grow 207% in fiscal year 2020. It's our fastest growing business, and it continues to grow pretty well for us. And then finally, we've got software. There are brands that want to take their operations in-house. This is a pure software as a service, self-serve model. 100% recurring revenue. We've already commercialized 3 of our offerings: Amazon Marketing Automation, seller reimbursement, sell and price tracking, and we have more to come as part of our roadmap. So by centralizing all our software and connected services into a single platform, not only are we using that platform internally to buy inventory, to incubate our own brands, buy brands, but also facilitating that in terms of services and software out to the broader ecosystem. And that makes us a comprehensive platform, because not only can we customize every offering for a particular brand, but we can also present it to a brand in a different business model that depends on their goals and where do they want to go. So that's Caspian's brand platform. We truly believe that by positioning ourselves as a platform business, we are facilitating scale and driving lifetime value. The more products that we can get onto our platform, the more brands we can onboard, the more data and insights we get, the more software, services, integrations, marketplaces that we can start putting together, more tailored solutions that we create for brands. That will facilitate even more products on the platform, giving us more data and insights. And that continues to help us build a long-term relationship with our brands. And the flywheel continues to kick in. The more we can continue to build out our platform to be more sophisticated with a number of different services, we believe that this flywheel effect will continue to kick in for all our brands on our platform. But more importantly, we can do this at scale, which keeps our costs down and gives us the economies of scale to be able to do this at an extremely large volume, which is what we have seen over time. And that's what got us to that level of $1 billion in lifetime revenue. Let's talk a little bit about our financials and our KPIs. 2020, $250 million in GMV, 40% growth in our retail revenue per partner. Monthly recurring revenue in our recurring revenue model increased by 180%. 800 brands now that we work with. The gross merchandise value per partner increased by 87%. Improvements in gross profit by 50%. All the leading indicators of our business tell us that we have built the right model for us to be able to facilitate some true scale in the future. We will continue to drive our retail businesses through retail as well as through Caspian brands, but then also continue to drive our fastest growing business through subscriptions, and which includes agency as well as software as a service through this recurring revenue model. In fact, you can look at this right here. Since we started and since we launched this new, more platform-like approach towards agency as well as software as a service, diversifying away from that core original retail model, you can see that almost 50% of our total gross merchandise value is now driven by a combination of subscriptions as well as our retail businesses. So that volume continues to grow up. We continue to diversify more of our GMV into recurring revenue subscriptions like businesses, and we're excited about that portion of the future. In fact, here are some of our LTV to CAC drivers. On the left-hand side, you'll see our subscriptions business. Only a new business, past 2 years, we've achieved an LTV to CAC ratio of 3.3 with a payback period of about 8 months. And on the retail side, it's a lot higher. That's an older business for us. It's been around for a while. 9.5 LTV to CAC ratio, 6 months payback on new customers that we get in. So again, pretty strong drivers of the overall business, and very excited to continue to bring that subscription business closer to what the retail numbers say, as well as continue to drive more growth on the retail side as well. This is what's the beautiful part about Caspian's model. It's because we're so diversified, because we're so comprehensive, because we're so customizable, we have created a value proposition that spans the entire journey of our customer relative to some of the other competitors out there in the market. Initially, brands might want to just focus on manufacturing, and they want to sell to Amazon retail or sell to maybe a third party. Well, that's where we are. Caspian Retail can help there. Caspian Agency can help there. As a brand continues to grow, they might want to take their operation in-house completely. That's where Caspian SaaS comes into play. At some point of time, they might want to exit because they're done and they can't find enough more opportunity in the market. Well, that's where Caspian can come in again. And so by creating a diversified model, we continue to serve the brand as they grow through their journey, and it increases the lifetime value of the customer on our platform. A customer can come in to Caspian for one of our services, and that's where that flywheel can start kicking in, because we can upsell them an opportunity into another service. If they want to change their business model, we can move them to another business model. And the beauty of that is it's all based on the same platform. Once we have access to the brand, once we have access to their data, we can utilize that data, we can utilize that relationship with the brand to be able to serve them in a way that makes sense to them. And that's the differentiator on how we are approaching the market relative to some very cookie cutter offerings out there that you saw on the previous slide. So, my friends, $1 billion in retail sales. Over time, 4,000 brands served. On average, 60% revenue growth in the first 3 months of joining us. You go to Amazon today, 99% positive lifetime rating. As part of our reimbursement program, which we didn't really talk about in detail, $5 million has been returned to FBA sellers. We operate in a $1 trillion addressable market out there. We currently support Amazon, Walmart, eBay, Target, Kroger, and many more coming in as part of our roadmap going forward into fiscal 22 and beyond. So we're really excited about the opportunity and what Caspian can do for the world. We're excited about achieving our mission to accelerate, grow, optimize brands on today's leading online marketplaces. And certainly with your help, we will be able to get to that vision of being #1 in gross merchandise value when it comes to the seller services industry. So I'll stop there, take any questions that you might have, but please contact us at any given point of time if you'd like to learn more about Caspian and what we're doing.
All right, we do have some questions from the chat, but we are up against time, so I'm going to go quick, all right? We're going to rip through a few of these questions here. Kunal, let's do it. Question number 1. In lieu of yesterday, do you guys use AWS as your backbone?
Yes, I mean, we certainly have a combination. We've got AWS as well as we've got our on-premise options as well when it comes to, yeah.
Nice. Succinct question, succinct answer. Number 2, what is your median gross merchandise value, GMV?
So it varies a lot by brand, but I would say it's in that 100K range or so right now.
Okay. What is the rev split across the 4 service lines?
So rev is interesting because right now rev is more geared towards the retail side because we only capture a small piece of the total subscriptions revenue. So on a GMV basis, it's about 50-50. Revenue is more on that 90-10 split.
Okay, awesome. All right, thank you very much. We've been on with Caspian Holdings and their CEO, Kunal Chopra. Kunal, thank you so much for the time today. Thank you so much for coming on the Benzinga Small Cap Conference.
Appreciate it. Thank you, Spencer. Thank you, everyone. Best of luck.
All right. It is 2:42. Let's keep this trains running. Let's keep this show moving. I see our next speaker here, Pablo Diaz. He's the president of Solar Integrated Roofing. I wonder what they do. Pablo, what's up, man? Oh, Pablo, you're on mute. Go ahead and unmute yourself real fast. Within the StreamYard window, you can see you're on. There's a mute button at the bottom there. Should be highlighted in red. Should be on the bottom left-hand side. It says mute. There will be a microphone icon. Let me see if we can do it on our end.
Oh, there we go.
Hey, we got you.
Sorry, sir.
That's all good. All good.
New system. There's about 50 of them popping up every week. So
yeah, no kidding. That's step 1. Step 2, need you to share your slides, please.
Absolutely.
I understand you want to draw on your slides. Is that going to be happening?
I sure would like to, if that's okay.
Let's see how that goes. That's never happened before on this show. So go ahead and click that share button. in the middle of the screen there. You can share the screen your slides are on. We will be able to see them once you do that. While that is happening, and while Pablo gets his slides up, get people in the chat. I haven't brought up the Slido for a while. I'm going to do it right now. Let me bring it up on my screen. Actually, no, I'm not, because Pablo just shared his slides. So I'll do it after Pablo. There's a good question on this Slido I want to ask y'all, but we'll do that after Pablo's presentation. So that being said, I see your slides. Pablo, can you go presentation mode, please? There we go. Can you go full screen? This should work. Just maybe click the hide button on there so we don't see that annoying message the entire time.
There you go. Berg. This thing is sensitive.
Whoa. Yeah, there we go. Perfect. All right. I will give you the floor, sir, and let you tell us all about why we all should have solar panels on our roofs.
Sure. So Solar Integrated Roofing is about a 15-year-old company, went public 8 years ago. I'm going to share, since we have 20 minutes, a lot of information to move through. I'm going to try to get to the meat and potatoes of this, of what we are. So on our corporate overview, our current market cap is actually, this is a little bit lower, $220 million in valuation. Our revenue guidance for the year is $100 million. This is a little old, so quite frankly, we're going to be doing about $120 million in revenue. We had a good July, have decent cash flow, which is growing, and I'm going to get to it shortly. But I really want to share with the value of what we bring is our brands. If you look in here, what we are is an alternative energy ecosystem that is self-sustaining, in that we can grow organically with each other because of the acquisitions that our CEO and founder, Dave Massey, started putting together several years ago. He's a visionary. He knew he could foresee where the market was going. I'm going to circle back. The purpose of the laser pen is for this purpose right now that I'm going to share. What is Solar Integrated Roofing? We're a nationwide alternative energy development firm. What we're really doing is creating customers via our acquisitions in EV and roofing and solar. And quite frankly, our roofing acquisitions have slowed down, and we're focused more on alternative energy. Roofing is a great partner because they bring solar customers and alternative energy customers. We source the material, we source the capital, and we outsource the installation process to licensed contractors. In the middle, we sit as the development firm that manages the process for integrity of the process. We're creating opportunities. We're really a development firm that's focused on sales and the capital side of the equation. Through our different subsidiaries, we have centralized services that allow our subsidiaries to grow. Technology. We've centralized HR. We've centralized treasury. We've centralized our finance division, which because in our space, everything requires funding for the most part. 95% of alternative energy projects, it's actually 96% of alternative energy projects are financed so that customers spend $0 out of their pocket, 100% financing. And we've centralized our accounting. And again, in the developer seat, we manage the process for integrity of the process. And alternative energy, if it's gotten a bad rap in the past, it's because there was not enough control mechanisms on the sales side. We've learned from previous competitors' mistakes, and we control the entire closing process, the entire sales sequence. So our financial proposals that are forward-looking documents are controlled. And I want to take a quick moment to take a step back and look at really what that means for, let me see if this is going to get it all funny here. Let's go back to our brands. We are an ecosystem of self-sustaining companies that have their original revenue streams. Plemco, been in business for 17 years. It's a EV charging unit company. For the most part, it's handled federal projects for that entire space. When it connected with USA Solar Networks, which has a huge commercial solar footprint that has $380 million in development stage, they were able to create an opportunity with Plemco and help them create their commercial division. Now Plemco is taking commercial projects, because every parking lot that we have out there with a commercial entity on its balance sheet, it is a liability. That the reality is, with all the subsidies that are in place for EV charging companies, it should be an asset. That parking lot should be creating revenue. Just one example where we created a new revenue stream. Another example, Future Home Power. They do about $1 million a month in sales. Pardon me, $1 million a week in sales. They're a very dynamic sales company we brought from Vivint. They partnered up with one of our subsidiaries, Cornerstone. They do about 50 roofs a month, but they wanted to get into solar, so they created a division within their infrastructure to sell solar without having to go through the trial and error of learning a new business model. Future Home Power brought their infrastructure. Now Cornerstone is selling solar in locations in which it isn't even licensed. Revenue centers are never expected. They're out of South Carolina and North Carolina, but now they're selling solar in Arkansas. Why is that? They're not installing it because U.S. Solar Networks outsources all of its installations so they can bring installation wherewithal. Again, new revenue centers, dynamic new revenue centers, where this ecosystem doesn't have to go outside of its umbrella to grow organically. Not that it shouldn't, but it doesn't have to, which is lowers our risk assessment. So as CERC is traversing the landscape, centralizing different functionalities that allow our alternative energy companies, our subsidiaries, to focus on origination, right? They're focusing on sales. They're the experts in their industry. They're focusing on sales and installation. These centralized services, though they're fundamental infrastructure nodes, they don't make companies more money. So that's why we've brought that in-house to manage that process, bring sophistication to it. And with our different subsidiaries, we're helping them expand their growth pattern. Our differentiators in our industry, we have been in this industry for 2 decades. We're a national firm. It's focused on origination on the capital side. As I've said, we've outsourced our construction to licensed contractors. That licensed construction is the highest risk assessment in the business model. That's why we outsource that. We can focus on residential and commercial. We currently do. Tons of experience in the construction component of our space. And this ecosystem allows for these new revenue centers that we were discussing in solar, roofing, HVAC, electrical, battery storage. As we all know, everybody, the administration is driving huge amounts of subsidiaries into the space. The Paris Climate Accord Agreement, quite frankly, is about lowering the carbon footprint worldwide. The only way to do that is with all of the industries that we work within. And our ability to scale is not an issue, because what has happened in our industry is a lot of companies focus too much on sales and they don't have the wherewithal to install their projects. Thus why we chose our strategy of outsourcing our construction capabilities. Now we do own some licensed contractors in about 9 markets, and there we do the installations. But for the other 90% of our work, which is in 40 states, we outsource that a construction component. I'm going to go through this a little quickly since everybody could read this individually. We do focus on solar installation services. Clearly, that's a component of our business model. Battery storage solutions. We have some of the best relationships in the industry. If we're going to do 125 million in revenue this year, our buying power is at that level. So the deepest procurement relationships that you can have, we have. SPAs is a discounted volume purchasing agreement that you have with the distributor. We have the best ones in the industry, and quite frankly, at our C-level executive team, we've been boots on the ground, so we know how to create projects, and finance is a core component of what we also do. Electric EV charging solutions. We have a 17-year-old company with tons of infrastructure, and and you're going to keep hearing me say this, organic cross-pollination of our ecosystem, we're creating new revenue opportunities. It's really dynamic and exciting. We've been on NASDAQ TV twice, and every time we're there, we have the capacity to share new projects and new opportunities that are creating just within our own sustainable platform. Our roofing services, 40 years in the business, roofing and solar, by the way, or alternative energy. When you attach a roofing membrane to an alternative energy project, it becomes one unit, and roofs get all of the subsidies that are in place for alternative energy. So you have roofing companies that have been in the business for many, many years. To bring them into the space is a natural dynamic solution where they could create immediate new revenue streams. They have great sales companies. That's why we partner with roofing companies all the time. Let's talk about our growth trajectory, please. Last year, we went from 17.1 million in audited revenue. This year, we're on the course to do over 100 million. How did we hit such phenomenal growth? It's because we were able to encapsulate all the capabilities of our subsidiaries. And when you combine them with our centralized business nodes, it allowed them to scale. And again, back to this ecosystem where new opportunity zones were created, new revenue streams were created. The few examples that I shared earlier. Let's talk about some meat and potatoes. How does this translate into real world projects? Plemco, our 17-year-old EV unit company, when they cross-pollinized with USA Solar Networks, we had installed on a large developer several solar projects on apartment complexes. That customer was super interested in the program we put together with Plemco. So they've already landed on top of their federal jobs, first apartment complex in Portland, Oregon. Once they perform, they get the other 200 projects. It's this cross-pollination, these opportunity zones that are created with our subsidiaries that are experts in their space. It allows for scale, it allows for growth, and hence why you see our growth trajectory at the hockey stick level that it is. Ehan Media, very, very sophisticated BPO centers, call centers, operations. They really have the capacity to have 500 phone reps on the phones. We first started through a program where we're focusing on hitting our KPIs because wanted to make sure we're investing our capital correctly. We're at a 40% sit ratio on appointments and 25% on our close ratio. As a minimum, we plan to put 100 reps on the phone, distributing leads to our different subsidiaries, and obviously leads generate sales. Another opportunity created through our ecosystem that's managed at our national alternative energy development firm. SVG, one of the leading educational virtual platforms in the nation for contractors. They have relationships with thousands of roofing contractors. They have created within their own organization a sales team of 200 plus roofing contractors that are now moving into the solar space to sell solar. They need a construction, capital, and material solution. So they've joined forces with the USA Solar Networks, and actually we're in acquisition and a binding LOI to acquire them. We should be closing next month. We automatically bring on 200 additional sales teams onto our organization. Right now, in our umbrella at Solar Integrated Roofing, we have 146 independent sales companies, 186 independent sales companies that bring their business to our platform. Coupled with SVG, will be close to 400 sales companies. Loganov Islands. This is a microgrid solution that we have brought to the island. It's a European travel hotspot, but they've never had a grid and have always needed to rely on diesel fuel for their electricity. We have an exclusive relationship with the president and the government of Loganov. we will have the capacity to bring microgrid solutions that we're working on a national basis per our subsidiary acquisitions. And on this particular project, we've structured the capital. So we're going to write a 30-year lease. Pardon me, it says 25-year, 30-year lease with the Laganav Islands, and they're going to subsidize our lease and through collateralize it through oceanfront property. And quite frankly, the citizenry there is beyond ecstatic to finally have a microgrid solution that can work. Callaway Farms, another microgrid project that we're actively involved in. It's a 100-year-old institution, a generational farm, 20,000 acres. Pre-construction is in actual phase 2 of this project, and these $50 estimates of this is a little older presentation. This has grown to a $65 million project. We're bringing 87 million kilowatt hours to the Callaway Farms, and they couldn't be happier. They're so far off the grid that the utility was going to charge them $20 million to bring electricity to their farm. These huge projects, with the buying power that we have, the infrastructure that we have, are literally landing on our footsteps daily. We have $380 million in commercial projects where we structure the capital with our different institutional partners to drive solutions for these customers where they cut $0 out of their check, or out of their bank account to go into the green alternative energy space. And I'm going to hurry along here. Arbiter Bank, we just finished our finance and capital equity raise. They're pushing $42 million into solar integrated roofing for growth purposes. Helixia, who has Department of Energy and Department of Defense contracts. Because of our sourcing capabilities and our procurement capabilities, we've signed agreements with them and we have several press releases on that. They're going to be sourcing $90 million in material from us on the alternative energy space. And finally, I'm going to wrap up with new opportunities. As an origination company and a national developer, it is logical for us to move into bringing in our own structured capital. We are in the process of creating a PPA fund for commercial solar alternative energy projects ranging from 100K to 5 million. The capital partners are in place. The PPA is being structured as we speak, and we're going to continue to work on accretive acquisitions that add shareholder valuation. SVG, they have 200 sales companies. Of course, we want to acquire them. Standard Eco, installation company, phenomenal installation company in 5 states. And we've just signed agreements with the 10th largest alarm company in the U.S. to convert 112 sales teams to sell solar services. So I'm going to, since I have just a few more minutes, wrap it up. And I just want to say as key takeaways, these $100 million revenue growth guidance, we're going to blow it out the water. The administrative and laws that are being put in place all allow us to grow and scale. And it's a great place, great time to be in the industry. So I'm going to turn it over to any questions for some Q&A.
Yeah, Pablo, unfortunately, we are at time, but Pablo Diaz is the president of, it says it right there on the screen, guys, Solar Integrated Roofing Corporation. Pablo, thank you so much for coming on the Benzinga Small Cap Conference today.
Okay, thank you.
All right, I see our next guest here backstage. Let's bring him to the front stage, guys. Dr. Faz Chowdhury, he is the CEO. There he is, CEO of Nomura Medical. How are you doing today, Dr. Chowdhury?
I'm very well, thank you. How are you?
Doing fantastic. Let's go and bring your slides up on the screen, guys. As soon as you share them. Oh, there we are. Boom, 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 boom. There we go. All right, the floor is yours, sir.
Super. Thanks very much. Thank you all for listening in today. And again, thank you to Benzinga for inviting us and giving us this opportunity to present at this conference. So I'm Faz Chowdhury, CEO of Nomura Medical. First of all, a few forward-looking statements to bring to your attention. And so let's jump straight to what is it we are addressing in terms of which space are we in, what is the market, what's the value proposition here. So essentially, we're looking at the obesity and diabetes space. And when you look at it collectively, these are beyond doubt two of the major drivers of the chronic disease epidemic. When you think about the number of disease conditions that can arise, or number of complications that can arise from these conditions, it is quite substantial. And when you look at it both from the point of view of the healthcare expenditure and, of course, the impact on quality of life on individuals. And so as a direct result of that, you have around 500 million people around the world with diabetes today. And the spend, of course, by healthcare providers is phenomenal. Let's just put it that way. And therefore, as a direct result of that, the addressable market is quite big. So that's the market in which we're operating. And what are we operating with? Well, we've basically developed a sensor technology, a wearable sensor technology, which is designed to monitor continuously various things from the skin. And importantly, first of all, we picked glucose for the simple reason that when you look at obesity, prediabetes, and diabetes, it is a huge market opportunity. And that's the reason why we focused on that initially. And later on, I'll be talking about some of the other applications that we are looking at already. And the question is, well, what is the advantage of having a wearable sensor that gives you a continuous output of your glucose profiles over the course of the day? Well, this picture hopefully sums it up. What you've got here is that if you look at those red dots, if you imagine that at different points in time during the day, you were to take a finger prick blood sample and put it on a strip, and you look at your blood glucose value. Well, you could do that several times a day. And despite that, you could actually miss the full picture, i.e. the bigger picture, which is that you've got lots of potential fluctuations in your sugar level. And when you look at the long-term prognosis, the long-term complications and implications of diabetes, it arises when you have a lot of fluctuations in your sugar levels as opposed to a steady sugar level overall. And that's why getting the full picture is so important. And I guess I would go as far as to say, based on published literature, looking at the profiles and looking at how much time you spend within a narrow band is now becoming almost a gold standard by which the progress or the ability to manage your glucose levels or your diabetes is being measured now. Hence the importance. So our vision as a company is to lead in the prevention, management, and reversal potentially of type 2 diabetes, and using both a low-cost, flexible, wearable sensor platform, but importantly, I would stress, also a digital ecosystem. And I stress that because we took a decision early on that it wasn't enough just to develop and sell sensors to people. It's you have a device, you have a sensor, daily sensor. Yes, it's easy to go out there and just sell that direct to consumer, or in the case of the US, it would be by prescription, for example. But what we felt is that the value add comes from that ecosystem that you build around it, i.e. leaving somebody to their own devices and letting them make their own decisions isn't enough in this day and age. Providing them with support, providing them with information, advice, etc. And of course, this can be done in a scalable way because it can be all driven by AI. And so that's why I stress that this isn't purely a device play. Yes, we do have a one-of-a-kind device currently, but it is also to do with digital healthcare. So the approach, again, at the heart of our offering is, is a box of our devices and sensors. And what you have is ultimately a device with a daily disposable sensor. And the idea is that this sensor is skin mounted, so it does not penetrate the skin. That's the key differentiator between what we have and what some of the competing devices offer today. The sensor sits on top of the skin, not inside the skin. And then we use well-established conventional enzyme-based technologies to basically measure actual glucose that is now in contact with the sensor and convert that to an electrical signal, which then gets sent by a low-energy Bluetooth directly every 5 minutes to a mobile phone app. And of course, on that phone, you then will see your profile over the course of the day. That's at the heart of our offering, that particular device. And what we then did was we took that and we've positioned it in terms of moving forward. What you will see from us over the next, let's say, 5 to 7 years are 3 core offerings. First of all, SugarBeat as a device, it will be available to buy online via various mediums, as you will see over the coming months. Secondly, we've put together a program called Beat Diabetes, and it hopefully does what it says on the can. And the idea is to try and help people to manage and rein in their diabetes, primarily in the type 2 space, and potentially also reverse diabetes. And the third being a consumer metabolic health program that we've just launched recently, the beta version of it at least, whereby the idea here is that, again, we said about we don't just want to be a device play, we want to be device and digital healthcare. But we've gone, again, another step further. And what we're saying is that it's, just being in the clinical space isn't enough, because ideally you want to stem the tide. Ideally, when you take the US, you've got about 25 million people with type 2 diabetes, okay? But you have almost 90 million people in the US who are pre-diabetic, and the vast majority don't know it. So the ability to be able to prevent those people from potentially contracting diabetes in the first place is by far the smartest and wisest thing to do, both from a healthcare spend perspective, but also from a quality of life perspective. And this is why we launched Miboco, which is basically Mind Body Connect, and I shall talk about that a bit more detail. Where are we today with our product? So the product is a Class 2B approved, CE mark approved device in Europe, and currently still undergoing review by the FDA as part of a PMA submission that we made. In the UK, we've had orders earlier this year, and I'm delighted to say that just literally this week, we delivered our first commercial batch to our UK licensee, and we will be delivering over the next, on a bi-weekly, monthly basis to fulfill that particular order, which was initially for a couple of 100,000 sensors and 5,000 devices. And we've had a forecast for up to a couple of million sensors over the next couple of years and 15,000 devices. But of course, that figure will be revised probably every couple of months, maybe every quarter. Because the thing you have to bear in mind is that there are over 4 million people in the US, in the UK alone, with diabetes, and almost another 9 million at risk of becoming diabetic. So even in a territory such as the UK, which is relatively small, the numbers are quite staggering. So the opportunities there is quite vast. And our UK licensee has in fact also developed a subscription-based program with which they will be offering these sensors. Outside the UK, there are a number of territories which accept the CE approval for registration purposes. Of course, in Europe, we can already sell, but places like the Middle East, Australia, Hong Kong, etc., we can sell the device with just by registering it in those territories. And we are looking at those registrations. But over the coming months, we do intend to start selling the device directly to the consumer in some of the major territories in Europe, at least to start with. Now, in terms of how it works, as I outlined earlier, essentially you get your profile, your trend of your sugar levels over the course of the day. The idea being that being able to see how lifestyle factors, dietary factors, etc., are affecting that fluctuation is far more powerful as a tool than just having that point-in-time measurement. Because the reality with a point-in-time finger prick measurement of your blood glucose level is that whilst you can estimate it or predict it, or guesstimate it, you can't really know what your sugar level may be in, let's say, an hour's time from when you took that measurement or what it was half an hour before, for example. So it is really a very important and a very powerful tool. And these are some of the testimonials that we've had back from our UK licensee, for example. And again, most people are certainly benefiting. Primarily, we find that when they are able to see that trend, it is a very positive and a very powerful psychological tool, because you are getting a picture that you otherwise have not seen or cannot see. Now, we've been asked many times, well, how does this compare with other devices on the market, et cetera, et cetera? Well, here's some volunteer data that we had back, for example. And if you look on the left, what you've got there is one of the volunteers who took finger pricks over the course of the day. And that's on the left, that's the blue line. And then you've got the red line, which is basically they were wearing, because they already happened to be wearing one of these existing invasive CGMs. And as you can see, even with that, your invasive CGMs, they're not They don't give you precise measurements, but they give you that profile at least. And when we then compare it on the right to the sugar beet data, what I've done here is we've only given the actual raw data. And the reason we've done that, and rather than convert it to the actual glucose values, is because just to show that there isn't any heavy, if you like, algorithmic data processing. The correlations we see are quite good, because remember, we are not measuring glucose by inference. We are measuring glucose directly. There is a certain quantity of glucose that arrives at the surface of the skin. It converts via the reaction with the enzyme, and you get an electrical signal. And that is what we're measuring. And so from that point of view, the profiles and the trends that we get are certainly well within what we would want for the purpose of the applications that we intended. So I mentioned the type 2 diabetes program in the US, Beat Diabetes. And essentially what it is, again, the device at the heart of it to give profiles via which we can give direct feedback to individuals. But also the digital aspect is essentially a diabetes management program that was originally developed at the Joslin Diabetes Center. And the reason we didn't go away and develop our own program is because here you have a program that has over 12 years of clinical evidence that demonstrates the clinical efficacy of that particular program. So it was a no-brainer, essentially, in terms of bringing that on board and combining it with our offering. And right now there are several pilots running, and they have been for the course of the year, being led by our colleague in Boston, Jay Warner. And the idea is that over the next few months, we will start to publish abstracts, and we will then start selling into corporates and insurers, because ultimately we think we will be providing what will be a highly cost-effective tool for the management of diabetes as compared to what is currently available. So then finally, regarding the consumer metabolic health side, so we developed this program, and we took this decision about 2 years ago. Should we not? And you know, it was relatively easy, given the interest that we had, to just license the device and let other people do this. But of course, the true value is in being able to offer a holistic service, and that way you generate not only do you provide a heightened level of service to the users, but also you are creating a captive audience for the various other sensor technologies that we're developing in the future, for example. But if you look at the target market, you have got over 80 million people in the US that could be potential customers of this. And if I look at the nearest, let's say, competitor to that particular offering, I would probably pick Noom. And when you consider that over the last 4 or 5 years, they've seen revenues multiplying manyfold, let's just put it that way. And currently, you know, they have over 50 million subscribers. And I guess the key difference, I would say, or the key unique selling point comparing our offering with the likes of Noom and others is that we have a wearable sensor at the heart of our offering. That is the highest barrier to entry. Developing a product like that can take over a decade. In our case, it took us exactly a decade. And what that does is, because it then gives some real tangible insights into what's actually going on inside your body, we feel that that's going to be a significant value add for potential users. And especially when you consider our sensors aren't going to be in the range of hundreds of pounds per sensor. These sensors are literally, it could be as little as a few dollars per sensor. And especially in the metabolic health space, a person would not need more than a couple of sensors, let's say, per month. So it becomes extremely affordable, scalable, but importantly, is something that you can deploy to the masses as opposed to being restricted to those that can afford it. One of the other questions I've been asked recently is, well, there are a number of companies that have actually jumped into the field of metabolic health, because obviously everybody realizes the vastness of this market, especially when you consider the way healthcare providers and governments are now moving, is that it's not enough to be treating conditions after the fact. You want to be preemptively preventing chronic diseases. Okay, and therefore, you know, being able to monitor metabolic health over the long term and essentially prevent the onset of chronic disease is by far the smartest way to go. Okay, and this is why programs like this are most likely to attract reimbursement. And here's a reason. And so I've been asked the question, well, what about other programs that are using CGMs, for example, continuous glucose monitors, to provide this kind of service? Well, there are services like that, and they are, of course, using the invasive sensors because that's all that's available to them. And there are certain, I guess, challenges associated with the use of those devices. First of all, you are using a significant needle to insert a filament in the skin. And secondly, you can see the middle picture, bruising on the skin. The other picture, you've got trauma on the skin again. And this does arise. And these are reported in the public domain. And so trying to sell a consumer product with a device like so is challenging, let's put it that way. Therefore, we do believe we still have a significant USP in terms of our product. So just to finish off very quickly, future products, one of the ones I would stress, I guess, is the continuous lactate monitoring. We are planning to do some clinicals early in the new year, and then we expect that sometime during 2022 that we should be having a product on the market that also does lactate monitoring. And of course, that initially would have huge applications in the athletics performance market. And so we do see that as a lucrative opportunity. And there are other applications in, let's say, alcohol monitoring and drug monitoring, for example, all of which are quite significant opportunities for us in the future. In terms of the team, we continue to build a world-class team, and right now we are in the process of hiring for a chief marketing and sales officers, both in the US and in Europe. And in terms of IP, again, as you know, when patents are filed, they generally don't get published for the first 18 months. Whilst we've got several patents that are already in the public domain, some of our core patents are yet to be published. And of course, then there's substantial know-how also involved in terms of what we do, both in terms of the sensor technology and the algorithms. So to finish off, in summary, we've now started commercializing, and we are now recognizing revenues, given that we've now dispatched and delivered our first batches of commercial product. The PMA review is in progress. There aren't any other sensors that allow you to use to apply on the arm and use it on a daily basis as and when you want to. So we do have a first mover advantage in that sense, and especially given that it can take several years, 5 to 10 years often, to develop a product like this, we do have, we believe, a significant head start in terms of what we can potentially achieve. And then the revenue generation models are quite simple, direct consumer, as well as sales to corporates and insurers. And these are highly scalable business models. And we have a healthy cash balance at the moment with still a relatively low quarterly burn. That's all I want to say. I really appreciate your time, and thank you very much for listening. So any questions there may be, thank you.
We are unfortunately up against the clock, but Dr. Faz Chowdhury is the CEO of Nomura Medical, ticker NMRD. Dr. Chowdhury, thank you so much for coming on the last Benzinga Small Cap Conference of 2021.
My pleasure. Thank you very much.
All right. I do see our next speaker here backstage. Let's get him on. Oh, Lexaria, speak it into existence. Karam Takar is the Sky Bioscience Vice President of Corporate Development. There he is. How are we doing today, sir?
Good, Spencer. How are you?
Doing fantastic. Let's see the charts. There they are. All right. The floor is yours, sir.
All right. Thanks, Spencer. Thanks to you and the team at Benzinga. Always a pleasure to be here. Again, my name is Karam Takar, and I'm going to share with you how Sky plans to unlock the pharmaceutical potential of cannabinoids. Let's advance. Okay, so before we get into it, standard legal disclaimer here. I will be making forward-looking statements. For all the risks associated with our business, we do encourage you to look at our latest filings. They can be found on our investor relations website or with the SEC. So jumping into things, Sky is a biopharmaceutical company that is looking to exploit the therapeutic benefit of cannabinoids. We believe that this has the potential to be a transformative new class of therapeutics. The endocannabinoid system has been shown to play a major role in a multitude of different disease states and has been shown to be modifiable to provide therapeutic benefit. We're going to focus on a particular area of ophthalmology to start. And there's a rationale to that, is that outside of the brain, the eye is actually the organ that has the greatest proportion of endocannabinoid receptors. So it makes sense that they would play a significant role in different diseases of the eye. Within ophthalmology, our first indication is glaucoma. There's an existing body of evidence that demonstrates that cannabinoids, specifically THC, can provide therapeutic benefit to patients with glaucoma. And we've got some very strong preclinical data that also demonstrates the ability of our molecule in particular to provide benefit in glaucoma. It's important to point out that the medicinal benefits of cannabis have been known for centuries, maybe even millennia. What we're doing is we're taking that knowledge and those naturally occurring cannabinoids and then modifying them. And what that allows us to do is it allows us to create IP. You cannot patent a naturally occurring molecule. By us modifying and improving the therapeutic benefit of natural cannabinoids, we are able to create new chemical entities and gain composition of matter patents, which is obviously very important in a biotech. We're expanding our set of molecules and for other indications within ophthalmology and beyond, and are capitalized through 2022 with some major inflections, key being initiation and final readout for phase 1 safety study in glaucoma and planning and initiation of our phase 2 study, also in glaucoma. So as mentioned, we're initially going to focus on ophthalmology. And as I was saying, there are a multitude of cannabinoid receptors that are found within the eye. And these receptors have demonstrated to play a major role in a multitude of different pathologies, such as intraocular pressure, pain, inflammation, wound healing, and neovascularization as well too. So glaucoma is our first indication, and it truly does represent a significant unmet need. There's currently 80 million patients worldwide with glaucoma, and this is expected to grow to 110 million by 2026. It's a significant market, making up $7 billion in pharmaceuticals. 80% of that market is made up primarily of two kind of legacy classes of therapeutics, which are prostaglandin analogs and beta blockers. And why there's still such a significant need within the space is that although there are treatments out there that exist that address the key risk factor, which is intraocular pressure, ultimately 40% of patients fail to reach their optimal IOP levels with first-line therapies, and over 50% of patients will ultimately end up on 2 or more classes of therapies. And once you're starting to combine or take more than one therapy, this leads to additional side effects and issues with compliance. Having patients take multiple drops can be an issue. What's also important to point out is that the drugs on the market currently address the one risk factor, which is elevated intraocular pressure. However, there's 30% of glaucoma patients out there that actually do not present with elevated intraocular pressure. And for these patients, there's currently nothing on the market. And that also represents an opportunity to capture that patient group as well too. So glaucoma is a disease that leads to the progressive damage of the cells that make up the optic nerve. They're called retinal ganglion cells, or RGCs. And what happens is in glaucoma, you normally have a constant production and drainage of fluid. And in glaucoma patients, what happens is that those drainage pathways get blocked and the fluid starts to build up within the eye. As that fluid builds up in the eye, it creates an elevated intraocular pressure. That elevated intraocular pressure, or IOP, then has negative impacts on the cells of the optic nerve, which leads to their death. And once those cells die off, that they do not regenerate. So that ultimately leads to permanent vision loss. So as I mentioned, there's been a lot of anecdotes of the benefits of cannabinoids in glaucoma. What people are less familiar is that there's actually a significant amount of scientific literature to support the effect of cannabinoids and specifically THC within the eye for glaucoma. So the cannabinoid receptor, specifically CB1 receptor that we're targeting, can be found on multiple tissues within the eye that are responsible for drainage, as demonstrated in this figure on the left. Additionally, there's been several human clinical studies that have looked at the benefits of cannabis in glaucoma, and all those clinical studies demonstrated the ability of cannabis to lower intraocular pressure. However, those were all done in a systemic route of administration, which is either through inhalation, smoking, or by ingesting the cannabis. So there's challenges to using a systemic approach to with cannabis, and I think the obvious one is that when it goes systemically, you're also getting the cannabinoids to the brain, and THC being kind of the key molecule that is responsible for lowering intraocular pressure also has an associated psychotropic effect. So it hasn't really been a recommended therapy when taken systemically. And people have tried to deliver THC topically through an eye drop. However, that's also proved very challenging because when you extract THC, it's an oily or lipophilic substance, and the surface of the eye is aqueous. So essentially, you don't get any penetration of the drug into the eye. What we've been able to do is we've been able to modify THC that changes its physical and chemical properties that now allow it to penetrate into the eye. And this is a prodrug approach. And so once that new molecule enters into the eye, there's naturally occurring enzymes within the eye that will cleave off that addition that we've added, leaving you with THC in the eye in a very low dose where it can perform its therapeutic benefit without any sort of systemic or other adverse side effects. So just to recap a little bit there. So THC's benefits in glaucoma have been well understood and well known. The challenge has been the systemic route of administration. We've found a solution to being able to deliver it topically. So the next step was, okay, how does our molecule and our formulation fare against other commercially available drugs? So here on the left, what we did is we looked at our formulation, which is SBI 100. So it's a nanoemulsion of THC VHS. And we did a head-to-head study against the leading beta blocker and prostaglandin, which are timolol and latanoprost. And what we were able to demonstrate is that SBI 100 was not only able to lower IOP to a greater extent, but also lowered IOP over a greater duration, which is also important for once-a-day use drops. Additionally, we did some follow-on studies where we looked at combining our SBI 100 with other classes of therapies. And the key takeaway here is that, again, THC on its own as SBI 100 outperformed latanoprost, which is the standard of care. And then additionally, when combined with a ROCK inhibitor, in this case, Ropressa, we were able to further lower that intraocular pressure and again, extend the duration of effect. So that leaves additional opportunities for our molecule, not only as a standalone, as a single agent therapy, but also as a potential combination or adjuvant. So a little bit on the mechanism, we've done some additional studies where we looked at a 3D model of human trabecular meshwork cells. The trabecular meshwork are almost like a filter-like structure that the fluid drains through. And over time in these patients, that meshwork gets clogged through fibrosis and inflammation. And what we were able to demonstrate in this first study here is that by applying THC, which is our active ingredient in our drug, we were able to increase the outflow or drainage through the trabecular meshwork in both healthy trabecular meshwork cells as well as those that are simulated into a disease state. We then took those same cells after they've been treated, and we did some assessment of morphology changes and also of biomarker changes. And what that showed or demonstrated was that by applying THC to these trabecular meshwork cells, we are modifying the extracellular matrix, which could potentially be modifying the disease as well too. Essentially, imagine opening up that fibrotic channels to allow more flow. And this was further supported by the biomarker analysis, which showed that we had decreased biomarkers of fibrosis and inflammation. So just a recap here of our SBI 100, which is our formulation containing our proprietary molecule. It targets trabecular meshwork. We've been able to demonstrate that through some of our in vitro studies, the mechanism of action. It also plays a role in other outflow pathways, such as the scleral pathway. And we think that it potentially could have disease-modifying effects through restructuring of the extracellular matrix. We've also demonstrated that SBI 100 as a standalone is superior in our preclinical models to the standard of care. And additionally, that we can combine our SBI 100 with additional classes of therapies to even further enhance the IOP lowering effects for those patients that may need it. And then what is kind of the other opportunity, which is a bit more of a blue sky opportunity, is the neuroprotective capabilities of cannabinoids. So cannabinoids are very well understood to have neuroprotective properties. This has been demonstrated in multiple studies and models, and we believe that there could be a potential for our molecule to also be neuroprotective. This would provide benefit to that 30% of patients that currently have no options that are not suffering from elevated IOP. So we've got a lot of milestones on the horizon. Before the end of the year, we've got our IND meeting. We're going to have our neuroprotection data, and we should be completing our GLP tox studies. Throughout 2022, we'll have some major clinical inflection points that will continue to drive value for shareholders. Again, this is just a recap of some of those milestones. What I wanted to take a quick second, or a couple of minutes to talk about is our cannabinoid pharmaceutical innovation program. So our primary focus is on developing our glaucoma program. However, we are also looking to expand our pipeline of molecules, and we are collaborating with an international group of academics to leverage the existing knowledge and know-how that's out there to accelerate new molecules and IP. Again, we really think that this pharmaceutical approach to cannabinoids is the way to extract the most value. And this was validated through a transaction that happened at the beginning of this year. So GW Pharma, which has been the pioneer that's led the way in this pharmaceutical approach, approved their first drug, which is Epidiolex, in 2018, and it's already ramped up to over $500 million in sales, which ultimately was part of the catalyst that led to its acquisition by Jazz Pharmaceuticals for $7.2 billion. So we believe that we can follow a similar pathway, however, maybe even going a step further in using modified cannabinoids rather than natural cannabinoids to further enhance those benefits. Just quickly on the team. The team is very experienced in drug development. Everybody comes from the life sciences, and we have experience taking preclinical molecules into the clinic and also partnering them with major pharma. We've got a very strong board. We've continued to expand, and we hope to do so again in the coming months here as well. Our advisors are on the clinical side, some of the who's who of glaucoma specialists, and our scientific advisory board or some of the top cannabinoid researchers with over 70 years of cannabinoid experience amongst them. Quick recap here of our financials. So about 476 shares outstanding, 659 on a fully diluted basis, and we are cash through 2022. So in summary, with our glaucoma program, there's strong clinical evidence out there that THC in cannabis can be beneficial to glaucoma patients. The challenge has been on the delivery. We've been able to find a solution to that, and in our preclinical studies, our solution demonstrates superiority over anything that's in the market currently. We've got some key catalysts that are coming up within the next 12 months, and we truly believe that we're at the tip of the iceberg and the opportunity within cannabinoid pharmaceuticals, and are continuing to expand our IP and pipeline to capitalize on that. With that, if there's time for any questions, I'd be happy to take them.
Yeah, we do have a couple here from the chat. Let's just go to this one first here. Is neuroprotective data still on track for mid-December?
Neuroprotection data is still on track for before the end of the year.
Okay. And then does this mean that another capital raise is likely before the phase 2 trials start?
So as I mentioned, we are capitalized through 2022, in which we would be initiating our phase 2. But that's the extent of our runway currently.
All right, Karam Takar, Vice President, Corporate Development at Sky Bioscience. Karam, thank you so much for joining the Benzinga Small Cap Conference today.
All right, thanks, Spencer. Always a pleasure.
All right, real fast, just before I bring up our next speaker, because this is going to be our last chance to do this today before the market closes, is have you guys seen the market today? You guys seen Roku, Jumia, any growth stock? Pretty crazy comeback. I just wanted to acknowledge that, right? Because we are a stock market company, and I'm looking at the markets. I know you're looking at the markets. Pretty crazy move today by a lot of stocks. Roku being the leader. So I just wanted to throw that out there. We can talk about it in the chat, but buy the dip works again is all I can say. Buy the dip works again. Okay, let's bring on Innovus Bio and their founder and CEO, Maria Matrachini. And there she is. How are we doing today?
I'm doing great. Thank you for having me.
All right. We have Maria's slides, guys. Let's get them up on the screen. There we go. Just get that right click off, Maria, and we'll be good to start. I see a little pop-up menu on your screen. You see that?
Nope. I have to say next.
Yeah, we just get you can. All right, that works too. Perfect. All right, the floor is yours.
Okay, so thank you very much for having me. And we have a novel approach to Alzheimer's and Parkinson's disease. What we are really doing is fixing cells that have gotten sluggish. We make them work better and faster. And that is, we are improving the speed by which they work, which is axonal transport. That, as it turns out, works in a number of neurodegenerative diseases. And I'm going to show you today how in our hands it works in phase 2 for Alzheimer's and for Parkinson's patients. So please do read the forward-looking statements. As I just said, this talk mostly will concentrate a little bit on the mechanism and then mostly on the 2 phase 2 studies, one in Alzheimer's and one in Parkinson's disease. As most of you know, we have been attacking neurodegeneration, Alzheimer's specifically, by attacking amyloid, and more newer approaches by attacking tau. And in Parkinson's, we have been attacking alpha-synuclein. While these proteins are toxic, they're all 3 toxic, they do exist in the brain of the Alzheimer's and the Parkinson's patients. All 3 do exist. So it's not that you could just remove one and then the toxicity goes away. You remove one and you still have the toxicity of the other 2. And so, in fact, our drug does lower the levels of all of these proteins. And it does so because nature gave these proteins a regulatory mechanism that is identical. Their translation, which means the way in which they're made, is the same, and the regulation of that translation is the same. And our drug interferes with their translation. This is a picture of how the drug does that. So the green bands is the protein. It's called iron regulatory protein 1. It's a protein that sits in the cytoplasm to which the mRNAs bind. That is the yellow band that is called IRE. So the little loops that I showed you in the previous slide bind to this protein, and when it's bound, the mRNA is not translated. This is true for all of these mRNAs. What our drug does, it keeps it bound. It binds at the interface of the green protein with the yellow mRNA, and it keeps them bound. So there is less translation, therefore there are less toxic proteins for all these proteins. And this is the mechanism. As you can see on top, you see the mRNA with the loop, that's the little red guy. You see the green protein, that is the bivalve protein. That protein binds to the little red guy, and when it's bound, there is no translation. And as I just said, when our drug, which is a small orally available molecule, when our drug is added, it does keep that binding stable, and therefore the mRNAs are not translated. So in a nutshell, what our drug does, it inhibits the translation of a number of neurotoxic aggregating proteins. So what happens when a nerve cell gets injured, when the brain gets injured? The first thing that happens, neurotoxic protein levels are elevated. That's true for A beta, it's true for tau, it's true for alpha-synuclein. What these proteins do, they impair the information flow of the nerve cell. As I was saying, the speed by which information flows is reduced. The nerve cell responds slower. It gets sick, it's attacked by immune system, and eventually it's killed. What our drug does, and that's shown on the right with the blue pristine cascade, you see that it reverses the whole toxic cascade. It lowers the levels of neurotoxic proteins. It increases axonal transport. It has an effect on inflammation. It lowers inflammation, and it protects nerve cells from dying. And by doing so, it actually protects the function that is affected. That function can be motor function in Parkinson's or cognition in Alzheimer's disease. So, not to insult anybody, this is a nerve cell. It has a body in the brain, fingers at the periphery, and an arm that connects the body to the fingers. And the information has to flow up and down that nerve cell, up and down that arm. And these are 3 pictures of that arm, and it shows how the information flows through that arm. So the first picture is a healthy arm. It's a nerve cell that is perfectly healthy. And if you disregard the vertical black lines, you see little black dots that are the carriers of information, and they move smoothly from the left to the right. In the middle, you have an Alzheimer nerve cell. It's a Down syndrome nerve cell. A Down syndrome nerve cell is a sick nerve cell. It is an environment with high amyloid, high tau, and high alpha-synuclein. And if you look at the little black dots that carry the information, they move very haltingly. They stop, they move, they stop. Overall, the speed by which they move through the arm is 50% slower than in a healthy nerve cell. And then at the bottom, it is the exact same Down syndrome nerve cell as in the middle, except it was incubated for 48 hours with ANDS41. And if you look, you see that the little black dots, again, they flow smoothly from the left to the right. So this is a beautiful example of how our drug restores the information flow of the nerve cell and restores how a nerve cell interacts with the environment and with other nerve cells. Now, in animals, the assumption was and is, well, if we reverse the whole toxic cascade, which we were able to show, well, we should see efficacy. And in fact, in 7 different animal models, we did see efficacy. In 4 animal models of memory and learning, The animals fully recover their memory and their learning, and their cognition is identical to healthy, normal animals. These 4 models were Alzheimer mice, Down syndrome mice, stroke mice, and traumatic brain injury rats. And then we tested it in 2 movement disorders. That's Parkinson's mice and frontotemporal dementia mice. And again, the animals behaved exactly like healthy, normal mice. And finally, we figured, well, if it works in the brain and it works in the body, how about the eye? So we induced glaucoma in rats. And when you do induce glaucoma in rats, you increase the pressure in an eye, the retina dies, and the eye goes blind. If we treat that rat with ANVS-401, the pressure goes up, the retina does not die, and the eye does not go blind. So in animals, we were fully capable of showing the reversal of the toxic cascade leads to efficacy in 7 different animal models. So now we wanted to show it in humans. And so we did a double phase 2 study, 14 Alzheimer patients and 54 Parkinson's patients. This was a double-blind, placebo-controlled biomarker study. In Alzheimer's, we only had 2 doses, placebo and 80 mix. And in Parkinson's, we had 0, 5, 10, 20, 40, and 80 mix. And then, of course, the endpoints were safety, pharmacokinetics, biomarkers, and efficacy. And in fact, we were able to show in humans this time that we were actually reversing the whole cascade and that we met every single endpoint we had in the protocol. The primary and secondary endpoint of safety and pharmacokinetics were met, and the exploratory endpoints of biomarkers and cognition and function were also met. What surprised us in such a short, small study is that, in fact, we saw cognition in Alzheimer patients and motor function in Parkinson's patients. So here is the toxic cascade and the reversal of the toxic cascade. On the left, you see the biomarkers that we measured in Alzheimer patients. It's tau, phospho-tau, soluble APP alpha and beta, and A-beta 40 and 42. And they all moved exactly the way we were expecting them to move. A-beta 42 goes up a little, which was to be expected if a person does better in their Alzheimer's disease. And then in Parkinson's, we saw a decrease in alpha-synuclein, which was also what we expected. Then we looked at inflammation, and all 4 inflammatory markers in Alzheimer's and in Parkinson's, other than YKL-40 in Alzheimer's, were reduced as expected, not to the same degree in both patient populations, but they were reduced. And finally, we looked at axonal health as measured by neurofilament light, and we looked at synaptic and nerve health as measured by neurogranin. And again, these markers that show that the cell is unhappy were both reduced in both patient populations. So now we got to efficacy. In Alzheimer's, we only had 14 patients. That is not a big study. However, in these 14 patients, the 10 treated patients compared to the placebo patients and compared to baseline, we saw an improvement of 4.4 points from baseline and 3.3 points from placebo, which is a very nice improvement. And then we also measured Waze, not just ADAS-Cog, but also Waze in Alzheimer patients. And the Waze test measures speed. It measures speed in thinking, speed in recognition, and speed, and that's going to be important in Parkinson's, speed in movement and coordination. And what we saw here again is a 6.6 point improvement over baseline, which is statistically significant, and a 4.9 point improvement over placebo. So in just 14 patients, we saw a nice improvement in ADAS-Cog and in Waze from baseline, statistically significant, from placebo, not quite. And then let's go to the Parkinson's patients. In Parkinson's, we measured 0, 5, 10, 20, 40, and 80 mg. And to make it simple, we added up the data of the most and the least significant, so you see the spread. So this is the UPDRS and part 3. Just for your information, part 2, 3, 4, and total UPDRS were statistically significant and showed improvement. Part 1 did not. And here we are showing part 3 in 54 patients. Compared to placebo, 10 and 20 milligrams are highly statistically significant. But if you look at all doses, not just the 10 and 20 that were the best, but all doses, they're also highly statistically significant. Now we move to the ways, and here again, we summarize the data the same way. And again, 10 and 20 are highly statistically significant, and all doses compared to placebo are highly statistically significant. So basically, this study showed us that the best doses to use in phase 3 are 10 and 20 mg, and that the ADAS-Cog for Alzheimer's and the UPDRS for Parkinson's are good endpoints to also use in phase 3. So basically, what we want to do now, or what we are doing, is summarize the data, send it to the FDA, ask for 2 meetings, one for Alzheimer's, one for Parkinson's. In both meetings, we are requesting 2 pivotal studies. So a short Alzheimer's and a long Alzheimer's, a short Parkinson's and a long Parkinson's. And that should then give us enough data to get approval for Alzheimer's and for Parkinson's. We expect to start the first Parkinson's study in maybe April, and the Alzheimer maybe a month later. So right now we are getting ready to send all the information to the FDA to get ready and to get their feedback on phase 3 for Alzheimer's and for Parkinson's. And I'm going to pass it on to Jeff.
Just waiting to see. Can we add Jeff here?
I thought he was on.
There we go. We got him.
All right.
We got him.
Okay, thank you. All right, thanks, Maria. So this is our patent estate. You can see here we have filed 4 different families of patent applications covering the method of use, covering neurodegenerative diseases, acute brain and nerve injuries, prevention and treatment of diseases, and most recently, last year, we filed for infections. The next slide. The pipeline, we've talked pretty much exclusively about ANVS 401. The other drugs, ANVS 405 is the same mechanism of action, but in acute form, injectable form for acute injuries, and then ANVS 301, a totally different mechanism of action for advanced Alzheimer's. But the focus again is ANVS 401 in AD and PD. And the next slide is a financial snapshot. We completed our IPO just under 2 years ago in January of 2020. We did a follow-on offering this past May, raising enough capital to fund us for another 2 years. And as Maria said, 2 short-term studies, one in Alzheimer's and one in Parkinson's. And likely we would raise additional capital to fund longer-term studies. We also have had grant funding from the NIH that's funded another trial in Alzheimer's, as well as our chronic toxicology study that we completed last year in animals. We've got about 38% insider ownership, total shares outstanding 8.1 million, a float of 5.6 million, and no debt. The next slide is about the team, Maria and myself, Chen Fang, who is our VP of Research, who joined us about 6 months ago, and Bill Mobley, who's our Chief Scientific Advisor from UC San Diego, who is an expert in axonal transport and Down syndrome. And the next slide is the Scientific Advisory Board, made up of world-renowned experts in neurodegenerative diseases at prestigious universities in the US. And the next slide is, in summary, we have a novel approach to stop both Alzheimer's and Parkinson's. It's the only drug we're aware of that attacks multiple neurotoxic proteins simultaneously. And our phase 2 trial was the first double-blind placebo-controlled study that showed improvement in both Alzheimer's patients in ADAS-Cog and Parkinson's patients in UPDRS. as well as Waze coding in both patient populations. So the successful completion of that study allows us, as Maria mentioned, to plan for our phase 3 trials, which we hope to be kicking off in the early part of 2022. And with that, we can open it up to any questions that we might have.
All right, well, we have like 1 or 2 minutes here. We got a lot of questions. So let me just go arbitrarily here. Are the end of phase 2 meetings scheduled with the FDA for the clinical trial?
One is, the other is not.
Okay.
But the FDA for the one that is said they don't want a meeting, to just ask them in writing, and they're going to give us back an answer in writing.
Okay. Has the approval for Aduhelm impacted Innovis?
That's an excellent question. How much time do I have? In some ways, yes. In some ways, no. Okay? So it depends how you see the future. Do you see the future having Aduhelm, or we can take the Lilly drug, the Roche drug, that also remove plaque, and probably will get approved, and say, well, they exist, they're being used, they remove plaque. What I said in the beginning is we really have more. We do more than just remove amyloid. We also do tau, we do alpha-synuclein, we do TDP-43. Paper was just published, and we'll have a news release on that one of these days. So we actually remove all the proteins that are toxic in the brain. So you could say, well, an antibody for amyloid is very strong just for amyloid, but you may want to have some additional removal of toxicity, which could not be bad. Plus, our drug is very safe, so it wouldn't add to the burden of side effects that you have with antibodies. It really depends how these proteins or these antibodies will be accepted. We can probably do a combination therapy with them, but we can also do a combination therapy with an anti-inflammatory or something else. At some point in our lives, there will be combinations, and I think our drug is very well suited for combinations because it's oral, it's easy to take, it's a pill a day, and it's safe.
All right, Jeff, Maria, thank you both so much for joining us again. We've been on with both of them here on novusbio.com is your website. Everyone, both of you, thank you so much for coming on the Benzinga Small-Cap Conference today.
Okay, thank you very much for having us.
All right, it is 4 o'clock, which means the markets have closed. Everyone put your pencils down. Before I bring on my next guest, I want to bring on this screen just for a second here. All right, this is the Slido poll that I've been mentioning throughout the day. Scan this code on your computer or your phone, whatever. Enter to win a free 1-year sub of Benzinga Pro. Really, people? Not a single person that answered this question is bearish next year. I find this implausible, impossible to believe. There is always somebody peddling fear and greed out there, or FUD, as the kids say these days. I cannot believe that not a single person watching this is bearish next year. I can't believe it. Maybe we'll ask them. Maybe if tomorrow's a down day, we'll ask the same question again, and we'll see what happens on the day the market closes down. The market's had a great day today, so maybe that's why. Anyway, scan that code on the screen. This will be your second to last chance. Enter to win a free 1-year subscription of Benzinga Pro. You just missed it. Sorry. All right, let's move on here, and let's bring on Dr. Adam Kaplan, the Chief Scientific Officer of MyMD Pharmaceuticals. There he is. How are we doing today?
Good. How are you, Spencer?
Doing great. Doing great. It's been a minute since we caught up, so good to see you again. Hope your Thanksgiving was well. Let's bring his slides up on the screen, guys. There we go. And Adam, take it away.
Thanks so much, Spencer. I also wanted to make sure that my colleague, Rob, who's the brainchild about all things financial, is hiding in the wings. So he's my fall guy. He's my net, and I never perform without a net.
He is lurking backstage. Yes, we'll bring him on in a little bit.
Excellent, thanks. So forward-looking statements for those people who are, bearish about forward statements. So let me give a quick company overview here. We have 2 drug candidates, MyMD1, which is a clinical stage immune regulator. I'll tell you mostly about that. And Supera CBD, which is a preclinical patented synthetic cannabidiol derivative. It is like its name implies, it's a super CBD. And I'll put some data where the name is in just a minute. We are currently set to begin 2 phase 2 trials in the first quarter. We're already screening for one of those 2 phase 2 trials at Johns Hopkins. This is our advisory board. Just in the interest of time, I'm not going to linger there. Excellent, experienced group. I myself am from Johns Hopkins, where I was for the past 2 decades. Studying autoimmune diseases and the like. So these are the guys who know everything about business. I'm the science guy. And I'll let Rob touch base on the financials. Essentially, this is the same thing, which is just to give you connecting the dots through the TNF alpha component of the MyMD1. It is been shown already in published studies to decrease TNF alpha as well as IL-6 and IL-17. Why is that interesting? Well, it turns out TNF alpha is the $40 billion a year market that Humira alone, one of the 5 drugs that's available, accounts for $20 billion a year. It's the #1 grossing drug in existence at present, and they treat autoimmune diseases. What's different about our drug is it's an oral drug as opposed to injection. It crosses the blood-brain barrier and it doesn't affect the ability of the cells in the blood to mount an attack when bacteria or viruses or fungi invade. So, we think that the safety, the tolerability of the oral medicine, and the fact that we can access the CNS, the brain and spinal cord, gives us advantages over the currently available treatment. So again, it is, since TNF alpha is the kind of king of inflammation, it's the first pro-inflammatory messenger that the immune system produces. Even from birth, we're ready to mount and attack any invaders that come in by what's called the innate immunity. You don't need to adapt or acquire this later. You're ready to go. TNF alpha is the leader. It's the first one up. And again, we sort of discussed the big grossing here, Humira, but even some of these smaller drugs are multi-billion-dollar drugs. Big area. So we think we're really sort of getting at the causes, not just the symptoms, not just because of TNF alpha, but because there are separate drugs out there for autoimmune diseases that also hit IL-6 and separate drugs for IL-17. We in one drug do all 3. So again, we think that that offers some benefits. That selectivity is really crucial. Unfortunately, the drugs, the TNF alpha inhibitors, for instance, all have a black box warning for severe infections, because if you block the ability to, ward off infections in the blood, then you're risking not being able to quiet down an infection, an overwhelming infection. And so it's severe infections, the black box warning, up to and including death. And death is not something you want anywhere near your package insert. There's also antifibrotic effects, which is very interesting. About 40% of deaths in this country have fibrosis involved. So think of this as scarring, things like cirrhosis, which is scarring and ultimately over-scarring of the liver. You've got kidney disease that involves scarring, cardiac disease, lung disease. All of these involve over healing. So it's kind of healing gone on steroids, healing gone awry that lead to this scarring. And MyMD1 is a potent inhibitor of this fibrotic in vitro studies. We are now interested in the potential applications of this for other studies. Also, since it turns out that the best evidence I can give you that inflammation is associated with depression is that a study came out of Harvard about a year ago showing that post-COVID infected individuals at 3 to 4 months out, 50% of them will have moderate to severe depression. That's a lot, and it's because of inflammation. COVID doesn't kill you. What COVID does is create a cytokine storm. It activates the immune system, and it's your immune system kind of like the sorcerer's apprentice out of control, that then overwhelms the body and causes death. It also, in lower levels, causes depression. And so post-COVID depression is one of the treatments we're going for. There is a study, this is just early examples of some of the data from that study, which is currently in submission from a major academic center. This just shows you that here, taking mice, the equivalent of about 60 years of age, treating them to about 85 years of age. The red curve shows that at time 0, 100% of those mice were alive. 13 months later, the majority of those mice are alive. That's in contrast to rapamycin or rapamycin plus metformin, the two other drugs that have been shown to slow aging and extend life. And you can see by the end of the study, they're all dead. So that's a pretty big on or off kind of phenomenon. People ask me, gee, am I taking it? And until we have better data, I am not. But I certainly will tell you that this is something, if this holds up in humans, what it does in mice, this would be a real boon. Because of that, by the way, we are going for the equivalent or the surrogate marker of aging, which is muscle loss and frailty. Frailty is a combination of muscle wasting and increased susceptibility to falls, cognitive impairment, these kinds of fun things that happen when we age, if we age in a way that is pathological, normally due to increased inflammation. And so the FDA has indicated that we can go for, we have an IND approval to start this study in sarcopenia and frailty, starting in January, just coming up a month from now, to begin the process of working our way towards an aging, decreased aging phenomenon. So Supera CBD, we'll just cover this in broad strokes. Supera CBD is a small change. As you can see here, the CBD is on top. You can see it has that 6-member ring, 2 6-member rings, but on the top right is a 6-member ring that if you go down to Supera CBD, the only difference is that 6-member ring turns into the pentagon. It's a 5-member ring. And that one small difference immediately has a difference here. So it turns out all cannabinoids, whether it's marijuana, which is predominantly THC with some CBD in it, and 100 other chemicals, they all work through either the CB1 receptor or CB2. When you think of THC causing the intoxication, that's CB1, but it also helps with anxiety and pain, but you do get intoxication and the cognitive impairment that goes along with it. And when you think of CB2, that's the immune system. It's the brake of the immune system when you take drugs that activate CB2. As you can see in this already, CB2 is where the money end of Supera is, 92% inhibition. That's compared to 25% of CBD on the left. And there's a slightly lower THC kind of CB1 activation, 39% in Supera compared to 54% in CBD. But the thing is, it's not just whether that molecule, that drug, binds to that receptor, the CB2. The question is, once it's bound, does it activate it? Does it inhibit it? And does it have a potent effect? We were shocked to find that the effect of this drug, remember, just taking that 6-member ring to a 5-member ring, led to an 8,000 time greater potency at activating that receptor. So it's kind of hard, you get a degree in neurochemistry here, if you can follow all this. But here in the middle, you see Supera CBD. You can see that the EC50, the half maximal dose to have an effect at activating that CB2 receptor is 0.004. That's in contrast to CBD on the right, where you can see you got to go out to 30 micromolar before you start to see any effect at increasing that thing. So if you take 30 and you divide it by 0.004 or 0.003637, you get 8,000. And that's the level of difference. So Supera really is super and superior in this way. So studies have demonstrated, comparing it side by side with CBD, that, and this is what we're working, that the binding and activation is really different. We also have evidence already that says superior CBD is great for anxiety. So this is in animal models. We are not yet done with our phase 1 safety studies. We are in the process of moving forward with those. So this is a step behind MyMD1. We're still doing preclinical and safety studies here, but it looks to be a molecule that has incredible potential to not just do what CBD does, including anxiety. CBD is now approved as Epidiolex for types of rare adolescent and childhood onset seizure disorders, so as an anti-epileptic, and the host of other potentials that you hear about routinely on television and in the news about the things that CBD might be able to do. And we think Supera not only might be able to, we think we will find the indications where it really is dramatically better at doing what it does. So those are kind of the highlights. I think we covered this. And Rob, do you want to come on and just make some important messages about the finances? Can we get Rob here to kind of bring us up?
Sure. The good news is we're fully funded. We have, as of the last September quarter, $16 million in cash. And I think one of the keys here is we'll be starting this aging trial right after the new year, and we'll have data by the end of the first quarter. So, you don't have to worry about running out of money or anything like that. We have this all fully funded.
So Spencer, we're happy to field any questions. If people have questions, that's kind of the highlights here. If there's anything you wanted to add, please let us know.
I would just say, like, generally speaking here, this could be for either of you, maybe for Adam. What is sort of the most difficult thing right now?
The most difficult thing. So, again, the difficult thing for let me take each drug separately. The difficult thing about MyMD1 is that the excitement that surrounds having a drug that, as you can see from the data, one thing I had forgotten to mention, very important, is it doesn't just extend the lifespan. These mice are fit, and so it delays aging. They maintain their same muscle strength throughout the entire 13 months, which is remarkable. So it's not just coming up with a drug that's going to make everybody demented and old. It slows aging. That is the holy grail, right? Because if you get rid of all cancer, you still have only increased lifespan by 3 years. Why only 3 years? Because if cancer doesn't get you, lung disease will. As you get older, they all go up, all of these risks. So aging, if you can hit aging, that's the way to solve all of the problems. The problem is it's very hard. There are no drugs that have approval for aging, so we're in virgin territory. And it's not that other people aren't trying, but so we really have to use these surrogate markers like sarcopenia and the like. So that's, being in an area that there's no path there. For Supera, the difficulty is that here we've got a molecule. We know how safe cannabinoids are in general, all of them. And the frustration is having to go through but that's the way the game is played, but having to go through all of the safety data. I'm just so excited by it. I'd love to get it into human studies, but the system is designed to prevent us from missing anything that was unanticipated. But you're just asking me what are the difficulties from my standpoint. The difficulties are that it's going to take time to get what I think could be a super cannabinoid to clinic. That's the frustration.
Is the goal to make these available outside the U.S. as well?
Yeah, absolutely. So we don't have our in-house patent lawyer here with us, but he's done just a phenomenal job. And I'm just going to throw a number out there. I think it's 14 patents for MyMD1 and perhaps another 15 some odd patents. We've already been granted a host of patents, I think 8 patents from IMD1 and a couple of patents from for Supera, but we already have heard back early from some other countries regarding patent approvals for both molecules.
And then and the last one here from the chat, how would I'm not sure which drug is being referred to here, but let's just assume both. How would it be administered? I guess.
Yeah. So again, great question.
Up on the screen.
Yeah, great question. So again, just to reiterate, one of the huge advantages of MyMD1 is it's an oral medicine. It's a small molecule. It gets across the blood-brain barrier. Huge advantage over all of the other anti-TNF alpha drugs, which are either injections or infusions where you got to go get hooked up to an IV. And with respect to Supera, it also is an oral medication, at least on first blush. That doesn't mean, once we get to human studies, we may be able to find out that, nebulizing it or, other means of delivery might be preferable. So we just have to wait and see how that goes. It's a good question.
Got it. All right. So Adam, Rob, MyMD, guys, thank you both so much for joining us on the final Benzinga Small Cap Conference of 2021.
Thanks so much, Spencer. We appreciate it.
All righty, let's keep it going here. We got a couple more presentations left. Our next presentation, we're going to switch gears here. We're going to pivot from biotech and drug development to food. We all love food, right? Blue Star Food Corp. Let's bring on the chairman and the CEO. There he is, John Keeler. How are we doing today, sir?
I'm doing well. How about you?
Doing fantastic. I'm trying to keep the energy up. John, I need you to help me keep the energy up, all right? We've been at this since 9 in the morning. Everyone, with John here, let's just do some quick stretching, all right? We're going to do some arm circles. John, let's go. Bring the energy. It's all you here.
Okay, thank you. Thank you, everyone here. Thank you for allowing me to share the slides. Well, listen, I'm not going to go into technical. I want to give you high level, and anyone else that wants to deep dive or double click on this company after my presentation, you'll have a contact at the end, and be more than happy to circle back with any one of you after the Q&A. Well, Blue Star Foods, we're healing the planet 1 pound at a time. We're a NASDAQ company traded on a BSFC symbol. Here's our forward-looking statements. Important to disclose it as we forward-looking projections and for you to mitigate your risk assessment before you invest. Well, what do we identify with Blue Star as the problem that exists in our life, all of us, is that the seafood will double consumption by 2020. There is a really, let me strike that. Let me give you that we're facing an increase in world seafood consumption worldwide with about 45 pounds per capita annually in 2017, and expected to double by 2050 with additional 2 billion expected more people in planet Earth. That really is a threat to our food security. Furthermore to that, we're adding insult to injury, the environmental pollution by harmful chemicals that we all made and waste dumping to our ocean is affecting our food supply and the health of the fish we do eat. Microplastic is here to stay during our lifetime. And if we don't act now, by 2050, the fish available will only serve about 5% of the world population. So with this issue, what is the Blue Star solution? The solution and the competitive advantage for us is our proven disruptive technology, which is based on modular self-contained on-land aquaculture system that grows healthy salmon free of contaminants, antibiotics, and microplastics. And salmon being our first species, we know will have the greatest success rate in our industry that we serve in. And going about the industry, let's go over what is the market size and the opportunity we see. When it comes to salmon, the global market on the salmonoid species is the most important commodity traded in value since 2013. And to address environmental concerns, this year, the Canadian government has declared their intentions to transition about 95,000 tons of salmon worth about $1.1 billion from their conventional ocean farming to land-based aquaculture within 5 years. 5 years, they want to get it done. And the Canadian government has already started by canceling ocean farming licenses. And there is a huge opportunity in a silver platter for us, guys. Impressive opportunity. And that itself brings up to, after us being public, what is our notable, here, let me give you a little more about the micro-regulatory demand that I just told you about to give you an idea of the true facts of the federal court hearings of BC on Discovery Island that with fish farms are phased out is underway. And just giving you some of the glimpse that is in the news. So then let's jump into, what is our notable gap valuation comparing to our peers and how is good entry to any investors coming in. But another valuation gap that you see is like we own Little Cedar Falls, which is a taste of BC on the left side. And then you compare Aqua Bounty, a publicly traded company, Atlantic Sapphire as well, where both companies are in production at their level. Then you have three more projects which are non-public, which are on the same salmon RAS company. And if you just compare with the two other public companies on the top in our space, Aqua Bounty has a market cap of $200 million today, and they have sold less than $1 million. Atlantic Sapphire last year sold $6 million in sales, or has $6 million in sales, should I say, and have a market cap of $448 million. Blue Star had on 2021 14 million in sales, 2020, should I say, 14 million in sales, and have a market cap of 7 million today. So there's definitely where the young pup is here, and want to show you the valuation gap that exists today and how we can get, how we're going to be aiming to delivering consistently going forward. So with that combination, what set us apart from this competition? Well, first of all, we have established supply chain with blue chip customers, okay? Such as not limited to, we have Walmart, US Foods, Costco, Disney, Cisco, PFG, etc. And those are the largest, most prestigious company to doing business with. And this company being for 26 years, we have been able to accomplish those relationships apart. And we actually, this company have evolved from a small scale fisheries seafood category to a proven disruptive food technology, alongside with these marvelous distributor partners that are here, just as an example. So just take a look at those partners. It doesn't get really any better than that. And who's going to take us to the next level are the executive team that we have here. And let me give you 3 highlights of all of us. Strong public company governance, over 100 years of seafood experience, and over $1.4 billion in revenue collectively among these executive team. And give you a snapshot of the sales, a run rate of 20 million in 2021. And you can see the growth rates path onto $227 million in 2028 with approximately $79 million of net income. That's really the growth path that we have, and that's where opportunity lies. So pretty much right now getting on the deep of our market valuation and our starting point since we just become public in NASDAQ, where the OTC were now public in NASDAQ. So really, how are we going to be able to get this 227 million is by growing our farms, footprint, increase our everyday revenue stream of seafood distribution that we have, able to capture the opportunity that the Canadian government has given us by transition conventional salmon volume farming into land-based, where we are the only one that have that technology currently in the British Columbia that is able to harvest week in and week out. And then at the end, give you guys more of a high level, why us? What are the investment highlights for you guys to look into it? Whereas if a company, 26 years in the business, we got blue chip customer base. There's a huge valuation gap between our competitors or comparables. And there's a huge undiscovered opportunity on the rapidly growing food supply chain. Guys, we got more orders than we can actually supply. Highly scalable and modular through our RAS system. And we just uplisted to NASDAQ a month ago. And that's really a good prime for any entry level for anybody who wants to do. So pretty much this is in your 8-minute cap. I know everybody's pretty much tired and get it going. Want to get out of the way, but I want to also give us some time for Q&A as well. I just want to have one question to all of you is like, next time you're going to have fish, ask yourself if you want to have it with or without microplastics. Well, here, thank you again. This is the contact if you would like to reach us after the post conference. Hayden IR. Please email Brett at Hayden IR there in the top of the screen, right below the Healing the Planet 1 pound at a time is his email address, and be more than happy to schedule any post-conference and meetings as well to going forward, and excited to share our venture, our news, and going forward. So that saying, if you have any Q&A, please let's take advantage of the next time.
All right. When do you expect profitability, John?
We actually, operating wise, we are profitable. The company, the operating companies are profitable. We do have humongous amount of I call it humongous expenses to be uplisted. It isn't cheap, but we look at this as an investment for valuation. So that's pretty much been saying. Our first quarter looks very strong in terms of revenue. We got orders ready to be delivered by then. And I expect that the entire company no longer having these massive expenses on the uplisting side of it, being generally the entire profitable in the first quarter 2022.
Do you have a projected net income on that $20 million or $20 million number?
I don't. If I take the operating incomes for the operating companies, I think it will be approximately net income of operational probably about $500,000.
Okay.
If I have to guess.
And for the record, I like my fish without plastic. So
okay.
just to be clear about that, in case that needed to be said, I'm sure most of us can also say the same. I'm curious, John. How is your own? I feel like I have to ask this of every single consumer products company right now. Is like, how is your own supply chain holding up, and how are your input costs right now?
Sketchy. It's sketchy. I can tell you that there is a supply chain backlog. There is oh,
did we lose John? No, he was getting to a good answer. Oh no, let's try something here. John is frozen. Man, what a great answer, though. All right, hold on. We're going to try to get John back here. How is your supply chain? Sketchy. That was great. No, John, come back to us, please. All right. We're going to try to get John Keeler back. If any of our producers back there can help us out, we'd appreciate that. But, man, he didn't even get to the actual meat of the answer. Oh, gosh. Oh, man, that was good. If you have any more questions, drop them in chat. Hopefully we can get John back, because that was great. I do actually have the genuine questions here. So it's not as if... here's what we're going to do. We're going to give John like another... Because we still have a few more minutes, right? So I want to give John like another couple of minutes to come back. And this is going to be the very last time that I pull up the Slido poll today. Oh, thank you. Finally, we do have some bears out there. Not that I'm necessarily one of them, but I was surprised to see this poll 20 minutes ago at 100% bullish. So good to see. We do have some skeptics out there for 2022. So if you have not already, scan the QR code up on the screen. I'm going to take it off for the very last time here in a few moments, and we will randomly select one lucky person who participated to win a free 1-year subscription of Benzinga Pro. Yeah, MC, I agree. He can't leave on that note. He has to come back. Tell us why it's sketchy. John, if you're out there through the metaverse, please hear me. Come back to us. I'll give John a few more minutes, and if not, frankly, then we'll just move on to our next presentation. But I want to give John the benefit of the doubt here because we do have a couple more minutes, before our next speaker was even scheduled to come on. So this is what we'll do between now and let's say like 4:35. All right, and if we can't get John back before 4:35, we will move on. Let me just do this though. Let me just I'm kind of blown away, everyone, at the market the last 2 days. Let me just pull up my Benzinga Pro. All right, I want to get GameStop off the screen there. And I want to go to my watch list. A lot of green out there. And the stuff that's red is not red by a lot. Oh, we do have John. Do we have John? Yes. It appears like we do. So let me get my screen, my Benzinga Pro off the screen. John.
I did.
Okay, we got you back. Can you hear me?
Yeah, I can hear you. Can you hear me?
Yes, I can hear you. Your video is frozen, but I can hear you. So that's more important. So tell us why the supply chain is so sketchy.
Well, definitely they are port backlogs, lack of containers. There's still limited output on production out of overseas countries. There's and the cost of freight are skyrocketed to about 400%, and the backlog itself, whatever it takes 45 days to get here, now it's taking 75 days. So it's just insane.
Well, those costs aren't sustainable for you, right? I mean, how long can you realistically sustain that?
We can sustain it as long as the customers are paying it, and they're paying it.
All right,
so
that's true.
Food cost will remain at a 10-year high in 2022, and there's no signs to going down.
Do you have plans to get into other grocers, or are you happy with where you are?
No, definitely. We have, at the moment we have more product, we'll definitely get into more grocers. We have more orders we can supply.
Okay. So it seems like you don't necessarily have a supply problem or a demand problem. You maybe just have you and everyone else just have a pipes problem right now.
Yeah, in my view, it's circumstantial. I don't think it's an ongoing concern. I'm happy to continue to have the problem of demand, which is gonna, at the rate that we're consuming fish and the growth of population, and the already established supply chain. If we don't really act fast on getting these RAS systems technology in place, we'll continue to see less and less and less fish available for the consumer.
Can I just ask a question? I mean, like, what exactly made you get interested in this? It's not exactly the most and I'm not trying to put it down at all, but it's not most people don't probably think about where their fish is sourced, right? So what exactly made you come across this issue?
Nothing that I read. I mean, I lived in those countries. I've been in the seafood business for 31 years, 26 for the company. And I see the challenging of having more product to sustain the demand that we're getting all the time. And the complaint is it's not enough. So as really an issue of that, if we don't really act upon, if we don't get into that issue expeditiously, what this is the Everett will be less fish available at a higher price and margin contractions in the future as people just stay away from it.
Awesome. All right, John Keeler, again, Chairman and CEO of Blue Star Foods. John, we were able to work through some technical glitches. Thanks for bearing with us, and thanks for coming on today.
Thank you indeed. Until next time.
All right, wait, Money Mitch in the chat. What don't I understand? And Shelly, yes, Detroit at dark. It's getting dark out here. It's 4:30. It's getting dark already. This is our life, Shelly. This is our life. We do it to ourselves with daylight savings. All right, let's keep the show moving here. We got a couple presentations left. Oh, there is our next speaker. He's already here, Dr. Howard Fedorov. He's the CEO of Immunotherapeutics. How are you doing today, sir?
Great. How are you, Spencer?
I'm doing well. You know, it's Wednesday, which means we're over the hump, coming down to the back half of the week. Take us home, Howard.
All right. It's my pleasure. It's great to be with you. So today I'm going to be talking about an approach that probably is familiar, but let me start by recognizing our exceptional management team, many of whom have joined since the company went public in March of this year. A little timeline for overview. Through a reverse merger, we became public. We began and aggressively then secured the in-license to both mRNA and lipid nanoparticle patents. We raised about $55 million in capital. We focused on an IMSC company that we had already interacted with and acquired Novellus Therapeutics. And along the way, as I've just indicated, we recruited some exceptional people to the team, and we were uplisted onto NASDAQ just about 5 weeks ago. So the technology that I'll be speaking about that will undergird much of what Brooklyn Immunotherapeutics is going to be doing is focused on mRNA cell reprogramming, mRNA gene editing, NovaSlice, which is a trademarked gene editing protein, which I'll speak about extensively, and Tornado, which is an mRNA delivery lipid nanoparticle system. We see ourselves at the center of an emerging technology landscape that includes mRNA therapeutics, in vivo gene editing, non-viral genetic medicines, and iPSC-derived therapies. Leveraging all of these is part of the purview of Brooklyn Immunotherapeutics. If we consider for a moment the in-licensed mRNA-based approaches with the lipid nanoparticle technology, we can show, as seen on the left side, the use of these in combination so that we can make engineered cellular medicines. If we then deploy these in a slightly different way, we can encapsulate synthetic mRNA, including perhaps the mRNA encoding a gene editing protein, and then deliver that in vivo, being able to then tune the delivery to the particular organ and a particular cell type to develop in vivo gene editing medicines. The foundational mRNA cell reprogramming platform is highly efficient. It involves the introduction of 5 proteins that reprogram a somatic cell, as shown on the right, a fibroblast, into an induced pluripotent stem cell. It has low toxicity, it has a high percentage of cells that are transfected, and therefore the yield with regard to correctly reprogrammed cells lacking genomic alterations is quite substantial. Importantly, because of the nature of the way that the reprogramming is done, there is no chance for genome integration. The reprogramming can, quite interestingly, be combined with gene editing to streamline, as I'll describe later, the autologous therapies for genetic diseases. And this represents a portfolio of in-licensed patents which are extensive. The unique gene editing approach involves this gene editing platform, and it is encoded by a synthetic RNA. It is rapid because of high expression. It leads to transient expression, which conveys specificity. It is amenable to non-viral delivery, such as the tornado or LNP I described earlier. There is no risk of vector insertion, and it leverages in-licensed patents for the construction of this novel nuclease, which on the right side, you can see it is by virtue of its polypeptide, it has a clear IP landscape. It has high specificity, meaning it could recognize collinear DNA of a large number of base pairs from 36 to 40. And interestingly, it is blocked by histone modifications, meaning that the genomic context in which it can produce editing is focused on the target and does not lead to so-called off-target effects, in part owing to the specificity, but also as well to the histone context. And it offers unlimited genomic site selection because it does not require, as does a CRISPR derivative, a PAM sequence. It can be used for gene editing, for gene correction, as well as for safe harbor insertion. And I'll just talk a little bit about these very briefly. The novel lipid, which we spoke about, the tornado, this LNP, we have composition of matter IP. It displays low toxicity after repeated cell culture exposure, transfection. It is an efficient transfection method, even in the context of serum, and it can transfect many cell types. As shown here, this is an induced pluripotent stem cell that was transfected using the LNP tornado, carrying a synthetic RNA that directs the expression of a fluorescent protein. But when combined with a LNP tornado, can be also used to introduce genes into the ventricles of the cerebroventricular system in the brain, the neuroretina, as well as into visceral organs, as diagrammed here, the liver. I'll talk a little bit about initially our allogeneic stem cell platform, the IMSC, and mention that it is being pursued for acute respiratory distress syndrome by a company we own an interest in, Novocyte, and it is being developed for bone marrow transplant failure, poor graft function, as well as when gene edited for a variety of tumor indications. The allogeneic IMSC leverages all that I've described to date, but importantly, because it derives from a single induced pluripotent stem cell, its origins are very clear, so it addresses the issue of identity, purity, and potency. By going this route, it produces a low risk of toxicity, as do other MSCs. It is, like other MSCs, portending low immunogenicity, therefore lacking the requirement for immunosuppressive drug administration. It leverages decades of work on how to do process development and manufacturing. And we envisage a single drug product that can be used across multiple and varied clinical indications. The iPSC itself can be gene edited, so it can then reprogram or program the IMSC with additional properties that will expand the clinical indication space. The MSC therapies have had inconsistent historical clinical efficacy owing largely to product heterogeneity, which I outline on this slide, where you can see that the historical issues due to donor variability, tissue source variability, manufacturing variability, limited or inconsistent characterization, poor mechanistic understanding, all of which are addressed by using the IMSC approach. And particularly because we have such an efficient way to do gene editing, it addresses the ability to then gene edit the iPSC, and as I described moments ago, then drive the differentiated iPSC into an IMSC that has new properties. The IMSC application in graft failure and poor graft function relates to the phenomenon that MSCs modulate the immunological responses, support hematopoiesis, and can repair bone marrow stroma that often are damaged in the setting of antecedent chemotherapy needed to condition patients. The clinical applications in hematopoietic stem cell transplant, HSCT, will allow us to approach treating engraftment failure or poor graft function following transplantation, but as well promoting HSC engraftment in the setting of de novo transplantation. Working with world-class key opinion leaders in HSCTs, we are now focusing on the best clinical applications and trial design and anticipate entering into the clinic first in human in Q4 of 2023. Developing a family of gene editing IMSCs borrows on that which we've just discussed, which is the unedited iPSC-derived IMSC, and allows us to address a variety of solid tumors where there is clinical high unmet medical need. The gene editing at the iPSC level, and then the thorough characterization of that edited product, followed by differentiation, is the path forward. We illustrate here that we can insert interleukin-7 and interleukin-15 genes into a safe harbor location that will then drive expansion and engraftment in the setting of a variety of hematological malignancies. And moreover, this approach can be combined with CAR-T and checkpoint inhibitors. This diagram just lays out the process as we currently envisage. In the autologous cell therapy domain, we believe that the efficient mRNA gene editing and the efficient nanolipid particle tornado will allow us to take CD34 positive cells and then to gene edit them, ultimately allowing for those cells, once edited and free of chromosomal abnormalities, to be re-administered to patients for hemoglobinopathies, primary immunodeficiencies, and congenital cytopenias. This leverages 3 decades of clinical experience isolating CD34 positive HSCs. And moreover, we know that these cells can robustly engraft and when administered back into patients have a tremendous safety record. The mRNA-based gene editing is less complex than other methods such as viral methods and certainly is safer than those viral vectors that lead to proviral genome copy insertion. This offers substantial opportunity for future partnering. As we think about autologous iPSC therapies, the technology, again, that we've been speaking about is the safest, most efficient, and fastest method for iPSC derivation. It is safe because it is a non-integrating approach using synthetic RNA to synthesize the reprogramming of factors. It is efficient because it uses the lipid nanoparticle approach that we described, which can be then repeatedly applied to cells to lead to efficient reprogramming, and as I mentioned earlier, concurrent gene editing if warranted. And it is fast in that reprogramming and iPSC colony formation occurs within 2 weeks. The safety and reliability and speed enable these autologous iPSC programs, and it permits, this efficiency permits the reprogramming of low quantities of cells from biopsies and simultaneous correction of gene defects. We can quickly produce multiple iPSC clones per patient, and the absence of genome integration facilitates screening to identify and characterize a safe clone to move forward into further development. As an example, the autologous iPSC gene-modified autologous iPSC can be used for paroxysmal nocturnal hemoglobinuria, where a somatic mutation in the bone marrow, but not affecting other somatic tissues, does not require gene editing, and therefore it can be envisaged that this approach can be used to restore normal bone marrow function in the setting of carrying out iPSC-directed reconstitution. When we use gene editing, we can take on infectious diseases and other diseases which are of a monogenic variety the cartoon here just basically illustrates our current understanding of how this will unfold when we move forward translationally and into humans. In vivo gene editing technologies are also leveraged using the nanolipid particle, the tornado approach. We have composition of matter IP. We can tune the nanolipid particle by varying the fatty acid length, degree of desaturation, and the like. And we can deliver nucleic acids, either RNA and or DNA, which facilitates gene correction approaches. The proprietary site-specific nuclease, which I spoke about, NovaSlice, it can target any gene through design of the protein binding domains. It is highly specific to target the genomic sites and achieves high-level but transient expression, which enhances safety and likely portends lower immunogenicity. As we see this currently, the in vivo gene editing approach will involve, as I said, the nanolipid particle tornado with the synthetic RNA, which can then be used to transfect the choroid plexus, the neuroretina, or the liver to take on this monogenic disorder known as familial transthyretin amyloidosis, which actually produces clinical features in a variety of both central and peripheral targets, and therefore contemplating how to direct editing to each of those is clearly important from a clinical concept, as well as having the potential to have a single drug product delivered to the appropriate location, which is enabled by which mutations are likely needing to be corrected in which anatomical compartment. So if we consider this for a moment, this is a disorder that in the non-familial form involves patients up to a 500,000 worldwide. In the familial form, approximately 10-fold less. This will be our focus. Patients who present with symptoms typically in the peripheral neuropathy or cardiomyopathy live for 5 to 15 years unless some intervention is taken. It is autosomal dominant. It is owing to multiple mutations in the gene. The mutations increase the propensity of the encoded protein to organize into what's known as amyloid, and it is the amyloid deposition that is toxic. And the genotype-phenotype data suggests that we know where and in which location anatomically we need to do the gene editing in order to produce the appropriate clinical benefit, whether that be in the brain, the choroid plexus, the retina, or the liver. So the approach that we take is one that actually is amenable to all of the clinical features, the polyneuropathy, the cardiomyopathy, the retinopathy, and the cognitive deficits that are associated with certain mutations in each of these anatomical compartments. The Brooklyn approach can take on all of these. Our pipeline looks like this as illustrated. I mentioned acute respiratory distress syndrome and its prosecution by Novocyte. This is an unmodified or naive IMSC. Our BMT and HSC approach, our solid tumor approach with the gene edited form of the IMSC, and other oncological indications. The autologous HSC approach, we are now focusing on one of several candidates, and I just described at a high level some of the considerations in terms of clinical indications. And our autologous approach for the iPSC-derived cell therapy for paroxysmal nocturnal hemoglobinuria is the one that is most front and center. In the setting of in vivo gene editing, the transthyretin amyloidoses, as I described, which can affect the brain, the eye, and the body in terms of the heart and the peripheral nervous system, is a set of clinical indications that can, in our view, be addressed by a single gene product and be delivered to the correct anatomical compartment depending upon which mutation and which area is affected by the amyloidoses. So in summary, Brooklyn will leverage best-in-class mRNA-based technologies to deliver transformative regenerative medicine. We have exclusive license to foundational IP, mRNA, and gene editing. We have a diversified product strategy for multiple clinical indications. We have an experienced management team with a deep expertise in cell and gene therapy, strong partnership possibilities for translational execution and future innovation, and the in-licensed patent portfolio offers the possibility for sub-licensing opportunities. Thanks very much.
All right. Thank you, Howard Fedoroff, the CEO and president of Brooklyn Immunotherapeutics. Sorry, ticker is up on the screen there, BTX. If we have any questions for Howard, now would be the time to ask them. I will just ask you a question that frankly I ask a lot of people. I've asked it several times today, which is, what exactly is the most difficult thing right now?
Well, I think if you generalize the question, I think many of us that are building companies want to be efficient in use of capital because it benefits shareholders and future investors. So thinking about the prioritization and thinking about the time to demonstrate in the clinic that there is biology and often clinical benefit, I think is the path forward.
Awesome. All right. Dr. Fedoroff, thank you so much for joining us today on the Benzinga Small Cap Conference.
Thank you, Spencer, and thank you to the audience.
All right. Before we bring on our last presentation of the day, I do have to live up to my word. I promised I'd be giving away a free 1-year subscription to Benzinga Pro. Let's do that right now. Can I get a drum roll, please, from somewhere? Okay, that was a drum roll. Eliyahu Saboni, you are the winner of a free 1-year subscription. There's your air horn, Eliyahu. We will be emailing you. Expect it in the next day or so. I don't actually know when. That's somebody else. But we'll be emailing you, Eliyahu. So check your email for an email from Benzinga. You have won a free 1-year subscription to Benzinga Pro if you participated in the Slido today. And you didn't win, then that's okay, because guess what? You can play tomorrow. We've got a whole nother day of Small Cap Conference happening tomorrow. Brent Slava will be here with you, shepherding you through the day. We are almost at the end of the line today. Before we wrap up, I do have to throw to our last presentation of the day. We started the day off with a fireside chat. We're going to end the day with a fireside chat. Let's actually bring on the host of this interview. Let's bring on Miss Izzy. I see her here. She's lurking. And I want to welcome Miss Izzy. I also want to welcome Miss Izzy's mom, who I understand is watching her first live stream. Hello, Miss Izzy's mom. Miss Izzy, long time. How we doing?
I'm good. How have you been?
Doing great, doing great. Okay, we've had some clamoring in the chat, some people asking, when is NG Energy? It's now. It is now. Miss Izzy, tell us who we're talking to.
So we've got a special one here today. I thank you, Neil, for letting us squeeze this in very last minute. So we had a day to kind of get this going, but he's born ready. He's a great public speaker. He's got a ton of knowledge. Serafino Iacano, he's CEO of NG Energy. GasX, if you've heard of it, trades on both the venture exchange and OTC markets for the States. And he's also the executive chairman for Grand Columbia.
All right, can I tell you something funny that just happened? As I just threw it to you to intro him, we lost him. So okay, everyone stay put. Nobody freak out.
He's in Colombia right now. He just left Spain to Colombia 2 days ago. So he's
okay.
Yeah.
We are going to get him back. I promise. And Izzy can back me up. He was just here like 10 seconds ago. He was just here. So no one move. We're going to just sit here quietly.
This is what happens the first time I interview someone. this would happen to me. So my first time interviewing Serafino for a podcast, I lost power in my house. I have never lost power in my house.
Wait. These are the things you got to warn us about.
I know. I don't know.
You're saying this is your fault.
For good luck.
Oh my gosh. Okay. Slack is blowing up right now. We are trying to reach him. Okay. Serafino, if you can hear me through the metaverse, come back to us. This is the second time today this has happened. But that's okay. We roll with the punches here on the Benzinga Small Cap Conference. So let's do this, Miss Izzy. Since we're trying our darndest to get Serafino back right now, let's just do this. Okay. Can I just ask you, like, overall here, it was a pretty good day for the market. Were you watching things out there?
Oh yeah, I traded pretty much all day. I was like trying to escape the market, and then I just kept coming. But my group has this joke where every time I leave, they always say, Izzy will be back in 2 minutes, and I always end up coming back like every 2 minutes.
I would love to hear your thoughts, because that was a pretty rip-roaring by the dip we've had in the last couple of days there.
Yeah, I mean, so a lot of this goes back to seasonality.
Sure.
My report from this past weekend, I was expecting and anticipating this really big bullish week up until we start hitting Friday. So we have CPI on Friday, and then we start rolling into our quad witching week next week. So back in September, that was the first time that we actually slid off track for seasonality. We spiked in volatility a week early. There we go.
We got him!
You can't give me a
Serafino, welcome back.
Thanks, Bob. You guys disconnected me. Maybe you were getting bored with me. I don't know.
You know what, Izzy? I'm going to throw you the floor. Izzy, Serafino, take it away.
Hi, Serafino.
Thanks, Izzy. How are you?
I'm doing well. How are you?
Very well, thank you.
I'm going to give you another introduction because that was a little unfair that you weren't on the camera there. So everyone, Serafino Iacano, CEO of NG Energy International Corp, and he's executive chairman for Gran Colombia. So our discussion today is going to be geared more around natural gas prices. If those in the audience, if you've been watching and monitoring gas, you'd have a pretty good idea that it's been quite volatile. So we can probably just dive right in here since we're a few minutes off track. First question I had for you, Serafino, was nat gas prices. They fell and moved really dramatically over the past fall. Some saying that this has been probably a record-breaking few months, right, in terms of warmth in the States. What effect has the spike in international prices had on domestic gas prices in Colombia? And how does this impact the markets in which you operate?
Well, in Colombia, it's a little bit different. It's a very captive market. In the United States, natural gas is used, or in Europe, it's used for heating and then for home usage. In Colombia, natural gas is used to produce electricity and for cooking and heating water. So completely different kind of market. I see the volatility that there is in worldwide, but it's also one of those moments. I think that the market went ahead of itself with prices, but I don't think they're wrong. Natural gas is going to be the substitute for everything that everybody's talking about. Coal, that I don't think it's going to happen as fast as everybody thinks. And this new goal that everybody has set for 2050 to be neutral emission of energy for energy, that's going to, in countries like Colombia, natural gas is always double whatever the price is of oil. So to give you a reference, WTI, normally natural gas in Colombia would be 12% of WTI, more or less. Depends if it's interruptible or if it's a long-term contract. In the case of Colombia, we are getting 7 to 750 per million BTU. So that's a very, very solid return on the investments of shareholders, especially our shareholders. Our total all-in sustainable cost for a million BTUs of gas, it's including royalties, it's $2 per million BTUs. So you have a very, very nice profit before taxes.
That's actually, I posted an article last night, just a really, really short, brief analysis that I did on gas. And I did a cross comparison with GasX, and there was no correlation to the decline in current gas prices, right? GasX is still holding up pretty strong. So it kind of reflects that, pricing in Colombia probably wasn't really impacted as much as it would be over in the States.
Well, in the States, I believe in the States it went down to $4, right?
Yes, yeah, actually lower than that,
Well,
so slightly lower.
Well, it was. I believe that it's going to go up again, and it's not a reflection of the cold or if it's a warm weather. I think it's a reflection of everybody that's got to put their infrastructure together and start using electricity. And where is the electricity for all these electric cars going to come from? Nobody has been able to give me an answer. It's not going to come from solar, that's for sure.
I have a bullish outlook for 2022 nat gas and for crude oil. So I'm probably a little bit biased when it comes to that, right? But I've done my quarterly and yearly analysis so far. Crude was my biggest swing for 2021, right? I did it as a yearly play and it's been on track. So if we keep moving in that direction, right, since the two are correlated, and like you said, you did a really easy calculation for everyone to kind of understand.
Just remember that a year ago now, oil went to negative money. You actually got zero money for your oil that was stored. Okay, it was absurd. Natural gas. Look, the world is going to realize that neither by 2030 or 2050 we are going to be ready with the expansion of electricity usage that is going to be in the world. I believe that electric cars are a reality, or bus or trains or things like that. But that only is going to enhance the use of and consumption of natural gas. And on the side of oil, I agree with you. Everybody thinks that oil, it's used 100% to make gasoline. Only 25% of oil is used for fuel. 75% is used for everything that we use on a daily basis in our normal life that we don't even think about, from polyethylenes to fertilizers to plastics and everything else.
Thank you for that. So second one is a little bit more related to GasX in particular. I know that you guys are ready to start drilling out there. Could you expand a little bit more on production at Maria Conchita and drilling out of Sinu 9?
Yeah, Maria Conchita, as we speak this week, they're finalizing the installation of the cleaning facilities for the Arruchara well and for the Istanbul well. It's going to be tested for about a week for bugs. You got to debug it after you put it together. And we expect between 2 weeks, 3 weeks, the latest, start delivery of natural gas to our customers in Maria Conchita. We're going to start with Istanbul with 4 million cubic feet of gas for domestic use in a very close area to where we are, that is called Valledupar and all the surrounding areas that take that. And Rio Hacha in particular, they're going to deliver the natural gas by trucks, but cleaned into our facility. By the end of the month, we're going to be testing our 14-kilometer pipeline so that we can, by January, start delivering natural gas from the Arruchara well, which is about 15 million cubic feet to start a day, to our customers in Bogota in the southern part of Colombia.
Okay.
Now the drilling in Sinu 9, we are building the pads on the north part of the concession, and on the south part of the concession we're building 2 pads. The 2 pads are going to be receiving simultaneously. We're looking for a second rig. The south is going to start drilling probably by the end of the month, and simultaneously in the north and the south. so that we can get results on both concession, on both first drill hole. It's going to take about 3 weeks to drill it. It's going to take extensive testing. It's going to take about 15 days. And then it's declaring commercialization and then going through the routine of putting together the infrastructure to deliver that gas to our customers. And we are still going to continue with the same rigs, drilling the all other areas as we finish reaching our program for 2022 of 6 wells.
What does that mean for cash flow then for GasX for 2022?
2022, we expect 35 million in EBITDA out of Maria Conchita. The money from Sinu 9 will come in probably by the third quarter. I'm not making any projections on that simply because we want to see what kind of results we have and how long does it take for us to build the infrastructure to connect. We have to build a 25-kilometer pipeline to hook up the gas.
Yeah, and that's fair. You touched a little bit earlier on oil prices and the correlation. So something I've been reading a little bit over the last few months on oil and nat gas is they haven't been as seasonally correlated as they've been in the past, right? So what's your take on that? And how well correlated do you think that prices have been in your experience and maybe the outlook for even for crude for 2022?
Look, let's start with the correlation of the U.S. is a very particular place for natural gas. You know, God was good to the U.S. and it's loaded with natural gas everywhere. It's got a fantastic infrastructure in place that was built in the days of Enron. Everybody probably half of your people don't even remember what Enron was, but it was the biggest infrastructure company to deliver gas. That's what's left out of it. So natural gas has very low cost of production in the United States, and it's got very low cost of delivery. So it's got the luxury of going up and going down. You got to correlate natural gas to outside of the United States. Go to Europe, and right now in Europe, natural gas sells for $16 per million BTUs. Okay?
Yeah.
$16 per million BTUs. It's 3 times, 4 times what it's sold in the U.S. Same thing with Asia. In Asia, natural gas sells at between $21 and $30 per million BTUs. So it's the same thing. In Colombia, it sells at $7. In the Caribbean, it sells at $9. And so on and so on and so on. So the correlation is oil. And you got to look at the price of oil. And WTI is the needle. Why? Because it reflects a barrel of oil versus a million BTUs that it's produced by natural gas. So it's 12%. That's it. So oil is up, natural gas is up. Oil is down, natural gas is down, with the exception of certain countries that they have the need for that thing. I believe that oil is going to stay in the 70s and 80 for quite a long time. And then I believe that by next year, it's going to touch the 100. That's because of consumption by people, not only with cars. Look, reality is the millions and millions of cars that are in this world are not going to disappear by 2025. And I just bought a new car last month. All right, it's a dual car. I'll pay my taxes, but I'm not going to get rid of the gasoline car. I have a car that uses both energy and gasoline, electricity and gasoline. But I go back to the same point, nobody has been able to tell me electricity to power all these cars is either going to come from coal, from nuclear power, from natural gas, okay? and maybe a little bit from solar and wind, but it's not going to be everything from solar and wind unless we want to cover the earth with solar panel and windmills. I don't know.
If anyone in the audience wants to try, challenging Serafino on that, this is the time to do it. No, I think I'd have to agree with you on that. I'm very pro EV and being clean energy, but it's more so the efficiency and long term, right? And the timeline that people are putting on this is, it's a little bit unrealistic in my opinion, right? But do I think it's never going to happen? No, right? Do I think that
it's going to happen?
Yes, but there's a lot more factors behind the scenes that maybe people that are not in the industry don't really know about, right? Like, so I come from a power and gas industry myself, right? So I understand the efficiency side of things, right? So and so far we just don't quite have that yet. But
well, look, you're going to cook with solar power. You're going to cook with solar power in houses with electricity. At night, you're not going to be
probably
able to cook.
Where I live.
Not where I live either.
So
not where I live either. Look, we have to be conscious and we have to be aware. And this is the only place that we have. I think that there is a transition and there's going to be technologies that are going to be invented. And I believe that in the future, there's going to be more technologies that are going to be invented to produce natural gas cleaner and do something with the CO2 emission and control those. That's where I believe that it's going to go.
Well, I think I'm out of questions, and I think we're actually out of time. So this was timed pretty perfectly.
Izzy, pleasure talking to you. Thank you for giving us the time, and we'll hope to see you soon.
I hope so too. Hopefully next time in person.
Take care. Absolutely. Take care.
Thank you so much.
All right. Thank you, Serafino. Thank you, Izzy.
You're welcome.
We bore through it. We got through the technical glitches.
Oh my, please God, don't do this to me. Don't do this.
We just roll with it. Just roll with it. That's what you did.
I could have talked about the market for like the next 20 minutes. I was ready to tell you guys about seasonality and how we had a spike in volatility and now it spiked back down, which meant we're going to be going up this week. So we're back on track in terms of seasonality. That's what I was kind of going back to.
Santa Claus is coming to town. Santa Claus rally.
Which means we might spike right back down next week because now we're back on track.
Actually, if memory serves, I believe the Santa Claus rally only actually refers to like the 2 or 3 days before Christmas.
Yeah, because it's like usually right before the week of quad witching.
Yeah, well, that too. Yeah, which is next week. So, all right. Hey, guys, smash the like for Miss Izzy. Thank you so much for coming on the Benzinga Small Cap Conference today. Tell the people where they can find you.
Having me. Always a pleasure being on here, Spencer. Thank you so much.
Yeah, tell people where they can find you. If they don't know.
You can find me on Twitter, _Miss MS _ Izzy IZZY. And then on my website, www.missizzytrades.com.
All right. Thanks a lot, Izzy.
Thank you. Merry Christmas, everyone.
Merry Christmas to you as well. All right. Hey, listen, we have come to the end of our day. If we can get some more likes. Wait, before we go, let me just see how many likes we're at. Are we at like 300 yet? Yeah. Oh, can we get to 350? That's like 2 more. We can get it. We can do it right here. Oh, yeah. 350. Let's get to 350. That's a very low bar to clear. That's like 1 more like. Just do it. There we go. See, I'm happy now. All right. I cannot end the stream today without first giving thanks to all of the companies that presented today, all of the speakers, all of the question askers in the chat, the hosts we had on the stream, all the work from our events team behind the scenes to put days like this together does not go unnoticed. It is because of them we have this day. So thank you to the whole events team. Thanks to everyone in our chat for hanging out, for talking stocks, for asking good questions. Some of you asked some weird questions. Those are cool too. So thanks to everyone in the chat. We'll be back with day 2 tomorrow. First, though, want to end with a quick word from our sponsor, Zuber Lawler. We're going to let them play us out, and then we'll catch you guys tomorrow morning.
Hello, I'm Tom Zuber. I'm the managing partner of Zuber Lawler. I'd like to thank our friends at Benzinga for the opportunity to speak today. Zuber Lawler is one of the most selective law firms in the United States. Our attorneys represent clients around the world, from offices in Austin, Chicago, Denver, Los Angeles, New York, Phoenix, and Silicon Valley. We focus on high-stakes deals, intellectual property matters, FDA, import, export, and other regulatory work, and litigation. We work in languages covering 90% of the world's population. Zuber Lawler is unique in the sense that the firm represents a long list of iconic fortune companies and global funds, and has also been representing leading cannabis companies for over 14 years. This provides our attorneys with an ideal perspective from which to manage high-stakes, complex matters in the cannabis space. Indeed, Zuber Lawler practices at the cutting edge of cannabis law. As examples, Zuber Lawler is a pioneer of the two-stage M&A deal, allowing continuity of cannabis operations in the context of U.S. restrictions on the transfer of ownership of cannabis licenses. Zuber Lawler obtained the second ever issued U.S. plant patent for a cannabis strain, as well as utility patents on cannabis processes, machines, and formulations. Zuber Lawler obtained federal trademark allowances for cannabis brands in relation to relevant products. One of our attorneys obtained the first ever issued generally recognized as safe designation from the FDA for hemp seeds and foods. And Zuber Lawler advises hemp companies on international import-export issues relating to North America, South America, Europe, and the Middle East. Zuber Lawler is currently managing major patent, trademark, trade secret, and commercial litigation in the cannabis space. I'm excited to participate in Benzinga's conference. I hope to meet you virtually and in person sometime soon. Thank you.